We build investor audiences for small cap companies, retail and institutional. 33 years, thousands of clients. We are experts in messaging, national TV ad campaigns, investor webinars, digital media, reaching hundreds of thousands of investors. RedChip. We do it well, we do it right, we do it big. RedChip. Call us or email us today.
Getting started in about a minute.
Platforms.
Hello and welcome to RedChip's virtual conference, Beyond the Index, the next generation of ETF investing. Our first speaker today will be Michael Serrano, the Managing Director of RedChip, followed by Barrett Boone, Vice President of Global Markets.
Hi, I'm Michael Serrano, Managing Director at RedChip Companies. Thank you for being with us today. I want to first give you a brief history of RedChip. We were founded in 1992 as a small cap research firm, putting coverage on companies like Daktronics, Winnebago, Starbucks, and even Apple in the early 1990s. Over the years, we evolved into a full-service investor relations and media firm. We've represented companies like US Steel, Perfumania, Celsius, Apollo Medical, and many other companies that ultimately became blue chip companies. We have a very long and rich history. Today, we offer the most robust platform for small cap companies, reaching both institutional and retail investors on a global platform. A platform that has its own TV show called Small Stocks, Big Money, titled after our CEO Dave Gentry's book, Small Stocks, Big Money, published by Wiley, and airing on Bloomberg Network every Saturday at 7 p.m. and on CNBC on Sundays at 11 a.m. Eastern Time. The backbone of our investor relations platform is our outbound marketing team, who speak to hundreds of investors every day. RIAs, portfolio managers, analysts, and high net worth investors, our team generates roughly 500 new investor leads every month. We have a webinar platform in which we'll put hundreds, sometimes thousands of investors on one Zoom platform for our clients to present their story. We do roadshows in up to 8 US cities. We have a very prolific digital media, social media platform with over 140,000 followers. And we have our national TV media platform in which we write and produce and air 30-second TV ads on financial stations nationwide. You can learn more about RedChip and our platform at redchip.com. Next, we'll take a high-level overview of the market and the industry landscape.
Hi, I'm Barrett Boone, Vice President of Global Markets here at RedChip Companies. 1,019. That is how many new ETFs launched globally in the first 6 months of this year, from 253 different providers. Not over the last decade, just in the past 6 months. Here's why that matters. For 34 years, RedChip has solved one problem. Excellent companies exist that no one is covering, and investors cannot allocate to what they cannot find. That is a discovery problem. The ETF industry now has the same problem. The wrapper has become so efficient and so accessible that innovation is arriving faster than any investor or advisor can reasonably evaluate. The strategies actually of solving the portfolio problem are getting lost in the noise alongside everything else. That is why we built this conference. So let me frame the 3 structural shifts defining where this industry is going, because every firm presenting today sits inside at least one of them. For 20 years, ETF and passive were treated as synonyms. That is now over. Actively managed ETFs pulled in a record $500 billion in net inflows through the first half of 2026. That is more than double the previous full-year record of $266 billion set in 2025, and more than triple the $552 billion reported in 2024. Active ETFs now stand at a record $2.5 trillion globally. That's up 34% in 6 months, marking the 75th consecutive month of net inflows. Active strategies accounted for roughly 36% of all ETF inflows this year alone. Investors are not simply buying cheap beta anymore. They want the structural advantages of the ETF, meaning tax efficiency, intraday liquidity, and transparent holdings, combined with the genuine security selection. The wrapper has become the product, regardless of what sits inside of it. You will hear that thesis expressed differently today. Principal brings institutional scale active management into the ETF format. Founder ETFs is expressing a specific factor, investing in companies where the original founder still runs the business as the chief executive officer. Now that is actively managed conviction, not an index screen. The second shift is perhaps the most misunderstood, but the most important one to get right. Traditional income investing meant buying dividend payers and coupon bonds and collecting whatever they distributed. The next generation of income ETFs manufactures cash flow using options, preferreds, and capital structure positioning. Infrastructure Capital Advisors has built its platform around this. Jay Hatfield has nearly 3 decades in the market and manages more than $3.5 billion across equity income, small cap income, master limited partnerships, REIT preferreds, and corporate bonds. The unifying idea is that income can be sourced from parts of the capital structure most investors never touch. YieldMax has actually pushed this concept further, using actively managed option strategies on single reference equities to generate weekly distributions. Worth stating precisely, the firm asked to be described as an option income manager rather than a covered call manager, because the strategies primarily use call spreads designed to retain more upside participation than a traditional covered call would. Now, these are sophisticated structures. Distribution rates are not yields, and distributions may include return of capital. That is not a criticism, it is the mechanics in work. Ask the presenters about it directly. The firms that explain their mechanics clearly are the ones that are worth your time. Now, the third shift is that thematic investing has matured from a marketing exercise into an allocation discipline. The market has been ruthless about sorting the two. The clearest example today is actually Procure, who's going to be presenting, who launched the world's first pure play space ETF in 2019. Assets fell as low as roughly $30 million. Most issuers, they would have closed the fund. Procure held the strategy through the drawdown, and in May it crossed over $1 billion in assets under management. When SpaceX went public in June, that fund was one of the few vehicles that owned it mechanically on day one. Andrew, who you'll hear from today, described the milestone as validation that the space economy has graduated from a thematic curiosity into a core portfolio allocation. MuseQ applies the same discipline differently. David Shuloff spent 25 years inside of the music industry before launching a fund built around a specific insight. Streaming subscriptions and live events reinforce each other, and music catalogs have become a recognized income-producing asset class. That is domain expertise expressed as a portfolio, not a trend chased with a ticker. Now, let's back up to that opening number. 1,000 new ETFs in 6 months does not happen without infrastructure. Tidal Financial Group is a significant part of the answer, operating a white label platform servicing more than 420 ETFs across 90 plus issuers, with over $60 billion in AUM. If you have wondered how a boutique manager with a genuinely good idea can now launch a competitive ETF without building a fund complex from scratch, this is how. Aptus Capital Advisors addresses the other side of that equation. What advisors actually do with these tools? Their focus is risk mitigation through buffered and hedged equity strategies, delivering through multi-manager models across firms like Schwab, Envest, Altruist, and other advisor platforms. Building blocks only matter if somebody knows how to assemble them. WisdomTree gives you the clearest view of this frontier. The firm manages more than $150 billion, up over 30% year over year. But the more interesting story here is actually tokenization. Their tokenized asset base grew roughly 25-fold in a single year, and in February they received SEC release to offer 24/7 trading with instant settlement on registered tokenized money market funds, which was a first inside of the US regulatory perimeter. Their leadership has argued that the early adoption curve for tokenized real-world assets is steeper than the early adoption curve for ETFs themselves were in the 1990s. If that is even directionally correct, it deserves your attention. As you listen today, I would ask that you evaluate every strategy against these 3 questions. First, what portfolio problem does this actually solve, and is that problem real? Second, what is the source of the return or the income, and can the manager explain the mechanics in plain language? And third, what does this cost in fees, in tax treatment, and in trade-offs that you're willing or not willing to accept, whether that is capped upside, tracking error, or concentration. Nothing you hear today will be a recommendation, and every product discussed carries risk. Read the prospectuses, do the work, but do it with better information than you had this morning. The index was the first revolution. It made market exposure nearly free, and it was one of the great wins for individual investors in financial history. What is happening now is the second revolution. Active management, engineered income, precision thematics, and institutional risk tools, not to mention tokenized settlement. They are all being delivered through that same efficient structure today. That is substantially larger than the opportunity set that most portfolios currently reflect. RedChip's job has always been to close the distance between good ideas and the investors who should know about them. Today, we are doing that in a new arena with the same conviction. On behalf of our entire team, thank you to every firm presenting, and thank you all for joining us. Beyond the index, the next generation of ETF investing will begin shortly.
Thank you, Michael and Barrett. Up next in today's Beyond the Index conference is ER Shares. Presenting today will be the CEO and CIO, Joel M. Schulman. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Joel, are you there?
I'm here. Can you hear me?
I hear you loud and clear.
Okay.
Please go
Great.
ahead.
Okay, thank you so much, and thank you very much for inviting me to this session. It's certainly a pleasure and an honor to be here to present. And I think there's a series of slides that your group is going to put up. So if we can start the slides, that'll be fantastic. I don't know if the slides are being shown, but I had a series of slides that I was hoping we would see.
Joel, we are loading them up right now. Thank you.
Okay. All right. Thanks. All right. So what we're going to talk about today is what we refer to as the ER30 Total Return Index, the Entrepreneur 30 Total Return Index. Now, this index has what we call the entrepreneur factor. The factor is what is left over after you run a factor analysis against all the sort of prevailing factors that would traditionally be included for growth or value, or whether we're looking at oil or any sort of combination of these sorts of characteristics. The residual systematic factor is this premium, which we refer to as the entrepreneur factor. Now, we create this proprietary lens using 19 attributes, and we use a VC lens. So we look at it through the eyes of what a venture capitalist would do when they select their companies. And we've done this for over 21 years. It's a 21-year history. We started with, for example, NVIDIA was in our very first portfolio 21 years ago when it was a $5 stock. We had Amazon and many others. So you can imagine that the performance is very strong. In fact, in the last 21 years, it dominates, the peer indices like the S&P and the Russell 1000 growth, or the Dow. It doubles, triples the S&P over that 21 years. It beats the Qs. And so this is an index that is actively selected, passively managed. We use our proprietary 19 attributes. And as we see in the next slide, please, if you go to the next slide. If we can advance, I don't know if I'm allowed to advance the presentation. Over this period of time, this has been the performance of the index for 21 years. Again, we rebalance and reconstitute quarterly. So rebalancing means, depending on how the weights in the securities move, we rebalance, and then we reconstitute quarterly based on various market conditions using our 19 attributes. And you see the performance of this over the last 21 years. If you go to the next slide, please, you'll see a graph of this chart. And you'll see again what it moves consistent with other growth indices. So when the markets fell down in 2021, we moved with it. In 2008, obviously, it would come down as well. But during the growth periods, it tends to move very, very strong. And so it tends to move stronger than the traditional growth indices like the Russell 1000 growth in both directions. And so what we've done with our index is we've paired our index in our ETF. We have an ETF called XOVR. We were the first ETF. 2 years ago, actually this month, in fact, 2 years ago, almost this week, we were the first to put private equity exposure in an ETF wrapper. So those of you who've heard private equity in an ETF, it's now more commonplace, but we did it 2 years ago. And the private equity we put in was SpaceX. We had a position that, at its peak was 450 million. We've got about 2 billion in our XOVR ETF. And the importance of this, and the reason why it's a nice fit for this particular conference beyond the index, is we took an actively selected, passively managed index, and then we paired, and we using the VC lens of how we select companies, then we paired it with private equity companies that perform in a similar manner. So we didn't just plop in something in our ETF that wasn't consistent or commensurate with the characteristics and the strategy of the index. We took something that was perfectly compatible with the index. And so these companies are coming out, like a SpaceX or some of the others that are being announced, they fit our model. And it's more than a founder CEO model. We had a founder CEO index, 20 years ago and so forth, but it's much more than that. It's another, 17 variables that VCs would look at in terms of, the parameters that they would use to select companies, which looks at the economic incentives, compensation, growth metrics, and so forth. And we use an overlay that looks at, traditional valuation metrics as well to see whether or not we want to have that as a high weight. So this particular index, the Entrepreneur 30 Total Return Index, which will soon be its own pure play ETF. So we're going to, since we've already got about $1.5 billion AUM tracking it, we're going to make its own pure play index for those who want just a pure play index. But we'll have in our ETF, we'll have again, currently we have SpaceX. We just bought a position of Kelce, commensurate risk characteristics. Many of you listening probably are familiar with Kelce. Is a strong, entrepreneurial, growth company that's backed by VCs, and so we're delighted to have it. We got it a month ago at a $22 billion valuation, and we think it's a great, strong growth company. We're looking at many other private equities to try to give investors an opportunity to get returns prior to the company going public. And really, that's what we're doing with our index. We're pairing a terrific public company platform, our Entrepreneur 30 or ER30 Total Return Index, and we're pairing that with up and coming private companies that may soon go public. And we're trying to give investors the best of the public market and what we deem to be the best of the private market. And that's what we're doing. And it's a pleasure to share that story here on this RedChip conference, Beyond the Index. And I think I'm out of time now, but I don't know if I'm allowed to have questions or if this is it, but it's been a real pleasure to introduce this topic and be part of this conference. So thank you.
Well, thank you, Joel. No, we're not going to have any questions. That'll be it for you today. And we very much appreciate you coming on. Thank you.
Thank you, sir. Good day.
Yes, and for additional information about ER Shares and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. As Joel noted, it is now 9:50 a.m. Eastern Time, and up next in today's Beyond the Index conference is Victory Shares. Presenting today will be the portfolio manager, Michael Mack. Now, before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Michael, are you there?
Yes. Hi.
Good. I hear you, and yes, we see you. Whenever you're ready, go right ahead.
Great. Thanks for having me. Wanted to talk today about the opportunity we see in the market in terms of really, there's two primary risk factors facing the market. Number one, market concentration. The Mag 7, they make up a large percentage of not just the growth side of the box, but also increasingly they're showing up in value strategies. For example, SpaceX is in a value ETF. Tesla is in the S&P 500 value. So people are really having to look through their portfolios to make sure they're not overexposed to companies that they wouldn't expect, or doubling down on the Mag 7 unexpectedly. The other risk facing equity markets today is valuation risks, right? The fact that the market's at 22 or 20 plus times earnings today. Historically, anytime we've been above that level on a forward price to earnings basis, volatilities ensued. And so it's important the control for your portfolio's valuation, right? So you don't have a year like 22 where you start the year at 22 times earnings, in the year at 16 times earnings, right? And it's the portfolio going down that makes that happen. Screening for valuation can control for that. The other thing we're seeing is free cash flow is becoming top of mind, and it's what we'd like to talk about today. If you think about what's going on in the marketplace currently, for years, companies were generating returns on capital in excess of their growth rates, which meant, like, if you take the Mag 7, they could fund their growth just using internally generated cash flows. But today, as this massive CapEx spend has come about, it's lowered their ROIs, which means now they're having to fund their growth externally, right, via the bond market, or the equity market. And we've seen, back in the 1990s, we heard the story of the bond vigilantes. We're seeing a similar instance here where the bond market's saying no more AI debt. We're tired of companies, spending a ton of money and coming to the bond market to fund them. So what's happened is they tried to go to the equity markets, and that's also been received very poorly. And so we're kind of coining our new term of the equity vigilantes, right? Where companies that are trying to issue stock are being punished by the market. And so it's very important to consider free cash flow. And I'll just touch on briefly, high level what we're looking at here, but you can kind of see, in terms of the industry landscape, there's different ways to value a company. We think in today's environment, really, it makes sense to value a company based on their cash flows, right? You see there the value of a company, it's the present value of its future free cash flow. And so our belief is aligning your value strategy with what ultimately determines value is going to help produce better outcomes over time. The disconnect in the marketplace today, you'll see, is that a lot of indexes focus on price to book, being assets minus liabilities. Well, the problem is most companies' assets are intangible and they're not showing up on a company's balance sheet. And so it's become increasingly hard to value a company based on their price to book. The solution is to look at free cash flow, right? You see here, none of the value indexes look at free cash flow. So in the VictoryShares lineup, we built a free cash flow suite, targeting free cash flow with the hopes of applying the concept inside a tax efficient ETF wrapper. You can kind of see here, here's a study for why you want to consider free cash flow on the value side of the market. This is a simple study. It says if you selected 100 companies based on valuation, what would that portfolio's risk and return look like over time? And you see here a portfolio built on free cash flow that was rebalanced quarterly. Not only would it have generated the highest return, it would have also done so with the least amount of risk. So broadly, we like free cash flow. Now, there's different ways to look at free cash flow. We think the way we approach it is unique in the sense of really there's two things that are important. Number one, you want to take a forward-looking approach to free cash flow, right? A lot of strategies just look at a company's trailing metrics, but as this market evolves faster and faster, it's important to factor in the forward cash flows. These are sourced from the consensus analyst estimates. They don't have to be perfectly accurate. They just have to be directionally accurate. And if you think about why, one is an avoidance case. 2014, when oil went from 100 to 40, if you're just looking at trailing, you're going to think the energy company's cheap, only to find out at $40 a barrel they're not. So the forward look keeps you out. And then on the positive side of the equation, we saw last year with Dell. Dell was a name that screened into the portfolio based on their forward free cash flow. Because if you think about Dell, prior to 2025, they were a slow growth PC business. In the summer of 25, they telegraphed to the market that they are now going to be a fast growing AI business. And so the forward estimates increased to reflect that. So we take free cash flow, we put it over enterprise value, market cap plus debt, minus cash, right? Captures the full balance sheet. And that gives us a valuation metric, right? Then the second thing we like to look for is we apply a growth filter. We simply screen the highest free cash flow yielders based on their growth, right? And you can kind of see here the process, how we do it. And then here are the results to this, right? As you build upon it, you see trailing being a great foundation, trailing free cash flow yield. Then that forward free cash flow yield we just talked about. Well, then once we have those highest free cash flow yielders, we rank them based on their growth. Because what can really hurt a value strategy is value traps, right? Companies that are cheap, but cheap for a reason. They haven't grown. Think of General Mills or Comcast. And so our research has found if you simply exclude the slowest growers, you can enhance returns an additional 100 basis points, right, over time. And so we have a couple ways to look at it. This is large value. It's ultimately going to be 50 stocks. We also have a small value and an international value version of this, S-Flow and I-Flow. All of them follow the same approach. They have a starting universe that excludes financials and real estate. You then select the 70, in this case, a V-Flow, you select the 75 highest. You then apply that growth filter. Notice something pretty cool. Your growth rate goes up 4%, but your free cash flow yield doesn't decline. This is really important to our process. We are able to factor in growth so we avoid value traps and we can perform in all environments or in most. But we still remain as value as before because we don't sacrifice valuation. This is a 50 stock portfolio. All of these ETFs rebalance quarterly, same day as the S&P, March, September, October, December, etc. And so, if you look at where we are today, the goal for a strategy like this is to outperform in a value market, tie in a growth market, which is what we've seen so far from our large cap version. Our small cap version, S-Flow, is the cheapest of the group. But if we look at a big picture of where free cash flow yield is as a factor, it's had a good run, but historically high free cash flow stocks have traded at a 25% discount, right? Versus the S&P. So let's say 16 times versus the S&P at 20. Today, that discount is 40%. So 15% higher than we normally see. We think this points to really value being in the early stages of a comeback, and there's still being a lot of room for value to go, given the 15 years of value not being rewarded. We could be due for a longer cycle. What I got. Any other questions?
Michael, no, we're going to leave it just at a presentation. Thank you. It is now 10 o'clock, so you ended up just on time. Thank you very much, Michael.
Thank you.
For additional information about Victory Shares and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact us, RedChip, at 1-800-REDCHIP or at info@redchip.com. It is now 10 o'clock a.m. Eastern Time, and up next in today's Beyond the Index conference is MUSQ, the Global Music Industry Index ETF. Presenting today will be the founder and CEO, David Schulhoff. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. David, please go right ahead.
Thank you, Craig. Good morning, everyone. My name is David Schulhoff. I'm the founder and CEO of MUSQ, the Music ETF. I have created the first pure play music ETF, giving investors exposure to the global music industry ecosystem. By quick way of background, I've been investing in music companies, public and private, for the last 25 plus years. I was recently president at Live One, overseeing podcast and digital streaming and content. I was the president of music at AGC Film Studios and I Am Global Studios. And before that, I had a company called Evergreen. We were one of the first private equity backed companies. I owned all the rights from Bill Monroe to Death Row. We acquired 26 companies, MC Hammer, Two Live Crew, JJ Cale. We won the Grammy with Eric Clapton for The Road to Escondido. Taylor Swift was my writer when she was 14 years old. We had Seals and Crofts, big part of the Michael Jackson catalog. I sold that portfolio to KKR. That company became BMG Rights Management. I'm trained as a lawyer, and have really been in this industry a long time. And about 3 years ago, I saw how much money was pouring into the space. Every private equity firm, from Providence Equity Partners to Blackstone to KKR to Apollo, they were all investing in the space, but there was no retail product for investors to invest in the global music industry. And you had so many companies globally, in South Korea, in China, in Japan, in Germany, obviously in the US, but you had no convenient way to invest in all of them. So that's why I created MUSQ. We're trading now on the New York Stock Exchange. We just had our 3rd-year anniversary, and this is a really convenient and exciting way to invest in all aspects of the music industry, from your favorite artist to live music to AI to equipment to content. And we'll get into all of that today. I like to open up with this chart just to show you how exciting and how far the industry has started. I mean, 150 years ago, Thomas Edison invented the phonograph, and look at all the change in the music industry, from acetate recordings to vinyl to LPs to cassettes and the Walkman, and then the introduction of the CD, the birth of MTV. And then, of course, you had Napster 27 years ago that got introduced, followed by the growth of streaming and satellite and all the different streaming services today, and then the rise of K-pop and TikTok. And here we are in this explosive AI music economy. And this fund is just ready to take advantage of all of the exciting revolution happening in the area of music right now. So fasten your seatbelts. I'm going to show you the most exciting fund in the music industry, MUSQ. The investment case for music is quite simple. The industry is doubling in the next 6 to 7 years. Okay. Today, we're roughly a $110 billion business. 3 biggest revenue drivers are, live music events and ticketing, recorded music, and publishing. And if you love music and you want to learn about the business of it, I encourage you to go read the Music in the Air report. Lisa Yang wrote it for the last 15 years. She recently got hired to go work for Rob Kinsel, the CEO at Warner's, but there's still I don't know who's replaced her, but she's got this amazing report that they write every year, and that shows you how the industry is doubling. So right now is a great time to invest in the space, because live music is doubling, publishing is doubling, recorded music is doubling, paid streaming subscribers are doubling. So today you have roughly a little under 1 billion paid streaming subscribers. Spotify, of course, is number one with 300 million paid streaming subscribers, followed by Tencent Music and YouTube Music, then followed by Apple and Amazon. And those paid streaming numbers are going to double to 2 billion. A lot of that growth in the US, but even more so in the emerging markets, where streaming is growing at a double-digit clip. JP Morgan has called music the best content story in the history of the media business. There's a reason for that, okay? Music today is incredibly undervalued. It's incredibly undermonetized. $11 a month for Spotify. It's half of what you pay for Netflix, for HBO Go, for Hulu, for Fox One. And so, over the next several years, you're going to see an enormous amount of what I call monetization density. You're going to see a lot of the streaming services raise rates. So there's going to be massive growth, not just through onboarding new subscribers, but squeezing incremental revenue from existing subscribers. And JP Morgan has, again, calls it a really great content story through the growth of subscribers and through the growth of monetization in developed markets and also in ancillary areas, from health to fitness and social media. So music is just, it's everywhere. It's pandemic. It is incorporated into every single social media platform. Okay, every social media platform has to have a music license. You cannot stream music in any service today, not from Snapchat to TikTok to anything that you see has to have a performing rights and mechanical license. Okay, and those rates continue to go up. And so you have structural protections to the music industry, which are only going to grow. This chart shows you, music was a $20 billion business in 1999 or 2000. Today, it has more than doubled. You can see, of course, physical product declining as Napster entered the equation, but then you had this explosive growth with streaming. And so the industry on the recorded side was roughly 20 billion. It's close to 50 billion today. A lot of that is driven by streaming, but now you have, again, monetization density. You have these super fans that are, eating up vinyl recordings. So you have the growth of vinyl. You have music that's being used in advertising and TV shows and sampling and in all these different social media uses. And so it's on track to triple from where it was 20 years ago. This just shows you a little pie chart on where we are, in terms of the global growth of music, in terms of the growth of streaming and the growth of live music. These are obviously some of the large music markets around the world. The U.S. is about 50%. So the U.S. drives about 50% of the market, and then, followed by Japan and the UK and Germany and China. I like to show this chart because it shows streaming penetration as a percentage of smartphone users. So here you can see that in the US, it's roughly 65 to 70%, but it's a lot lower in the emerging markets. So what that means is that streaming penetration is really expected to grow as all these services get onboarded onto these smartphones. So in some of these emerging markets, those represent big opportunities for the growth of new paid streaming subscribers. This is another interesting chart I'd like to discuss. If you love music, and Auerbach just told me how much he's a Phish fan, and all my friends tell me how much they've been consuming music. If you've been consuming music as long as I have, and probably everyone here has consumed music, 25 years ago, that was like close to 10% of your entertainment spend at home. Okay. Today, it's less than 1%. And why is that? It's obviously because of streaming. Now you're paying $11 a month. You're paying $120 a year to have access to 250 million songs. You're used to like buying 10 CDs for like $400 or $500, and you're used to buying tickets. And so again, that goes back to the investment thesis that music is incredibly undervalued, incredibly undermonetized. Spotify should be charging 3 times what it's charging right now. And we are going to see them continue to raise rates. And they're doing that almost every quarter now with very little attrition, again, because we are all used to spending a lot more money on music. This shows you just some of the, streaming leaders in the music world. Um, Spotify, Tencent, Apple, Amazon Music, and some of the other smaller players in China. You know, I'm showing you this chart. I could really teach a whole course on this, and I don't want to, and everyone loves talking about this. And so I'm going to spend 2 minutes on it, but this is a very deep discussion. So everyone loves, understanding music publishing and music catalogs. And, obviously the headline articles all the time are Springsteen sells for 20x, or Bob Dylan, or Tom Petty, or Fleetwood Mac, or our whole industry is really about this right here. When you talk about what is Spotify doing, they're in the business of the exploitation of music royalties. And so we are an alternative asset class, okay? It's important to understand that there are two different copyrights in our business. You have the music and lyrics, those are part of the underlying musical work, and then you have recordings of that. So Bob Dylan wrote that beautiful song, Knocking on Heaven's Door, in 1973. How many times has that been recorded? Hundreds of times, right? It's been recorded obviously by Bob, but by Springsteen, by Axl Rose, hundreds of artists have recorded that, right? And so music catalogs get traded, they get sold. Sony owns the publishing catalog to Bob Dylan, but the labels are in the business of the exploitation of those recordings. And so UMG is in the recording business and also in the publishing business. Same thing as WMG, same thing as Sony. And then you have obviously a lot of pure play music publishing companies out there, from Primary Wave to Reservoir Music Group. So we have all these companies in the fund, okay? So if you want exposure to music royalties and you're not an LP at one of those big private equity firms that is spending all that money to buy catalogs, then you can invest in our fund and get exposure to that. Another thing I'd like to mention is that there is a premium when you are investing directly in these catalogs. There is scarcity, and that is why these valuation multiples are so high. And quite frankly, when you're an LP in one of those firms and you're paying 20x for Springsteen, that's like a 5% unlevered yield. That's not a great return. But investors like that because they're predictable, they're uncorrelated, and they have scarcity value. But you're better off investing in our fund, which has a much higher return, and you have liquidity, and music stocks are trading at a discount to all of the different private equity firms. So something I like to discuss and like to highlight, in this presentation, because everyone wants to learn more about music catalogs, and but our fund gives you exposure to all these assets. But that's what Spotify's doing. They are in the business of exploiting these rights. Live music events and ticketing is a huge part of our fund. We give investors exposure to all these different companies that are invested in this area today, from Sphere to Madison Square Garden, of course, to Live Nation, and some of the other ticketing companies like Vivid Seats. Live music is up, over 10 times from COVID. It's hard to ignore the success in the last 3 years, from Taylor Swift to Beyonce to Coldplay to Springsteen. Here are some of the huge tours. I imagine some of you attended some of these tours. And so live music is simply on fire. Super fans, are willing to pay up to whatever it is, $1,000, $1,200, $1,500 for a pair of tickets. And super fans are, dropping a lot of revenue to the music industry right now. And you look at these venues being built from Sphere, you look at all these exciting, tours that are taking place. And, our fund is giving investors exposure to live music and to everything that's happening in live music events and ticketing. So just to recap, what is MUSQ? We're a convenient way to invest in the whole music industry ecosystem. Our belief is that music will continue to expand worldwide. It's the first pure play music ETF. We have anywhere from 40 to 50 holdings in our fund. It's a really convenient way to invest in companies in the US and in the rest of the world. We're not buying ADRs. So if you want exposure to companies in South Korea, K-pop stocks in Japan and China, and so on, we're buying all the local equities in those countries. These are the different categories that you're getting exposure in, from streaming to content to live music to equipment and AI. We're obviously investing in big names like Spotify and Apple and Amazon and YouTube and all the big content companies and Live Nation. And then we're also invested in all the, companies that are making the instruments, the guitars, the consoles in the recording studios, the tools that artists are using to create new music, keyboards, and so on. So a couple minutes quickly on index methodology. So we're a passively managed fund. I built the index. The ETF tracks the performance of the index. The way this index is shaped is 80% of the companies in this fund are all pure play music companies. These are all companies that generate more than 50% of their revenues from music. 20% of the companies in the fund I call diversified or non-pure play. They generate more than 20% of their revenues from music. So companies like Spotify, Universal Music Group, Live Nation obviously are pure play. Diversified companies would be Sony, would be Apple, would be Amazon. We have to include them in the fund because after Spotify and Tencent, they're the third, fourth, fifth largest streaming companies in the world, or they're big content companies. So we do want to give investors exposure to what's happening in some of these companies that may not be pure play, but they are still big investors in the music industry. No company can have a minimum market cap less than, it's actually 200 million. We recently amended the rules. No position can be greater than 12%, and no position can be smaller than 25 bips of the fund. This fund gets rebalanced quarterly on the third Thursday of every October. No company can be smaller than no company can be smaller than $200 million in market cap, and there can't be less than 500,000 shares traded a day. And emerging markets are capped at 20%. This gives you a sense, it's a little outdated, but this gives you a sense on the index holdings. If you go to our website, musq.com or musqetf.com, you can download, obviously the fact sheet, the prospectus. You can download all the different holdings in our fund. There's also exciting videos there you should look at, and there's tons of articles there on our website. We have blogs, and I go on TV all the time. I've become sort of the public evangelist of the music industry. I've been on Fox and CNBC and Bloomberg and Forbes and so on. So anytime there's an earnings report, either on Spotify or on Live Nation or whatever, I'm out there talking about it. We have a lot of these videos on our website, but you can also just go online, and if you want to learn more, you can just listen to some of the interviews I give talking about the growth of the music industry, why MUSQ represents a compelling investment opportunity for investors, why it's exciting to diversify your portfolio with something that's totally uncorrelated to the rest of the market. And I've given dozens or many dozens of interviews in this area. These are some of our top 10 holdings today. Again, they are slightly going to change. Go to our website and download them. These are the segment weights and the areas we invest in. These are some of the countries and the weights that we invest in. Performance has been, pretty strong over the last year. We've come down over the last 2 or 3 months. Just, there are some structural things. Bill Ackman sold his shares in the fund, caused the, stock to drop a little bit. But this has been a very strong performing fund since we started. Okay. And this is a great long-term investment, we believe. And it's really just getting started because the whole industry is doubling in the next several years. So I think you want to own this now, especially that the stocks come down a little bit since our high a few months ago. Anyway, and that's a picture of me when we rang the bell. We're up on our 3rd-year anniversary. Thank you. I think there might be a few questions, and happy to answer them for the audience today.
Thank you, David. Yes, let's move into questions. First question, global recorded music revenue, David, has now grown for more than a decade, with streaming accounting for roughly 70% of the business. Now, as you look at the industry today, what do you think investors most often misunderstand about where the next phase of music industry growth is likely to come from?
Right. So I think, when you look at Spotify, I think investors are very quick to look at paid streaming subscribers, and it's been very good. I mean, revenues are up 10 to 15% if you look at the quarter, second Q2 for Spotify. And so they're looking at, paid streaming subscriber growth domestically and the emerging markets. But again, I think the industry is far beyond that right now. We're looking at monetization density. There's a super fan economy taking place. There's deep monetization of the top 2% to 3% of an artist listener base. And so that's number one. Super fans are going to drop $4 to $10 billion a year in terms of premium subscriptions, in terms of live music events and ticketing. Again, look at what they spent on these tours, from the Cowboy Carter tour to the Eras tour. Okay, so super fans are a huge boost to this music economy, number one. Number two, you have recurring price adjustments, upward price adjustments. Music streaming is now being treated as an essential utility. And we're going to see consistent price increases to track inflation. I think investors will be looking at that. And then you have simply these under-monetized territories. Music is moving heavy into the emerging markets in Latin America, in Asia, and other parts of the universe. So I think we're going to see a lot of high conversions in the emerging markets.
David, Spotify and Universal Music Group are both current MUSQ holdings, but they sit on opposite sides of the streaming economics. One controls the consumer platform, while the other controls a large body of music rights. Now, how do you think about which side of that relationship has the stronger economic leverage as streaming matures?
So I've been a music publisher, Craig, for 25 years. Owning content is like being a monopolist. It's like owning a toll road. Everyone has to come to you for permission, and you dictate price. So content owners, companies like UMG, WMG, they hold the stronger long-term economic leverage in that. Consumer tech platforms like Apple, Amazon, Spotify, they're subject to platform shifts, to churn, and distribution competition. Music rights are irreplaceable intellectual property. There's no alternative version for an artist's catalog. That's number one. Number two, major labels dictate baseline economics. They're the ones that dictate how much an artist gets paid, and they dictate the model. So labels are number one. Streaming companies are number two.
David, Spotify has also been moving to identify AI-generated artist personas and to limit their role in recommendations. Now, from an investment perspective, what would tell you that the industry has found a workable economic model for AI, one that protects copyright and artists while still creating incremental revenue?
So we're in a major transformation right now. It's so exciting what's happening in the industry with AI. At the end of the day, Craig, it comes down to consent, control, and compensation. We need to make sure that the label owners consent to the use, that they're in control of it, and that they're compensated correctly. Recently, Warner Music Group entered into an agreement with Suno, which is the fastest growing AI private company today. UMG entered into an agreement with Udio, the second AI company, and all the other labels are working toward entering into what I call two-sided licensing agreements. These are commercial partnerships where the tech companies pay explicit upstream licensing fees to labels and publishers to legally train their LLMs, their large language models. And that's really what's happening, not just with Suno and Udio, but also with OpenAI, with Anthropic. They're training their algorithms to sound like popular artists. And so what we need to do right now is set up guardrails so the labels can be compensated correctly. And if they're commercializing and creating voice twins, then the artists are getting paid. But that is happening, and the industry is working towards that.
Let's turn to the live side again, David. Live Nation and CTS Eventum are both represented in your portfolio. What makes live music economically different from recorded music? And what are the most important variables you're watching? Is it ticket volume and pricing? Is it venue ownership? Is it sponsorship, promoter margins, consumers' willingness to keep spending on experiences? Could you elaborate, please?
Right. Well, look, live music is all about the emotional connection between the fan and the artist, and there's no replacing that. Nothing can copy that. And so live music operates on an entirely different business model than recorded music. Recorded music is about highly predictable, recurring software revenue via subscriptions. Live music functions as a real estate and logistics business. And, when we look at companies like Live Nation and CTS Eventum, we look at venue ownership percentage, we look at sponsorship and advertising revenue, we look at per capita spending. But suffice to say that live music has simply been on a tear. They've been some of the best performing stocks in our fund.
David, we have time for one more question. 30 seconds, please. In your answer, MUSQ, it tracks that rules-based index that uses revenue or market position tests to determine whether a company has sufficient exposure to the music industry. And of course, the index is market cap weighted with constituent limits and quarterly rebalancing. You did mention this in your presentation. Tell us, though, what's the thinking behind the rules and how do they prevent the portfolio from becoming either too concentrated in a handful of global giants or too diluted by companies for which music is only incidental?
Right. So we back tested this product in some of the bearish markets, and the returns have simply been incredible. We think we've devised a way that represents a balanced approach to giving investors, downside protection and a lot of upside. So we put a lot of thought into the rules. I encourage you to go to musqix.com and download the methodology to get further details on how we came up with the construct. But we're giving investors global exposure to all sectors of the industry with the right weights in place to give them very good upside and to protect their downside.
Thank you very much, David. For more information about MUSQ, please visit the sponsor's website where you can access the fund's prospectus. For questions about today's conference, just reach us at RedChip, 1-800-REDCHIP, or info@redchip.com. It's 10:30 a.m. U.S. Eastern, and up next in today's Beyond the Index conference is WisdomTree. Presenting today will be Global Chief Investment Officer Jeremy Schwartz. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Jeremy, please go ahead.
Well, thanks for having me. Pleasure to be here. I'm going to share some, I have a daily update that I do on our website, this market dashboard. If you like what we're talking about here, we make it available every day with some updated numbers. I won't go through everything because it's quite a long deck, but I'll start with a brief high-level macro comment, then we'll go into the themes and areas of the market we find most interesting today. And on a day when the Treasury is announcing some bond buybacks that are supporting the fixed income market, I thought I'd start with we often talk about the Fed and the macro, but one of the charts that is relevant to things we'll talk about later on the equity premium is just where are bond yields and how have they come? Where are they today? I often talk about the nominal yields versus the real yields. So the 10-year TIPS yield is the inflation adjusted bond yield. When we compare equities and say, well, how much more, compensation to equities are for you versus bonds, we look at the TIPS yield very closely. So, right around 4.6, 2.4 are where these levels are. I mean, we go back 5 years ago, these TIPS yields were negative. You're giving the government $100 and taking, 90 cents on the dollar after inflation 10 years later. So that's kind of a crazy time in bond land. We're getting to be more normal levels. I wouldn't say these are very high returns, but they're getting to be more normal levels. And when you look at, the job that Warsh is trying to do, we'll see how much information we get at the Jackson Hole conference next week. But what you get between the Fed funds rate and the 10-year is starting to be a much more normal level. So you get a 1% premium between the 10-year and the Fed funds. If you go back the last 60 years, that was kind of a normal level. I mean, there was a time, again, just a few years ago, the Fed funds was inverted. We had a higher short-term rate than the long-term rate. That was also not a healthy environment. We wanted the Fed to be cutting rates more quickly back then. Today, you'd say it's kind of a healthy spread. Now the question is where is he going to go? How's he going to react to all the sort of supply situations, the oil price? What is the inflation trend? We've done a bunch of work that says some of the inflation is being impacted by the rental markets. We think that is a little bit cooler than the official data. But they've got a key challenge to talk about how are they going to move policy, what's guiding their decisions, and where are they going. But we think some of the data would support them staying where they are. They just need to communicate better. I think Washington needs to communicate better on what are really is the Fed looking at. So there's a lot more to come on the Fed. The key thing for the economy side, clearly you've got this battle between the conflict in the Middle East, oil prices, and AI. And so I'm going to talk a lot about where we see AI and the markets. Also for the Fed, where's the job numbers coming out? When we look on the right, the initial jobless claims you get every Thursday, that's been a very healthy range. You see no real broad-based job losses happening from this AI story. Now, the new normal job growth might be very low because of immigration, because of the demographics of our population. Powell had talked about 0 to 50,000 as being the new normal job growth. You saw sort of the 3-month moving average spike a little bit higher. You see it trend down after last month. But it's this is going to be one of those questions of where do jobs go? Is AI going to take some of the jobs? And you hear some of the companies announcing layoffs, trying to use AI as their explanation for why they're laying people off. And we often think that it's more about they had overhired, overextended, they had a lot of fat to cut, and they're using AI as the explanation. But I think this 0 to 50,000 is the new normal. And again, you don't see any real pickup on the high frequency indicators that we'll get again another number tomorrow. There is this fear out there that will you have an apocalypse in people losing their jobs? Our senior economist Jeremy Siegel put out this piece. AI is not an apocalypse. We were responding to one of the Citrini research pieces where he put out this scenario about how there could be this doom loop of people starting to use the AI, starting to cut back workers, and what would that mean for really employment, and then a negative spiral on less people being employed, less consumption, and leading to a real challenging scenario. But our view is that you're going to get higher real wages, if let's say you get enough productivity, you don't have to work 5-day work weeks. You might be able to work 4-day work weeks or 3-day work weeks because you are so much more productive. Well, a lot of people might say they want to keep working higher, and that could lead to more real wage growth. So our big picture macro view, don't be afraid of the jobs apocalypse that some people have talked about. We think it's going to lead to better real wage growth. And it's just like the history of innovation. If you go back to the 1800s, 3/4 of our workers were in farming. Today, less than 2% are farmers, yet we still export food. This is just the history of civilization, that we come up with new technologies, new innovations that allow you to do a lot more. And it's scary at the time saying, hey, we're going to be displaced. What are we going to do? But over time, we find new jobs and new places to stay occupied. We think this is going to be really no different. Now, also, it's interesting as a firm, WisdomTree made some investments in farmland. This is a chart showing that job growth has gone down from 75% of the economy to 2%. This still could be a very good investment, even if jobs aren't growing or you don't have more people going into that industry. You get very good returns off of farmland today, actually. You get a nice income rate, you get actually inflation protection, you get productivity growth from new technologies that allow the farmers to do more. Now you get some other uses of the land. So just you don't need really an expanding economic footprint to actually have very good returns. And so that's one of the things we had acquired a business called Ceres Partners last year that is helping people get access to farmland. But it's sort of an interesting comment on growth versus return that we often talk about, that you don't need expanding economic growth to have good returns. Now, I think the dynamic that scares people is just how fast innovation is accelerating. And I like this story. I picked it up from social media, but you talk about the progress in automobiles and how long it took for, let's say, if you go back to the early 1900s, we had 25 million horses in the US, and they were displaced by the automobile. How long did it take for the horses to get displaced? Well, the first steam engines were in the 1760s. It really took 150, 200 years of progress before the automobile got to a place where you had 25 million horses, then 90% plus no longer had a job. It was a long cycle of innovation before the horses were put out of business there. Then you take the more recent examples, the AI versus the machine versus humans. Chess is one of those places where you first saw the potential of the machines, and you first started seeing computerized chess 1980s, and they kept getting steady progress. And at first, the best chess players, grandmasters, would beat the machine 90% of the time, but year after year, the machines got better, and now the machine would win basically most of the time. And so it took about 40 years in chess for the machine to get better than the human. And now when you look at where the technology is going, you're seeing really fast pace of progress and innovation. So this is one of the excitements, but also creating that fear. Is our employees going to be like the horse? And we say, hey, you're not going to be replaced by somebody who knows how to drive. You'll be replaced by a horse who knows how to drive. No, you need to be at your cutting edge. If you're an employee using the tools, I encourage all my people to be using all the tools available to them. And really, in some ways, it's a great equalizer for some of the younger people who can get caught up with people with a lot of more experience. And so it's just sort of interesting how fast this pace is happening. Now, there's these questions of, is there overspending? Is the demand real? Can these hyperscalers keep up the spend? Will Anthropic and OpenAI keep spending on the chips? This was some survey data of the companies using AI. We do believe it's a real lasting trend, and we do think it's going to continue, that there's just much more demand than supply for all elements of the ecosystem. But we'd say we're in the, we do a podcast every week called Behind the Markets. In the last few weeks, we talked about where are we in the innings of companies getting margin improvement beyond, say, the true chip companies and like a NVIDIA and the whole ecosystem powering the AI. And we'd say, in a baseball analogy, you haven't even started seeing the national anthem for companies that are actually seeing true, as an economy as a whole, real margin improvement. These surveys are saying S&P 500 companies are saying, some are using 40% for revenue generation, a little bit less than 40% for cost reduction. You're seeing the productivity story. I see it personally on my team using AI, how much more we're able to do, how much more software we're able to create without even software engineers on our team. So you're seeing, we do think you're seeing measurable signs of the demand signal being real, but in terms of how it's quantifying to the bottom line, I think you're still early for the economy at large. Certainly, some companies are benefiting, but for the economy at large, still early. Now, the debate in the market every day is, can this CapEx from the hyperscalers like Microsoft, Alphabet, Amazon, Meta, with these $200 billion numbers from Amazon and Microsoft and Alphabet, a little bit less for Meta, can that continue? But then the question is, whose earnings does that CapEx become? And so this is like the sort of bottlenecks for AI, the chip designers, memory and packaging. Clearly, the big story this year has been the memory names like Micron, Hynix, and Samsung. You got the future of optics with Lumentum, Coherent, Corning, with all their roles in the optics story, the power to get all these chips up. Soon maybe the chips won't be the bottleneck, but how quickly we can get them powered up will be a key issue. And then you've got the clouds, the neo clouds, Amazon, Oracle, and the stories behind all those companies doing this compute infrastructure. One of the things we talk about, WTAI is our flagship AI fund. It owns this whole package at the bottom. So it's basically our broad AI fund that goes from the chips, the memory names, really trying to say all the spending from the hyperscalers, whose earnings does that become? And that is what our broad WTAI fund is designed to do. Now, when you listen to, where is the advancements coming and signs that it's real? I mean, actually today, and I could say this is not just an AI story, but you got excitement today in biotech with the news from Moderna and Merck having developed a vaccine that could be customized for cancer discoveries. And it was like one of the first examples of customized vaccines for cancer. I've been saying for a little while that I thought that one of the greatest places that AI is going to have an impact is biotech, that there's going to be so much drug discovery happening because when you think about what your DNA is just data. You put the DNA data through the AI machines and they're going to discover all sorts of discoveries. And the question will be, can the regulations keep up with the amount of new drugs that come to market as quickly as you ideally would like? But you're seeing all the major AI firms making big investments in this exact space, from Anthropic, OpenAI. There's new startups coming that are being funded to go after this space. It's one of the real, you could say, tangible benefits. Even when Dario, the CEO of Anthropic, was talking about, the on social media this week about AI, he talked about, when will AI develop cures for cancer? And I think that's going to be not just the hype, but it's actually going to come. These real discoveries are going to be along the way. It's one of the things that's exciting about AI. And I'd say for the chips and all these other places, I think the next wave is physical AI, and you're seeing all this with humanoids and drones, and robotics. And this is definitely, I think, when Jensen started talking about the growth that he gets from hyperscalers buying their chips, this is really, one of the next big waves of where is that demand for the chips and infrastructure going to come from is, when will you have the ChatGPT moment for humanoids and drones? I think you're seeing, in some ways, the drone case with the war in Ukraine and from Iran using drones for their attacks. I think the amount of spending we're going to be doing on this type of technology is really being, you could say from the war standpoint, very clear that the drones are a key feature of what's happening. But it broadens out from that kind of military application to the consumer application. You just saw this week, Uber announced a big partnership with Zipline. Zipline is one of these drone delivery companies. And I think you're just going to see more of the defense technologies coming to consumer applications. This is going to be one of those next phases of taking the AI story forward. We launched an ETF, WDRN, for physical AI, humanoids, and drones. That's really the going beyond a broad AI fund to this sort of physical AI fund. We think this is the future, the next phase of what's going to drive AI forward, and we think there's a lot of potential behind all that. Now, the hyperscalers are being debated, and I think the question of all this compute they're building out, will there be demand for the compute, all that CapEx coming back to that I started of what's driving all those stocks. We wrote this piece called the SPR of compute, that if you have a conflict in Asia, we have the tensions with Russia, Ukraine, and Iran in the Middle East today. There's fears about Asia and in China and Taiwan, and what's going to happen with that potential conflict in the future. And if there is a real conflict in Taiwan, the compute that's in the ground that all these companies have been building becomes much more in demand and much more valuable. It's sort of like they have an SPR, the Strategic Petroleum Reserve of compute. And there's this whole debate on what is the depreciation schedule of these chips and the compute that people put into ground. What you're finding is a lot of these chips are still appreciating in value far beyond what people thought, that old chips are still being used, and even the cost of these chips are still going up. So largely, it's a thesis that we think the spend is going to continue and the demand is real, and that they now have this big infrastructure. You're seeing companies like SpaceX sell their compute. There's talks of will Meta sell some of their compute, but they have an installed base that they can sell out because it's so in demand that there's prices going up on all that. Now, Meta is one of these battleground stocks that people, again, are fearful of the spending that they've been doing on their $150 billion of CapEx. We've pointed this company as one that we would say the AI spending is paying off. This was from a few earnings calls ago where they talked about, if you think about Meta, they have a pretty simple business model. It's time on their platform, serving better ads, and they got people to spend more time on Facebook. They saw a 14% ads quality bump, and it's leading to better revenue growth. And so their revenue growth actually keeps going at fairly good levels, and it's just this fear about their spending on CapEx for AI that's causing the stock a bunch of trouble. But it's now at one of its lowest valuations in a very long time. It's one of the stocks we think is being unfairly punished for its spending, and we think the spending is real and actually paying off in their own results. So that's just sort of an interesting example of, again, for people questioning the spend from the hyperscalers, we think it's justified. I'm going to talk about just a few quick market level conversations and how we think about a few other places beyond those thematics. We talked about WTI, WDRN for the drones and physical. This is our S&P 500 P ratio, 21 times earnings. It's when we talk about long-term fair value, we often say 20 is our long-term equilibrium PE on the S&P. So it's not dramatically more expensive. You go back to the 2000 tech bubble, we got to 30 times earnings. And we think about rates going higher today. The TIPS yields got as high as 4% when we had this 30 PE. So it's not really I would say dramatically overvalued. The tech sector, because of the really, really strong earnings growth this year, I mean, you were over 30 PE on this sort of what we call the expanded tech sector that includes companies like Amazon and Tesla that are in the consumer discretionary sector, Meta and Alphabet, which are in the communication sector. This expanded tech, 24 PE, it's very close to its 30-year median. It's nothing like tech in 2000 when you got to 60 times forward. So a lot of people worry about a tech bubble, and we say it's nothing like tech of 2000, where you did have real extreme valuations. They're kind of, we'd say, deserve valuations at this 24 PE. You could question, will the earnings growth sustain? Every company's got its own idiosyncratic risk, but it's not this massive bubble that we saw back in 2000. Outside of tech, you're below the 20 times that we say is fair value, so 18.5 times. It's a little bit above the median, but below the one standard deviation above number. So, real reasonable prices beyond that, the tech sector, which was 24 times. And so, we say there's no real overvaluation there. And for that equity premium that I teased to start with comparing bond yields, there's a lot of people who say, with that 20 PE, a 5% earnings yield, we have zero equity premium. The Wall Street Journal did a piece. There's zero equity premium because of where bond yields were and where the earnings yield was. And we really just say that's the wrong way to look at it. You've got to compare it to TIPS yields, long-term data. Stocks are real assets, earnings and dividends grow with inflation over time. And so, this chart on the left, yes, the number is below where it's been the last 20 years because bonds were such a bad deal and stocks were very cheap for a lot of the last 20 years. Now we're getting closer to fair value on stocks at 20 PE, and bond yields are normalizing. And so at 230, yes, it's below where it was, half of the levels of where it was the last 20 years. But still, this rule of 72, it'll take you 30 years to double your purchasing power with TIPS, that 2.4% yield, 30 years exactly. With stocks, it's 14 to 15 years for the S&P if you assume earnings growth is on par with historical at a 5% earnings yield. And that's a real forward-looking return, we think. And so you still double your money twice as fast as in bonds. So yes, bonds are more normal, but we wouldn't be rushing to bonds for the return, maybe for defensive nature of it, but not some attractive return. And the environment for stocks is good when you look at the earnings growth. It's been one of the record seasons for earnings outside of a real recession bounce back. You've had very, very strong earnings growth that is supporting this market. Now, on the big stocks, there's a number of these that we would argue have become real value stocks. When you think about the Mag 7, a lot of people in the last 15, 20 years, all you had to do was be in tech. But there's definitely more differentiation today. There's only one of these Mag 7 names that has a multiple that was what caused fear in 2000 of the tech bubble. Tesla's at 164 PE. It's certainly not about its business in the car business. It's really a look for self-driving, for humanoids, the robotics, that physical AI story that we talked about, that people are excited about its long-term future there. But Meta at below 20 times is less than the market multiple. So we would say this is one of the more classic value stocks. Nvidia at 22 times, based on its historical earnings, its estimated earnings growth, we'd say this is a classic value stock. Apple, I'd be more cautious on it. 34 times, it's at a decent premium. It's actually the most expensive outside of Tesla, with one of the slower growth profiles. So it's one that in some of our committees we've downweighted Apple. We've leaned into Meta and Nvidia for some of their value opportunities, and even Microsoft at sort of mid-20s is we'd say is sort of a more reasonable price than some of these other stocks as well. So it's sort of interesting the bifurcation we're getting in among the Mag 7. We talked about thematics and WTI and drones. Our sort of flagship growth fund is QGRW. It launched at the end of 2022 in the bear market for tech, and it's had a very strong run. If you look at the different index providers, how they classify growth and value, there's been a huge spread between the traditional growth indexes and QGRW. So I'd encourage you to look at this. It goes up against the NASDAQ and then the other traditional S&P and Russell growth indexes. It screens for profitability and growth. And because it does that, it has some of these higher sort of forward-looking and historical growth rates. And it has a lot of the same companies as the NASDAQ in the top holdings, but the companies that they hold that we don't hold tend to be slower growers. They just happen to be listed on the NASDAQ. They're not true growth companies. The companies that are unique to our basket in QGRW are the faster growing stocks. So I'd encourage you to check out that, particularly versus traditional growth indexes like the Russell Growth. There's been big deviations in some of that. And then I'm going to close on sort of one maybe more value-centric idea. I mentioned we thought NVIDIA and Meta were two of our what we call more value stocks today. Our favorite value strategy at the moment is WTV. It's a US value fund. It focuses on dividends and buybacks in particular. And when you look at the S&P 500, it's got about a 2% dividend buyback yield. The S&P Value Index has a 3.5% dividend buyback yield. This one focusing on high conviction buybacks is over 6%, which I think is a really attractive number. When I look at our data on long-term returns for stocks, they did 6 to 7% after inflation over very long periods of time. If you get 6% just from buybacks, and dividends today, that's a lot of your long-term real return. You don't need a lot of real growth on top of it. So I think this has been one of our favorite barbells with that quality growth strategy, QGRW I just talked about. WTV and QGRW as a better core is one of the things we talk a lot about. Maybe I'll pause. I know we're running up on time here, so maybe I'll stop the formal presentation here.
Jeremy, thank you very much for that. And since you ended up by talking about WTV, I want to use one of our participants' questions about that one. It produces a definition of value, WTV, that may surprise investors. NVIDIA is currently its largest holding, and Zoom, Salesforce, and Netflix are also among its top positions. What does shareholder yield capture that conventional price to book or low PE definitions of value can miss? And why can a company commonly labeled a growth stock qualify under that framework?
Yeah, it's interesting. I mean, there's a lot of, you have to really drill into people's index methodologies to see how they get to some of their holdings. I mean, the S&P 500 value, I showed Tesla as one of the most expensive stocks in the market, yet it's actually a top 10 holding in the S&P value index, because if they have a slow enough growth rate, they're not pure growth by their definition, and then they get some weight in the value benchmarks. We are trying to find the cheapest stocks in the market with also some quality filters as well. And dividends and buybacks are our primary screening tool. But also, it's an active fund, so we have some flexibility in what gets included. But it's, the average PE on our basket, instead of something like 18 for the S&P value, we're at 12 to 13. These are much cheaper stocks, and that average buyback yield and dividend yield combines over 6%, basically 2 to 3 times the level in the S&P 500. So we're definitely buying stocks discounted by the market. We like that the companies are buying back their own stock. They think they're sort of investing with their money, that they think the stock is cheap. And so that's one of our flagship value funds today, been one of the sort of top performers in the value category.
Jeremy, our time is up. Thank you very much for your segment. For additional information about WisdomTree and its funds, please visit the sponsor's website, where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or at info@redchip.com.
Thank you.
Up next in today's Beyond the Index conference is YieldMax. Presenting today will be strategist Mike Khouw. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Mike, please go ahead.
Thanks very much, Craig. So, I wanted to talk in the theme of the Beyond the Index, the next generation of ETF investing, not just about a couple of funds of ours that I think provide examples, and I'm actually going to use some stuff that's going on today that I think is also relevant, but from my perspective, when I think about what ETFs offer to investors now, it's not just about getting exposure to an industry, to a sector, to a theme in the form of something that trades easily as a stock does, but also so that we can get access to investment styles and asset classes that were previously unavailable and probably more in the realm of hedge fund investing. And so YieldMax funds, for those that don't know, we focus on options overlay strategies to generate distributable income. And the examples I'm going to be using today are probably relevant just because a lot of people have been following them anyway, the semiconductor space. And we have two that focus on this. One is called CHIPY, CHPY, and the other is SOXY, SOXY. The principal distinction between these two in terms of the strategy style is not the underpinning stocks, which I'll go into a little bit, but actually the approach to how rapidly and aggressively they make distributions. Okay, so let me just advance here. We'll just talk a little bit about who these funds are for, and then I'm going to go into the strategy a little bit more in depth and actually provide some real world examples because we have some that are going on today with the news that's coming out of Moderna that might be kind of interesting. We'll talk a little bit about the risk and volatility profile for these respective funds and for the strategies generally, the nature of how these portfolios are put together. We can talk a little bit about the total returns for these funds and some other sector-based ETFs that don't trade options, so we can sort of compare them side by side and see what the impact of doing options overlay strategies
Hi,
can
Mike.
be. Yeah.
Mike, I'm terribly sorry to interrupt your presentation, but the screen, you're not sharing your screen at the moment. Can we take a moment to
Oh, I
set
thought
up
I
your
was sharing
screen?
it.
Yeah,
Thank
I
you
know.
very much for bringing that up because I'd started to share earlier, but when I joined the
It's a quirk of
webinar,
Zoom.
it must have dropped.
It's right. It's a quirk of Zoom that you can set up backstage and then it doesn't transfer
Hopefully,
over. So
hopefully you're seeing it now.
We see it. Thank you very
Excellent.
much. Please continue.
It would have been a very difficult presentation if nobody could see what I was talking about. As much as I like to hear the sound of my own voice and have people stare at me the whole time, I'm glad that we actually will get to talk about this. Okay, so we're going to be talking about CHIPY and SOXY. We're going to be talking about our approach to generating options income in these funds, which is selling covered call spreads, which is a variation of selling covered calls. And that it's an important distinction, and we're going to talk about and look at some real world examples for how that impacts the results. The risk and volatility profile, how these portfolios are constructed, some of the performance over the course of the past year or so, and some of the key takeaways. Okay, so who these funds are for? We would say that they are generally for investors who seek income. Once upon a time, that was one of the principal reasons to invest. People bought bonds to collect coupons. Certainly in the pre-World War II era, people frequently would buy stocks to collect dividends. More recently, of course, capital appreciation has sort of been the name of the game, but we believe that there's a lot of investors, and some of the fund flows that we've been seeing back this up are very interested in collecting income off of their investments. And in many cases, they're looking to collect substantially more in terms of regular distributions than conventional investments can provide. The two funds I'm going to be highlighting in this particular case, SOXY and CHIPY, they are, as their names suggest, based on semiconductors. So thematically, these are for people who are desiring exposure to that sector, but are also looking for the options income. But just so everybody is aware, we offer over 60 ETFs that have options income. So we have a lot of different themes, including these, but I think this is probably a good place to start. And one of the reasons I think it is because this has obviously been one of the best performing areas of the market over the past couple of years. And one of the concerns some investors may have when they are doing options overlay strategies is, am I giving up some of my potential gains by doing so? And we also want to talk a little bit about risk-adjusted returns. So when we think about options income ETFs, we really have to make sure that we're comparing like for like. So if a fund pays substantial distributions, we obviously want to take a look at total returns. We need to take a look at both the appreciation of the underlying shares, if there is any, and also the distributions when we're comparing it with similar themed investments that don't pay distributions, and taking a look at things like the volatility of those investments and also the drawdowns that you might see. So in these funds and in all of our funds, the idea is that we own the underlying shares in those cases where the fund can do so. There are some funds that we have where you're not able to do that because of the RIC rules that are for ETFs. So in those cases, we'll own a proxy for a stock. So you can get a proxy by purchasing a call and selling a put of the same strike and expiration out into the future. Essentially, you're getting into kind of a forward, if you will, but you can get synthetic exposure to the common that way. But in Chippy and Soxy, we own the underlying stocks. So there's no synthetic exposure in these funds. And then we sell covered call spreads. So we sell a call above the current stock price, and then we buy a higher strike call above that. The logic for doing this is that we're looking to collect some balance of income from the options overlay strategy while not formally capping the upside the way a conventional covered call would. And the performance characteristics of these funds will bear out how that actually makes a very big difference in the real world. So one of the things that ends up happening, generally speaking, when you own stocks and you sell options against them, because you're getting a modest tailwind from the continuous collection of options decay or options premium through the course of time, is that the volatility profile of strategies that do this tend to be a little bit lower than simply owning the stocks would be. So for comparison, in this particular example, just looking over the past year, I updated this information this morning. You can see here that Chippy has just under 35% of volatility on average over the course of the last year. Soxy, which is our target 12, so a very similar basket in terms of the underlying stocks, but the distinction is it's paying slightly less frequent and not as large distributions. We target a 1% distribution per month in that one, compared to SMH, which is very well known, I think, and the SOX, which has the highest volatility. So the portfolio construction for these is very similar to those other two ETFs that I just mentioned. One of the differences is that the concentration tends not to be quite as high in these. So if we're just taking a look at those constituents of the portfolio that are greater than 5% weight, and in both cases, the largest for Soxy and Chippy are just over 6%, but there's only 4 stocks actually in either of these that are 5% or greater. You can see that the concentration is substantially lower in Soxy and Chippy than it is in the SOX index, where it's 38.3%. And in SMH, the VanEck Semiconductor Holders ETF, where it's 53.5%. SMH, I believe, rebalances on a quarterly basis. One of the things that can cause big concentration, of course, is actually a good thing, which is you can purchase a stock. That stock can appreciate materially, and as it does so, its concentration can increase, in between rebalance periods, such as the case for SMH, where its largest holding now, I think, exceeds the 20%, which is what on their prospectus they have is the cap. So for us in the Soxy portfolio, NVIDIA is our largest holding, AMD, ASML, Marvell, all about 5%. The remaining 24 stocks, and so there's a lot of crossover between all of these portfolios, as you might imagine, is as low as 1.6% for the smallest constituent and as high as 4.75% for the largest constituent, not among these top 4. So taking a look now at the distribution track record. So what we're taking a look at here is assuming that you owned Chippy over the course of the last year, and you had simply taken the distributions. This is making no assumptions at all about reinvestment returns. You would have gotten 50% net cash distributions in Chippy, 16.75% in Soxy. Now, quick point about that. Soxy is what we call a target 12. So a target 12 is one of the funds that we have where we target paying out a distribution rate of approximately 1% per month. But of course, if the underlying shares are appreciating materially through the course of time, 1% of a larger number, larger monthly distribution. So the target distribution rate at the beginning of the period was 12%, but it ended up being 16.75%, in large part because of the appreciation of the underlying portfolio. As most people watching are certainly aware, the semiconductors don't typically pay big dividends, so the distribution rate for both SOX and SMH was about 40 basis points. NVIDIA pays a very modest dividend, but it's a large constituent, so that probably is a meaningful contributor there. So just taking a look at the strategy objectives at a glance, when we are trying to think about what the objective of these funds, all of our funds really, is, and that is that we're looking to capture some measure of upside participation, typically 70 to 80% is what we're hoping to capture in terms of the upside participation. I have a real world example that I'm going to be showing you from today, which I think is kind of interesting on this. We're looking for slightly reduced volatility. As I previously indicated, when you consistently sell options premium against your equity positions, that creates a little bit of a tailwind and will tend to mute the volatility. Some volatility reduction isn't necessarily a good thing. So if you cap your upside volatility, sort of the distinction, if you will, between a Sharpe ratio and a Sortino ratio, that's not necessarily a positive. But what I will show is that actually the total returns and the total volatility stacks up quite favorably, even net of this. We're looking to achieve over the course of, through an entire cycle of comparable total returns for the options overlay strategy versus the straight equity portfolio. And then, of course, as the name would suggest, we're looking for substantial distributions. Okay, so here are a couple quick things, and I'm going to show the examples of this. Over the course of the last year, Chippy and Soxy actually were able to deliver lower volatility and higher total returns than SMH, and considerably lower volatility than SOX, which is the highest volatility of the four examples that I'm providing here, with about, with better than 80% of the total returns. The portfolio construction, as I previously mentioned, a little bit more balanced in these. That can work for or against you, depending. But of course, you have a little bit less idiosyncratic risk if the portfolio's construction is such that you don't have really substantial concentration in single constituents. The distribution profiles are obviously much higher. In this particular example, of course, we're looking at underlying comparisons where there isn't really much of a distribution at all. And the mechanism is a fairly straightforward one. So now what I'd like to do is I'm just going to switch over at this point to talk about a little bit more concrete examples, because when you start talking about option strategies, it's easy, I think, to lose people. So we have two examples that I think are illustrative of how this works, and I'm going to use NVIDIA as my example in this case. So as it happens, we have positions, we have a target fund in NVIDIA, and we also have sort of a max distribution strategy, so NVIDIA and INVIT. And what I want to do here is just illustrate. Now, you'll notice that this only goes back to, hopefully you can see this, December 10th of this year. The reason that this only goes back to December 10th is because this one here, the INVIT strategy, which is the target NVIDIA strategy, that actually only launched in mid-November. So I can only capture a 30-day realized volatility number beginning in mid-December, because of course you have to have a look back period. But one of the things you can quickly see here, and I'll try to highlight this, this is the 30-day volatility for NVIDIA. And this is for NVIDIA, which is basically a yield maximizing options income strategy. And this is a target options income strategy. All of these are tradable instruments. So you can buy NVIDIA, you can buy INVIT, you can buy NVIDIA, could buy, obviously, the semiconductor strategies. But I thought it would be easier to understand what's actually going on underneath the hood if you can take a look at it on a stock by stock basis. So, and this, I think, NVIDIA being arguably the best understood in the space. And you can see that the volatility for the options income overlay strategies is substantially lower. And that's fine. People like lower volatility. But what also matters is how your total returns stack up. Now, in this case, I'm just going to point this out as well. This goes back now to mid-November. So this is the total returns since the inception of the Target 25 in NVIDIA. So again, just as a reminder, we have substantially lower volatility, realized volatility in these products. But look at the total returns. So the total returns for the Target 25 NVIDIA strategy, 21.8% since inception, 21.26% for NVIDIA, which is our yield maximizing options income overlay strategy on NVIDIA, versus 20.1 in NVIDIA itself. So we have much lower volatility, but we have comparable, actually slightly better total returns. Now, I want to also point out that if you're looking at, and this is a mistake that I think a lot of people tend to make, is that when you have a strategy that pays out big distributions, people often, the first thing almost anybody does is pull up a price chart, certainly with an ETF. And what you're going to see is that the share price of NVIDIA is lower, but the total returns are still better than the underlying stock. And that is simply because the distribution that has been paid in NVIDIA since November 18th is, about 35% of the initial investment. So, whether one strategy appeals more than the other, and I think this speaks sort of to the trend in the industry generally, is that what we have seen is that investors are flocking more to those strategies that pay higher distribution rates. When they're offered an alternative, we're seeing more money flow into the higher distribution rates. Now, think about it this way. In some ways, that makes some sense because it gives an investor greater flexibility. You can always take a distribution and reinvest it. So that flexibility essentially lies in the hand then of the investor in those cases. And, to also illustrate how these strategies can perform when a stock really takes off versus a covered call. So if you sell a covered call, you own the underlying stock, you sell an upside call, you collect a bit of premium for that. The downside of the strategy, of course, is that if the stock really takes off, your upside participation is capped at the difference between the current stock price, the short strike, and the premium that you collected for selling that call option. But if you sell a call spread, you're sacrificing some of the upside, and that helps in those circumstances where the stock does not go above that strike. But in those rare instances where a stock really moves very sharply, you're not sacrificing all the gains. And it just so happens that today we have a really good example of this. So Moderna, for those who are following it, you may know, made a huge move today. So just for people who are wondering why that is, maybe because you're participating in this Red Chip event, and I'm glad that you are, you might not have seen this big melanoma study and the Merck was the other one that had a really, really big move. Positive results, and the stock is up quite sharply. Now, as it happens, we have positions in other funds in Moderna that implement this exact same strategy. So Moderna is up 120% in round numbers, and our positions in this are up nearly as much, 111% in Mirni, for example. And this makes a really big difference, of course. And what you're really capitalizing on when you implement a strategy like this is the fact that options are frequently priced as if the underlying stock's behavior, their price behavior, is normally distributed. And I'm sure a lot of you who are watching this are familiar with this concept. But of course, most people realize that returns tend to be fat-tailed. You end up having an excess. This is leptokurtic. This is a leptokurtic distribution, meaning what does that mean? Just a fancy statistical term that is alluding to the fact that in general, you have more modest moves concentrated around the mean than a normal distribution would predict, and you have these fat tails. Sharp moves to the downside may happen with greater frequency, or in this example, sharp moves to the upside may happen with greater frequency. So if you sell a call option over here, just make a little box right there. So if you sold a call option at, say, that level, 3% out of the money that expired in a week or two, you will end up making money most of the time. That will be a trade that works out for you more often than it doesn't. But that does not necessarily mean that its expected value is a positive one for your investments, because you may end up sacrificing these rare instances where the gains were so substantial. That's basically the benefit of optionality. So by selling a call spread, what you're doing is you're shorting this one and buying one over here. So you will be able to capitalize on the benefits of options income without necessarily sacrificing a huge amount in those rare instances where the underlying stock really takes off. So with that, having provided some more concrete examples, I thought this might be a decent time for me to pause, because I see that my time has only 7 minutes remaining. If there's some questions, I'd be happy to take them.
And there are, Mike. When you look at implied volatility, realized volatility, and the dispersion between individual stocks today, where are you finding the most attractive opportunities to sell option premium?
It's a great question. Well, first of all, there's some things embedded in your question which some of the people who are in the audience might have been paying attention to. The dispersion point, let's start with that last part. So for non-options traders who might be in the audience, when options traders talk about dispersion or correlation, most frequently what we're talking about is the relationship between the volatilities, the implied volatilities, that is the price of options on single stocks relative to the price of options on indices of which those stocks might be constituents, right? So you can imagine, let's come up with a relatively simple example. If I had a portfolio that had only 2 stocks in it, and I'm using these 2 to diversify my positions. Not that 2 stocks really diversifies much of anything, but it could if one was anti-correlated with the other, right? So if I buy 2 investments and one is anti-correlated and they're equal weight, both could have volatilities of, call it 30%, but the volatility of my basket might actually be close to 0, because when one rises by 1%, the other falls by 1%, and vice versa. So when options traders talk about dispersion, really they're talking about how dispersed the returns of the constituents of a basket are relative to one another. And we talk about that relationship in terms of implied correlation. And implied correlation actually had gotten very, very low this year, as low as I'd seen it, well, pretty much as low as I've seen it in my professional life. We started trading dispersion, which is long constituent vol, short index vol, back in the late 1990s. A number of other options trading firms would do this. And that attractiveness is diminished considerably when index volatility falls sharply. And actually, if we look at something, what's a good way to think about this? If you see that the VIX index, for example, is falling to a low level, while you simultaneously observe that the implied volatility of, say, the top 50 stocks in the S&P remains essentially where it was or elevated. Effectively, what you're seeing is this effect, that the implied correlation has fallen. And that makes selling single stock volatility more appealing on a relative basis. Now, I'm simplifying this quite considerably because these are path dependent issues. In other words, you're always looking at the price of options where they sit right now relative to the stock price of the underlying assets. And the volatility surface of individual stocks and the index itself is not flat. So all of these things change with the course of time. But the volatility risk premium is a pretty persistent phenomena. It's well documented in the literature. And I think the total returns that we've been seeing back up the idea that you can sell some measure of options against underlying assets that you may hold. It could be stocks, it could be other things too, and end up with favorable total return characteristics.
Mike, YieldMax began with strategies tied to individual companies, but the lineup now ranges from single stock funds to sector portfolios, broad multi-stock strategies, and funds of funds. What have you learned about where a single stock option strategy works differently from applying the same basic concept across a diversified portfolio?
So I think one of the things that we've just illustrated, the example that I provided in the single stock of INVIT, NVIDIA, and NVIDIA, which are, so INVIT and NVIDIA are single stock strategies that sell call spreads against NVIDIA, and SOXY Chippy versus SMH and SOX, is that essentially the benefits that you can see in single stock do translate into a broader portfolio. Now, I would like to make one interesting point about this, and that is that it sounds like there is no such thing as a free lunch, right? So we need to put that front and center. If the underlying stocks are all going up from the lower left to the upper right, and always running through the short strike and through the long strike, we will capture 70 to 80% of the upside. We will still be able to pay nice distributions, but that is a circumstance where you'd much rather be long the underlying. A simple way to think of this is that if a stock goes straight up, you'd much rather be long a call than short one. Even if you're short one, long another, it would have just simply been better to be long the upside. So it's not like you get outperformance in every possible circumstance, but you will outperform when a stock goes lower. You will outperform when a stock goes sideways. And by selling covered call spreads rather than selling covered calls, you still get meaningful participation to the upside. So, in products like Biggie, which is our top 50 by market cap, and in some other places, we're getting very comparable total returns, to the underlying portfolio of equities while still paying handsome distributions. So, I think in general, it's working out quite well. Won't in every single case, but in general, you do get to capture the volatility risk premium, and that's a positive for investors.
Mike Khouw, thank you very much for an excellent presentation. For additional information about YieldMax and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Founders 100 ETF. Presenting today will be partner and portfolio manager Michael Monahan. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Michael, please go ahead.
Thanks, Craig. It's great to be here. Welcome everybody. Appreciate you tuning in. I'm Michael Monahan. I'm the founder and portfolio manager at the Founders 100 ETF. In the Founders 100 ETF, ticker FFF, we own the 100 best founder-led companies. And the question we ask you as you look at your portfolio is, do you own enough founders? Most portfolios are missing the efficacy of the founder factor. What do we mean by the founder factor? We looked at 11,000 stocks over 30 years and found that founders outperform by about 4% CAGR. Outside consultants such as Bain have also looked at long periods in the stock market. Bain looked at the S&P 500 over 25 years and found that the founder-led companies outperformed the broader market by 3.1x. So a lot of efficacy in owning the founders. We built an entire strategy around this. And the reason we did that is most investors have very limited exposure to founders, which is unfortunate for their portfolio because this founder factor is so strong in helping portfolio performance. We looked at the 300 largest ETFs, and in general, they have less than 20% founders. Specifically, the S&P 500 has 15% founders, and the QQQs have 20% founders. So if you want to take advantage of the outperformance that founders have historically brought to the stock price performance, FFF, or the Founders 100, is a pure play on doing this. So how do we build a portfolio? How do we select stocks? We build the portfolio by looking at the 200 largest founder-led companies in the stock market. At any one time over the last 30 years, there's been about 800 to 1,000. We look at the 200 largest, and from that, we run a factor model that picks what we believe to be the 100 best, and then using a modified market cap weighting, build a portfolio to own those stocks. So the types of companies that we own in the portfolio would be the dynamic founders that you follow every day. Palantir is a top holding, NVIDIA, Dell, Meta, CrowdStrike, Oracle, Shopify, Blackstone, BlackRock, Salesforce. So these are the types of names that are in the portfolio: highest growth, highest innovation. Going back to the outperformance, we're often asked, Michael, what makes founders different? Why are founders delivering 3 times the stock price performance of non-founders? Founders bring very interesting attributes. They're visionaries, they execute, and to borrow Jensen's word, they have grit to push their companies forward, and they have the moral authority to pivot and change if need be. In addition to the efficacy of the founder factor, when it comes to managing the portfolio, we want to introduce you to the team behind it. We're not a nameless, faceless organization like some of the mega managers. I'm Michael Monahan. This is the 3rd act of my life. Act 1, I had a long traditional Wall Street career starting at Goldman Sachs, Carlyle, Riverstone, and Sanford Bernstein. My partner, Lauren Cassidy, was a Sanford Bernstein analyst. She was on the #1 ranked consumer finance team at Sanford Bernstein, and then went on to run money both in the long-short world at Cantillon, and then for the last decade, she was the lead portfolio manager of $20 billion of capital at a value manager. So the team behind this has had a long career in managing money and really thought through how to build the best possible portfolio for you. The question we often get asked is what inspired to build this company? And I think it's important for people to understand why this is aligned with the American ideal. We were actually in Washington, D.C. 2 years ago for a friend's celebration. We went to the Smithsonian, and I would encourage everyone on here, if you've never seen the Fort McHenry flag, It's on display at the Smithsonian. I think it's important that you go see it. It's the flag that was flown above Baltimore during the War of 1812. The Brits were shelling the fort didn't fall. And we've put up this giant flag, and it's what inspired Francis Scott Key to write the Star-Spangled Banner. And it inspired us to ask the question of the people that built America were different. These were iconoclasts. And given the 25 years that Lauren and I have been investing markets, we looked at each other and we said, what if we built a portfolio of only iconoclasts? And founders are iconoclasts. And after we went back and did 4 months of very dedicated research, the data to analyze founder-based investing, it doesn't exist. There's no Bloomberg data set on this. There's no FactSet data set on it. So we spent the 4 months digging through 30 years of historical filings to build it. And when we did that, we found that on average, the founder-led companies outperform. And we wanted to take advantage of the same spirit that built America and use that to build a portfolio that you can invest in and hopefully give you the highest risk-adjusted compounding for your portfolio. So we think this is a great portfolio if you're seeking long-term capital appreciation over a 5-year horizon. If you can tolerate some swings in the market, we do certainly have drawdowns. These are typically high growth companies, but it gives you the opportunity to take advantage of founder vision, leadership, and innovation. And we also know that investors and advisors have concerns about being over-concentrated in the S&P 500 and the NASDAQ 100. And our portfolio has 80% active share to the S&P 500. What that means is that our portfolio is 80% different by market cap than the S&P 500. So if you put this in your portfolio, you're getting a truly innovative and truly differentiated product. Now, with that, I know that the hosts had some questions, and I know that the viewers have some questions. So one of the things that we think is really important about this strategy is it's very easy to understand. We encourage everyone listening today, buy things that are easy to understand. Easy to understand has the greatest probability of success. So we're very long-term investors. So you won't hear me talking much about near-term catalysts. We built a strategy that allows you to invest without worrying about any of those things. FFF is meant to be dollar cost averaged into your portfolio over very long periods of time. So whatever your investment style is, per week, per month, per quarter, this is a buy, hold forever, and compound strategy. My partner and I are both very large investors in this. I personally seeded the fund with my capital. I anticipate most of my liquid net worth to remain in it. We're big believers in it. We built something that we really believed in. We wanted to invest for ourselves. And then we opened it up to outside investors to invest alongside with us. So with that, I will bring it to a close. We think it's simple. We hope we've identified why it's simple. And then we'd love to answer some of the questions from the moderators and the people watching today.
Absolutely, Michael. First question here, founder-led companies, they are found disproportionately in areas like technology, software, and other growth industries. What convinces you that founder leadership itself is an investable characteristic rather than simply a proxy for owning innovative growth companies?
That's a great question, and we'd give a light pushback and light adjustment. It's not just found in technology. We own 10 of the 11 GICS categories. The only GICS category we don't own is utilities, and I suspect with this bottleneck in energy, there will be a founder-led utility company soon. So we own all 10 GICS categories. I just interviewed Ron Mittelstadt from Waste Connections 2 weeks ago. So in industries as basic as picking up your garbage, there are founder-led companies. There are founders driving beverage companies like Monster Beverage, and there are founders driving consumer finance companies like Rich Fairbank at Capital One. So founders lead companies all across the economy, and it's not just in technology, although certainly given the changes in technology, these do tend to be led by founders.
Michael, once a company qualifies as founder-led, what fundamental factors, for example, cash generation, balance sheet strength, competitive positioning, valuation, or anything else, matter most in deciding whether it actually deserves a place in the portfolio?
Really good question, and it gets at how is the portfolio constructed? Why don't we go through how the Founders 100 portfolio is constructed? As I mentioned, we looked at 11,000 stocks over 30 years. So every quarter, we look at all of the US listed stocks. From there, we identify which of those stocks are founder-led. At any one time in the stock market over the last 30 years, there's been about 800 to 1,000 founder-led companies. We then identify the 200 largest by market cap founder-led companies. And then I mentioned that both my partner and I came from Sanford Bernstein, and we apply some of the principles around factor-based investing. We take our fundamental view of the world, we turn it into factors based on cash generation, price to earnings, balance sheet quality, other quality metrics, and we run a factor model screen on top of that. So we take the 200 largest, and then what we get is what we believe are the 100 best. And to explain it easily for our listeners, it's not so much as selecting in, it's almost selecting out. So imagine a pizza analogy. We believe that all of our pizza chefs, we don't care what type of pizza they're cooking. We just want to check for burnt crust. So really what the factor model does, it looks for companies that could be problematic and then moves them out of the portfolio. What we've done is basically created a factory. And one of the things it says, if you as a founder have the vision, the grit, the execution, the understanding of what your customers want, and the ability to build the distribution channels to bring it to them at scale, all of that from 0 to 1, seed stage, A, B, C, D, E, going public, surviving the public markets, that tells us that you have the factor to build a great company. And so that's the positive signal that comes from founders. And then we run the factor model just to make sure that there's no burnt pizza crust showing up. And if there is burnt pizza crust showing up, we'll slide that company out at a quarterly rebalance and bring the next company in.
Michael, the portfolio today has a substantial cluster around artificial intelligence with Palantir, Dell, NVIDIA, Meta, and Oracle among its largest positions. Do you view AI as one investment theme here, or are there very different economics and competitive advantages across the semiconductor infrastructure, cloud, and software layers of that ecosystem?
Another really thoughtful question that I think will help today's viewers think about investing. We view it not as a monolith, but each one of those areas is its own separate investment area. The hyperscalers are much different than, say, the high intellectual property semiconductors like a NVIDIA or a Cerebras. And then you have the memory stocks that have typically been cyclical. Then you have the cohesion and ontology layers like Palantir. And then you have the SaaS layer that is going to have some of the agentic workflows and be the trusted tie into the enterprise. So we see each one of those layers having a different differentiation, a different value proposition. And so we don't view it as a monolith.
Palantir, currently the fund's largest holding. Company has reported very rapid growth in both its U.S. and commercial government businesses this year. What is the core investment thesis for Palantir today? And what evidence would tell you that adoption of its AI platform is proving more cyclical or less durable than you expect?
I think that durability question is really important. We'll talk about it for Palantir, but I think it's worth bringing up in general. And that is the founder factor is durable over very long periods of time. So it's not something that's in a specific sector or a specific time period. There's academic research going back to the 80s talking about how founders bring this durability to the way they build and manage their companies. On Palantir specifically, I think this is another good example of how long-term investing, that is buy and hold, is critical. It gave us an opportunity to buy Palantir when we launched the fund. Palantir, obviously a very high growth company, and it had traded sideways for a couple quarters as the investor base was turning over from primarily retail. Probably some of the people on here bought Palantir very early and held it and were very smart long-term investors. But there was a couple quarters where the traditional institutional growth investors had not adopted Palantir yet. And that allowed patient investors to step in and buy it. It's growing incredibly rapidly. The US commercial business is what people are watching to see that that's growing and that it's moving away from being purely a government contractor and into commercial growth. And the reason commercial growth is growing is Alex and his team are solving something that has been an ask in the business world for 20 or 30 years. And that is, we have data in all of these silos, but we can't get the silos to talk to each other to create actionable data. And that's what Palantir has been able to do for the first time in business intelligence. And that's where you're seeing the strong growth in commercial. You're seeing, the key metric that people are watching in a software company is Rule of 40. That's where you add revenue growth and margins. And the Rule of 40 at Palantir grew from 127 to 145 to 155. These are just unprecedented numbers. And so you're seeing that Palantir and the growth and the opportunities have a durability. They're also bringing something to the enterprise that Alex Karp talks about a lot, is that they're going to be the trusted layer between the enterprise and the foundational models. Number one, that makes sure the enterprise is not overly reliant on any one of the foundational models, and also helps buffer that data from the foundational model, because there is a balance of how much you want to expose to the foundational model, because as a corporate, the thing that makes you valuable is your processes and how you're delivering your products and your distribution to the customer. And there may be some buffer you want between how much you want the foundational models to know about you, because then they can repackage that and sell that to others. So for all of those reasons, Palantir has positioned itself. And the final thing, an important thing to talk about for Palantir, is how they use forward deployed engineers. So one of the larger questions in this artificial intelligence build out is, what will it do to human jobs? And we've had a contrarian view that AI will not be a net destroyer of human jobs. Now, it will be in pockets, as all major changes have been. We've studied everything from the steam engine to electricity to railroads to mobile to internet. So there will be job changes with AI, but in each one of these revolutionary changes, there's been more job creation than destruction. We think AI will be the same. And so it's not a matter of AI taking jobs from humans. It's humans using AI will outperform humans not using AI. And this is relevant to Palantir because remember, Peter Thiel and the others that were at the formation of Palantir all come from PayPal. And what PayPal learned early on is that artificial intelligence and machine learning alone could not find fraud. Humans, there weren't enough of them to find fraud, but if you combine a machine learning tool and a human, you can do very powerful things. And that's what Palantir brought with the forward deployed engineers. So they've really had 20 or 25 years, a 20-year head start, plus all of the institutional memory of what a lot of that team did at PayPal to really be way ahead of their competitors. And we think it's durable and not cyclical.
Dell and NVIDIA are both major holdings, but occupy very different places in the AI build-out. Dell has described a rapidly expanding AI server backlog, while NVIDIA sits much closer to the underlying compute architecture. So how do you evaluate where economic value will accrue as AI spending moves from building training infrastructure toward larger scale inference and enterprise deployment?
That's really a really great question. And I think sometimes, people sort of, again, think of this as a monolith, and these are very different areas. We think training will continue to be an important part of the market. And certainly NVIDIA has the best training chips out there. Elon Musk just made the announcement that SpaceX and SpaceXI would train exclusively on NVIDIA. So we think their position there will continue to remain very strong. And you're right, when it comes to building AI data centers, especially on-premise AI data centers, Dell is really taking the lead there. The margins are much more durable there than people anticipated. So I think at least in the medium term, you're going to see very strong margins in Dell's server business. Building these servers on premises to do agentic workloads at the corporates where they want to ring fence and hold all of that data within both their physical and electronic ring fence. And Dell is really leading that part of the marketplace, and we think will continue to do so.
CrowdStrike, Shopify, Salesforce, Snowflake, they give the portfolio exposure to very different software markets. I think you'd agree, Mike. Within software, what separates a founder-led company with a genuinely durable competitive advantage from one where an attractive narrative or rapid growth may already be fully reflected in the valuation?
That's a good question, and it's something we've studied. And I think fortunately or unfortunately, I guess the unfortunate has become fortune, the SaaSpocalypse in late January and early February really reset the long-term multiples of some of these really great, really durable software companies. And the fear then was that all software would get vibe coded away. One of my favorite days to know this was completely overdone, I think IBM, which we don't own because it's not founder-led, but it's a proxy for this area, I think traded down 13 or 14% when Claude could write COBOL. Well, I'm here to tell you that Jamie Dimon isn't letting anybody vibe code his mainframes. And so to me, that was sort of marked the bottom of this really being overdone. And so what we're finding is that the great software companies are not going to be vibe coded away. In fact, they're the trusted layer into the corporates. So they're going to be what's trusted to keep the data safe, trusted for the interconnect points. And they're moving from a per seat license to a per computer, per task license. And so we're going to continue to see durability in some of these great software companies. You are right. Some of these very light wrapper areas, they certainly could have exposure to some vibe coding. But the reality is most of this software on a per seat basis relative to the value it's providing is so inexpensive that people aren't going to take the risk of vibe coding something versus a highly professionally built and maintained software system. And that's probably another thing worth pointing for your viewers. It's not hard to prototype something. Even before the amount of high-powered AI software development tools, prototyping something is never the trick. It's building it, maintaining it, and testing it at scale. And that's really the durability that helps protect a lot of these, very durable software as a service enterprise companies.
The portfolio has a 7.5% individual position cap and is reconstituted quarterly, but current weights range from several large positions above 4% to many positions below 1%. How do you determine when a company deserves to become a high conviction position? And what would lead you to materially reduce or exit a founder-led company, even if the founder remains in charge?
Great question. And I'll just put some of the top weightings up for the viewers as well. We run what's called a modified market cap weighting, similar to what S&P does, similar to what NASDAQ 100 does. So our portfolio, we set the weightings based on market cap. What we do to limit risk is we put a hard 7.5% ceiling in. We won't rebalance to more than 7.5% at a quarterly rebalance. It could drift higher with the growth, but the reason we did that is we ran thousands of simulations on the portfolio prior to launching it to figure out what the best risk reward was for a maximum portfolio weight. So the weightings are driven by market cap. We put a cap on so there's no excess concentration by any of the mega companies. And then what would cause us to sell a stock would be back to this factor model. If the factor model shows some burnt pizza crust potentially showing up, then we would shift it out and bring in the next name.
The macro environment is not especially forgiving for long duration growth equities. Economic growth has moderated, inflation remains above the Fed's longer run objective, and policy rates remain well above the ultra low levels of the previous decade. Now, what parts of the founder-led universe are most vulnerable if capital remains relatively expensive? And where do you think strong company fundamentals can matter more than the macro backdrop?
Great question, and we'll get into that. But I think what's most important to point out to people is we've built a portfolio that is not particularly sensitive to all the macro background. Our long-term style of investing ultimately means most of this macro is noise. And what's even more important in a tricky macro environment, I think people would say that starting Feb 28 or March 1, when the Middle East war kicked up again, that created a lot of disruption in most people's portfolio. If you look at our performance from then till now, we've outperformed the S&P by about 4%. I'd have to look after yesterday, be a little more, a little less, but we've managed to outperform the S&P during a very difficult macro environment. And that's because of the way our companies operate. Founders have vision. They typically grow faster so they can grow out of a multiple compression. They tend to have very disciplined balance sheets, so they're not using a lot of debt. And so we've built a portfolio that is pretty darn insulated from the macro.
And final question, Michael. Let's talk a little bit about your personal journey in the final minute that we have.
Yeah, so for me personally, this is the culmination of my life's work. I'm a founder myself. I founded a defense technology company prior to this, made really interesting hardware to build highly specialized wireless networks. And it was through that journey that I met some of the great founders out there and really learned that founders truly are different. The way they build companies is different. And it got me really inspired, along with the Fort McHenry flag, to dig in, do a ton of analysis, and discover that this persistent, durable founder factor is there. Invest that way myself and invite you to join us in investing in that style of investing.
Thanks for an excellent presentation, Michael. For additional information about Founders 100 and its fund, please visit the sponsor's website where you can access the fund's prospectus. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Procure AM ETFs. Presenting today will be co-founder and CEO Andrew Chanin. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Andrew, please go right ahead.
Thank you so much for that great introduction. I'm thrilled to be here. Everyone joining us today, thank you for being here. You could have been anywhere in the universe, but you're here today to learn about the world's first pure play space ETF, ticker UFO. For those of you who don't know me, my name is Andrew Channon. I am CEO and co-founder of ProcureAM. We're an innovative ETF company that looks to provide investors with access to difficult to access investment opportunities. And UFO was the first ETF that we launched back in 2019. So we have over 7 years of UFO being in the marketplace. And we're thrilled to talk about not just the ETF today, but also a brief little bit about the history of the space industry, some of the catalysts that are already occurring in front of us today, and where we might be headed, as well as some information about the Procure Space ETF UFO. For those that don't know me, my background has been in the exchange traded fund industry since 2007. I've worked as a lead market maker for global and international equity ETFs on the floor of the American Stock Exchange. I've helped build proprietary trading desks, trading in ETFs, and started giving ETF ideas away to existing issuers that weren't in the marketplace. They went on to launch them, and eventually one of them said, "Why do you keep on giving us your ideas? You should try launching your own." And that actually led to me sponsoring some world's first investment opportunities, such as the world's first cybersecurity ETF, as well as the first junior silver and exploration ETF, the first video game ETF, the first digital mobile electronic payments ETF, as well as other many firsts to market. So hopefully, that helps provide a little bit of credibility or background, and hopefully you enjoy what we have to present today. So if you look back at the history of space, space in its early forms of being an industry was really just kind of left open to just to nation states, so countries, militaries, and what really kicked it off was in 1961, where Yuri Gagarin became the first human to actually orbit space. And I think you could probably attribute a lot of all the amazing accomplishments that we've achieved as America because of that pressure that the USSR put on the United States for sending the first human into orbit into space. And then if you fast forward to 1969, an event that some of you maybe got to witness firsthand or on TV or on the radio, or the rest of us get to hear about the amazing accomplishments of July 1969, where the Apollo 11 landed humans on the moon for the first time, arguably, possibly the greatest engineering achievement of humankind to date. In 1981, you may be familiar with the space shuttle. The space program was doing a lot more, where we also started to do things like GPS, and started doing things that provided benefits for civilians. But if you look at kind of a common thread across a lot of this, you'll see that only nation states had the capital back in the day and the technology. The risks were extremely high to go to space. And if you wanted exposure to the space industry for those kind of 60 years, unless you were an astronaut or worked at a company that was trying to provide solutions for NASA and others, being a taxpayer was pretty much the best way that you could actually get exposure to the space industry. And why I think that it's relevant to talk about the past is because of some of these catalysts that brought us about to launch the space ETF UFO, was that there were some of these catalysts and that government monopoly began to break. So taking us to closer to modern times, but not to current present, in 2002, SpaceX was founded. SpaceX, as most people here on this phone call and webinar are aware, was the largest IPO ever in financial markets in human history. And we got to enjoy this American company coming to the public markets in the United States, but their journey started in the early 2000s by a visionary or a madman, depending on who you are, what your opinion is. SpaceX had many bold goals. And one of the main things that they were looking to do was to significantly reduce the cost of accessing space. So this was brought about by the advent of reusable rockets, which essentially helped to significantly reduce the time in between launches, because back in the day, the common way to get to space was to build something from scratch And then once it achieved its goal, it was pretty much scrapped or saved for a museum. And if you wanted to go to space again, you were rebuilding a brand new spacecraft. And the cost, the time that it takes to do something like that is part of the reason that the cost of accessing space was significantly higher than it is today. I had made a chart with two interesting graphs on it that didn't make it to the final cut. One showing the cadence, the amount of launches per year, and it looked like this on the chart, and the opposite chart that was going to be underneath it was one showing the cost of launch for space, and it looks very much like an X. The amount of launches that we're seeing currently today it is radically higher than it had been previously. SpaceX being the largest as far as amount of weight launched into space, represents between 80 and 90% of launch payload capacity currently as of this past year. And kind of right behind SpaceX is China. And if it wasn't because of a company like SpaceX, the U.S. could potentially be lagging China in the space race, which is becoming extremely critical today. So one of the goals of SpaceX is to significantly reduce the cost of launch, possibly even to under $100 per kilogram. We're still a bit above where that is today. A lot of analysts look at possibly $150 per kilogram to go into space as a potentially realistic goal for the not too distant future. But what they're trying to build over at SpaceX with their next generation of Starship rockets, could have that potential once they're fully operational, commercially operational, and building these rapidly and deploying them around the world, is something that is potentially feasible. Something that people back in 2002 probably would have laughed at, but here we are today. So the space economy as of 2025 is actually by the Space Foundation, which is the largest non-profit, non-biased entity focused on the overall space industry. Came out with their numbers just towards the end of July and showed that in 2025, that the size of the global space economy was roughly $686 billion, up about 12% year over year. And I want to kind of break that down for you. So we talked about in the early days of the space industry that the space industry was almost entirely government funded, and that is no longer the case. Roughly 79%, almost 80% in 2025 was actually commercial. And so broadband, positioning, navigation, Earth observation, launch services, this is not a government spending story anymore. Certainly government spending does help, and we do see various pockets and areas where government spending is still very important and driving a lot of innovation. But it's commercial infrastructure that is also now becoming a major driver. So governments and defense make up roughly $141 billion of that $686 billion mentioned, and global military space spending crossed $150 billion last year for the first time, which has been a growing share of the overall space economy. And later we'll come back to why that matters. There's about $12 billion plus in private investment last year alone, orbital data centers, launch satellites. The Space Foundation's own projections is that this crosses $1 trillion potentially as soon as 2032. So this isn't a 20-year story. It's roughly a 6-year story from where we're sitting at today, which I think for a lot of observers that have been watching the space industry would be really pleased if we could hit that number. So the next chapter of space. Probably one of the more underappreciated areas for a potentially growing space economy is compute. And we're hearing about it nonstop on the financial news networks and if you're reading financial publications, but compute is starting to move to orbit. And it's being pulled there because we have some terrestrial problems. On July 14th of this year, the New York governor, Governor Hochul, signed the first statewide moratorium in the United States on new hyperscale and data centers, 50 megawatts and up in New York. The grid simply can't keep up with AI compute demand as it currently stands, And this isn't just a New York problem or something that's being considered in New York. It's a preview of the constraints that show up everywhere where power-hungry AI and infrastructure wants to land. The orbital answer is already happening. StarCloud raised $170 million in a Series A at $1.1 billion valuation, and they already have NVIDIA H100 in orbit. So it's not a concept. It's a flying hardware currently today. We're currently working on future iterations. SpaceX, which we had mentioned previously, along with Google and Axiom, Thales, a European space company, all filing various plans in the orbital data space. And we'll also probably be discussing this later again in disclosures when you read through it, but not every name that I mentioned just previously or will mention is necessarily a holding in UFO. And we'll go into telling you why certain companies make the cut and certain don't later on in this presentation. But SpaceX and Thales are in the portfolio today as of last night's close. But that's why we're also looking at presenting an investment opportunity that uses an index to define what space is. UFO currently holds satellite manufacturers and operators, launch providers, ground infrastructure that both do commercial compute capabilities and defense demand, which depend on these various types of compute needs for national defense and security. So these are some of the areas how space might help us with some modern day problems, but space is already part of our everyday lives. So let me start off with asking you a question on this slide. How many of you have touched space this week? I bet pretty much everyone in this discussion has, and maybe you haven't considered it, whether you have or not, but very good chance that everyone here watching today has touched space at least once this week. SiriusXM is a satellite radio provider, giving you connectivity in your car. Garmin is a GPS signal from space. Many people have these embedded into their smartwatches, or if you captain any boats, Garmin is frequently seen for maritime purposes. AST Space Mobile, a name that's been getting a lot of coverage in recent weeks, especially following SpaceX's most recent earnings call. They had mentioned of Starlink Mobile, which could potentially be a competitor to AST Space Mobile, but AST Space Mobile provides cell signals that reach cell towers where cell towers can't, directly to your phones if you're traveling off grid. But essentially, space stopped being a frontier story a while ago, and currently infrastructure is already embedded into our daily life. The investment opportunity is now catching up to that reality. So how do you actually get exposure to all of this in one trade? Potentially UFO, the world's first pure play space ETF. Listed on NASDAQ, it's the first pure play space ETF, and it's been trading since April of 2019, and it seeks to track the performance of the VettaFi Space Index before fees and expenses. There's a couple things I'd want you to hopefully take away, and that is that this is exchange traded access to several areas, to launch providers, to satellite makers and manufacturers, ground equipment, telecom operators, all in one trade. It's a rules-based and transparent strategy. This is not actively managed. This is not making a single bet on an individual company or an individual country. Every holding in the fund is publicly traded and priced daily, and it's in a global category focus that can include small, mid, large, mega cap listings from across the Americas, Europe, and the Asia Pacific. And UFO, many of you, if you have already invested in the fund in the past, may be aware that UFO held Rocket Lab and AST Space Mobile years before either became household names. And that's kind of one of the arguments that we make for why people might want to consider owning a category and owning it early through a rules-based index, rather than trying to guess which single individual name might become the next headline. And so hopefully, if you look at the fund today, on the next slide, you will see that there's a 7-year track record. We won't get into discussing performance, but for anyone that's curious, we'll provide you information for a link to our website so you can find that directly. The expense ratio for the fund is 75 basis points, which is fairly in line with thematic ETF peers. There's currently roughly 66 holdings in UFO. Similar to the index, the fund is rebalanced quarterly and reconstituted semi-annually. So it's at these time periods that you can find certain names that now qualify that didn't previously based on those rules may be eligible for inclusion. And similarly, during reconstitutions, if a name no longer meets the methodology requirements, that those names can be removed from the fund. There were times where the fund had, roughly 30 names in it, but as the global space economy itself has grown, the amount of pure play space opportunities trading around the globe has increased. It has allowed for additional exposure into many new companies, technologies, and geographies that quite simply weren't necessarily available when the fund initially launched in 2019. But that is just one example of how this fund is living, breathing, and looking at the space economy today and how it may evolve potentially into the future. So I'd like to talk about the index. We are really proud to be licensing the VettaFi Space Index. They set the rules, which are very important. At least 80% of the underlying index at rebalance goes into companies that derive at least 50% or more of their revenues from space-related businesses, activities, and services. Space-related has a real bar, and space-based function has to be essentially to the product, not a peripheral feature bolted on to an otherwise ordinary company. It's also global by design, small, mid, and large cap across the Americas, Europe, and Asia, because space is not just a US story, a North America story. This has been an industry that has been highly collaborative over the years. If you look at the conflicts, starting with the Ukrainian-Russian conflict, you'll see that space was front and center in this entire scenario. And as troops and supply buildup started occurring at the borders of Ukraine, it was satellite imagery being presented by satellite companies that were providing this real-time information of this war that was about to start. Once the conflict began, we started seeing satellite jamming becoming a strategy for stopping or slowing down the ability to communicate strategically. We saw Russia taking hostage of numerous satellites owned by OneWeb at the Kazakhstan Baikonur launch base. OneWeb, a company owned significantly by the UK government. So this was a strategic geopolitical hostage taking of vital technology for the UK government. We also saw Russia refusing to export certain parts that are very useful for space rocket engine manufacturing. And it started causing countries, companies, militaries, and even individuals to start to come up with their own space plan. How will we move forward? And so these have all become very important as military is now viewed as the strategic high ground of warfare, currently. And this is just another one of these potential catalysts. It's not just that the cost of accessing space has been driven down dramatically over the last decade, but space is extremely important for defense purposes, which is why we're seeing things like this increased military spending and budget. The modern space race now, as opposed to the early days of Yuri Gagarin and the Apollo 11 lunar landing, which was more of a vanity project, I would say, which was, hey, this is great. Look at what we did. This is now having real stakes. And losing is not something that people want to do. Many nations are vying to become the global space power. There may be one, there may be several, but right now those stakes are being planted to determine who will have the infrastructure of the rest of this century as it's currently being built out today. To give a little bit more information about the underlying index, which helps power the UFO space ETF, the index organizes the space economy into 5 different segments. We have rocket and satellite manufacturing, ground equipment manufacturing, space technology and hardware, space-based imagery and intelligence, and telecom, TV, and radio broadcasting. And it's a deliberately broad scope. It's not just rocket companies and launch. It's a large amount of the value chain that makes this economy that we talked about earlier in the presentation. Geographically, as of the end of June this year, roughly 81% of the underlying index have been focused in US listed companies, with the balance spread across Canada, the Netherlands. Japan has become a very large player in the space industry, Luxembourg, South Korea, and others. So yes, there is a heavy US concentration. And the US is a major provider and leader in the space industry, but it's not the only thing that matters here. We are seeing innovations being created from around the world, and it's also very difficult for many investors, particularly retail investors, to get exposure to foreign companies. UFO might be one of those ways that investors can actually access some of these harder to find or invest in names. So for those of you that might be interested in learning more about the Procure Space ETF UFO, you can see on this slide, you can reach us through our website, procureetfs.com. On there, you can find some information, some interesting information and documents about the fund, some thought pieces about the space industry beyond just our ETF. You can see our phone number for reaching out to contact us directly, email us, or snail mail us. We're there, and we're looking forward to hopefully answering many questions with you as the space industry evolves. Also would like to show you just our disclosure considerations. That gives you some more information about some of the information I shared on this call. Certainly, as always, talk to your financial professional before you make an investment. Read the fund's prospectus. These are all very important documents or areas where you might be able to learn more before you make an investment. I'm also told that we do have some questions for Q&A today, so I'd love to help answer them if you're able to help pull them up on the screen.
I'll just read them aloud to you here, Andrew. First one here. Space investing for years had sounded fairly speculative, but as you mentioned in your excellent presentation, satellites now underpin communications, navigation, weather data, agriculture, logistics, national security. Now, where has the space economy crossed from an emerging technology story into essential infrastructure, and where is that transition still incomplete?
So I think there are numerous catalysts still potentially ahead for the space industry, but some of these things are starting to emerge today. And I'm glad that you brought up some of those areas where we're seeing kind of the connectivity to space. One of the hardest things that I find is helping people understand what space is. To many people, it's far off. It's science fiction. It's something about movies and interesting novels that people have read, and it's not necessarily as tangible to everyone. But you see billions of dollars being invested into things like cloud computing, Internet of Things, connected devices, AI, even blockchain and cryptocurrency. And there's this kind of common thread amongst all these industries, which many people, whether intentionally or unintentionally, seem to miss. And in many of these cases, we're talking about data being this common thread. It's being produced in one place, and most times it's being sent to another. And in so many of these use cases, space is providing these various assets that are operating as the digital data toll operator on the digital data superhighway. And so satellites are helping with this, ground stations are helping with this. And so to the extent that people are seeing this massive need for data, this massive generation of data, sometimes this data is even being generated in space from satellites, from imagery, observation, and whatnot, and then is being sent down to Earth as well. And as we talk about data centers in space, this is also a potential another area where we have data going from one place on Earth to space, or space to Earth. And in order to have all these industries functioning, we need a vibrant space economy. And so a lot of this infrastructure is put in place today, but we're seeing numerous types of next generation technologies being developed. And in many cases, space is at the helm of this innovation. So you need launch to send these space assets to space. You need sensors, you need communication tools in order for the satellites to receive this information and then send it to where else it needs to go. So there are many different areas. Don't count out the defense, the military use cases for space, because this is very important as well. But we're only starting to scratch the surface. And the further we can drive down the cost of accessing space, the more companies, individuals, governments have the ability to build out things to understand more about what's possible for the overall space economy. So we're excited to see what catalysts present themselves, but many were essentially previously not economically viable because of the cost of accessing space. So we're excited to see what innovation can present itself in the near future.
Andrew, as you've made very clear in your presentation, some of the largest positions in your portfolio are simply not rocket companies. For example, you mentioned Garmin, also Trimble. These are among the biggest holdings in your portfolio. Let's get more into what navigation, positioning, and geospatial technologies tell us about where the economics of space are actually being captured today.
So GPS is extremely important thanks to the US military. Many of us have GPS capabilities in our smartphones. There are actually other nations that are building their own rivals to GPS. In China, they have their own version that they're working on. But to be an individual working in or utilizing the modern economy, in many cases, GPS is extremely important, whether it's figuring out the fastest route to get to your house to an event or a meeting that you need to be at, whether it's app delivery services, being able to provide you with real-time information of when that Uber or that food delivery might arrive. GPS is extremely important. Then you even have companies that are not space companies that are utilizing GPS for autonomous purposes. So tractor companies that are trying to use GPS coordinates to autonomously navigate things like tractors. As we build out our capabilities on the moon, having the ability to have autonomous devices that could hopefully build out habitats on the moon and beyond for us before we actually send humans there will also be extremely critical. Connected devices, Internet of Things, using slightly different technologies, but navigation and communications will be extremely important. SpaceX, as many of you may be aware, are trying to have goals of building out permanent human colony on Mars and being able to have autonomous humanoid robots or other apparatuses, technologies that can help build out those permanent colonies before humans even set foot on Mars could be very helpful and also minimize the human risks of going to some of these far off distant places. So GPS, navigation, communication, things like the Ka band, like a company like Iridium has been specializing in, which is soon expected to have a merger with Rocket Lab, another large holding in the fund. These are all very important areas of the space economy. And again, the cheaper we can get to space, the more technologies and things that we might be able to see built off of these or improvements to these existing systems.
This is a question about SpaceX and Rocket Lab, Andrew. SpaceX, as you said, is now one of UFO's larger holdings following the public listing, and Rocket Lab is another one of your significant positions. Now, from an investment perspective, how do you think about the economics of a vertically integrated space company combining launch, spacecraft, components, and potentially recurring services versus a company concentrated in one layer of the value chain?
I think there's room for numerous types of structures of companies to be able to compete here. SpaceX loves to vertically integrate. We've also seen Rocket Lab step up and make a lot of strategic acquisitions. Many knew them originally as a rocket and a launch company, but some strategic acquisitions have allowed them to start moving into the satellite manufacturing area, as well as this potential merger or acquisition of Iridium, which could not only provide them with their own owned satellite manufacturer and operator, but a client for launch. And so as we see technologies evolve, as we see companies start to build out their roadmap for the future, it's exciting to see how these companies are starting to evolve. And especially in the M&A world, where this used to be an area that only the large diversified aerospace and defense names were able to play in because of the dollar amounts going into some of these acquisitions, we're starting to see new players start to step forward. You're starting to see companies like SpaceX, Rocket Lab, and others start to become one of those out there that can look for interesting opportunities to build out their own capabilities.
Thank you very much for that, Andrew. And for more information about Procure AM and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses and any more questions. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Hoya Capital. Presenting today will be Chief Investment Officer David Auerbach. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. David, please go ahead.
Thanks so much for having me. It's great to be here with you today. So we're here to talk about the world of real estate investment trusts, or REITs. And for those that don't know, you're using a REIT-owned property right now to watch this video today. A data center REIT is facilitating this presentation. So we'd like to talk about how we use REITs every single day of our lives, not really thinking about it. And yet it's a very easy way for investors to sit back, collect dividend income, and go about their daily lives. Hoya Capital is one of the largest REIT and research providers that's on Wall Street. We're the largest real estate research provider on Seeking Alpha. We have two exchange traded funds listed on the New York Stock Exchange. We're going to talk about the high dividend yield ETF today. The ticker is RIET. And our second fund is the Hoya Housing 100 ETF. The ticker of that is HOMZ. You can learn more about Hoya at hoyacapital.com. You could find our research there. If you'd like to know the day-to-day happenings of the REIT industry, you could subscribe to my free daily newsletter called the Daily REIT Beat. And if you want to watch REIT videos with management teams and investment managers, check out my TV channel, again, free, REITtv.com. So from a very high level, this provides you a good overview of the world of REITs. We have over 20 subsectors that make up the industry. And what you'll notice is that at the end of the day, REITs are still just a very small fraction of the world of commercial real estate. But why should an investor invest in REITs? And on the right side of this table here, it shows the benefits of investing in REITs. The first one's the biggest and most important one, liquidity. 150 plus publicly traded REITs trade on the major stock exchanges. With bid-ask spreads, we have 29 plus REITs in the S&P 500. So these are very liquid, readily available investments for your portfolio. Diversification, we talk about all the different subsectors that make up the world of REITs. Transparency, all of these companies publish quarterly earnings, regular press releases talking about transactions. They publish supplements, investor presentations, and quite frankly, their investor relations teams are very approachable to answer any questions that any potential investor may have, as well as the performance, because over long periods of time, the REIT sector tends to outperform the other markets, again, over long periods of time. When we talk about REITs, there's two different sectors that make it up. There's what we call the bricks and mortar, or the publicly traded equity REITs, your shopping centers, your apartments, your self-storage properties, your industrial warehouses. And then there's mortgage REITs. Those are the ones that are focused on mortgage-backed securities, home loans, all that fun stuff. But I'd like to point out that, again, we use REIT-owned properties every single day. If you get a package delivered by Amazon to your doorstep, it was probably facilitated by an industrial warehouse. Oh, by the way, you walk around with a REIT-owned property in your pocket every single day in a cell phone because you're using cell tower REITs to have conversations. And there are 3 publicly traded cell tower REITs that are out there. From a big picture, REITs have underperformed over the past couple of years. There's a lot of reasons that go into it, but obviously the Mag 7 performance in the S&P 500 has driven that outperformance. And so REITs have been operating in a high for long environment for some quite period of time. Obviously, we'd like to see rates reset and come back to earth, but the REITs have been focusing with blinders on business as usual. So this chart here shows the data as of this past Saturday. All but 3 sectors in the world of REITs are in the green this year, and about a third of them are up 20% or more. And we can go into them later on about why. But obviously, data centers being driven by the growth of AI, as well as, frankly, the industrial demand runoff for the amount of new industrial space that's built for every gigawatt of power that's being created in data centers. When we look at valuations, especially focusing towards small cap REITs, we do think that there is a big opportunity here because they are trading at discounts to net asset value, as well as the spread versus private real estate shows that the small caps are somewhat attractive. This table provides a very good overview looking at, frankly, why small caps, higher dividends, trading at a discount, sub 50% debt there. So we think there's a real opportunity. We'll talk more about RIT in a second. I'll come back to it. But we want to talk about some trends that we're seeing in the world of REITs. And number one is the amount of mergers and acquisition activity that's out there. You can see we've had multiple REITs that are either sold or in process of being sold this year. And one of the big players when you talk about REITs is Blackstone. And this highlights all of Blackstone's transaction activity over the past couple of years, looking at the property transactions that they've participated in. So with this volatility, we have seen the number of U.S. REITs has shrunk somewhat. We feel that the lack of new supply benefits REITs as far as new development. And so for every single day that passes with the lack of new development, that existing real estate becomes that much more attractive. But from a fundamental perspective, a lot of people are looking at REITs versus pre-COVID. And what I mean is that when we were coming into COVID, REITs were at an all-time high. The sector was firing along, fundamentals were solid. You really couldn't punch any holes in the thesis. Well, here we are today. The REIT numbers, the earnings and everything are blowing past where they were pre-COVID, but yet the performance has not caught up yet. And then one sector that you can see that is on an uptick here that had been under pressure for a long time was office. And there's a variety of reasons why, but what we have seen is an uptick in office leasing, especially driven by some of these tech and AI firms. So with the lack of new supply, we do see an opportunity here for REITs to grow their earnings, grow their development pipeline, as well as, more importantly, when you buy REITs, you buy it for the dividend income. And so this table shows you that over 60 REITs have raised their dividends so far this year, while only just a couple of them have cut so far. That being said, the dividend payouts still have not caught up to where they were pre-COVID. And so we still have a lot more room to grow for these companies to continue to grow their earnings. As we comment, REITs can only grow one of two ways, either through acquisitions or dispositions. And so as a result, we think there's a big opportunity for that development pipeline to pick up should the lending environment get a little bit more favorable towards REITs. But one thing that hasn't stopped is the capital raising side of the equation. REITs have raised tens of billions of dollars of new capital, whether in terms of debt or equity this year so far. The range is anywhere from 5-year notes all the way up to 30-year plus notes that are out there. And we have seen a couple of IPOs as well. And we think that there are going to be some more on the horizon as conditions hopefully continue to improve. When we talk about the REITs with their balance sheets, REITs do use fixed rate debt, which obviously kind of insulates them from the volatility that we're seeing out there. So there is an opportunity for them there to continue to grow that capacity. This information I'm sharing with you is part of a much broader educational deck that we provide. So if you simply click the QR code here, you can download this presentation and frankly 30 to 40 more slides that highlight all things real estate investment trusts. But I'm here to talk about the high dividend yield ETF. The ticker is RIET. It's a very unique fund where we focus on 100 REITs. That's a rules-driven, passively managed ETF that we rebalance twice a year. But as one of the largest REIT and real estate research providers, we're covering every single one of these companies on a daily, weekly, monthly, quarterly, and annual basis. So since we publish so much research, we're actively staying on top of these companies, whether it's doing video interviews, articles, webinars. We know this sector backwards, forwards, inside, and out. What makes REIT unique versus, let's say, some of your other market cap driven ETFs, Most of the ETFs that are out there are market cap weighted, meaning the largest are at the top, the smallest are at the bottom, and thus where the alpha or the opportunity persists as far as dividends and all that stuff is at the bottom of the stack. So we kind of take that large cap ETF and turn it upside down to find the opportunities in the small cap REITs, the mid cap REITs. And then we have protection with the large cap names as well as what they call the dividend champions. But what makes RIET so unique versus a lot of the other funds that are out there, and you'll hear from another partial REIT ETF issuer here later today. But as far as I'm aware, it's currently the only REIT ETF on the market that combines both common stocks and preferred stocks. So 1/3 of the 100 names, which represents 10% of the portfolio weighting, is in liquid REIT preferred stocks. And by adding that little sleeve of liquid REIT preferred stocks, we're able to add about 100 to 200 basis points of yield to the bottom line. So with where RIET is trading right now, we pay a monthly dividend that's annualized around 11% or so. No leverage, nothing funny about it. Our goal is to find the REITs that pay the highest dividends with the lowest leverage ratios. We cap our weightings in terms of sectors, geography, market cap to try to provide a truly holistic, all-encompassing wrapper that covers all things REITs, so that, again, you're collecting income from shopping centers, nursing homes, medical office properties, the type of things that we're using every single day by living our normal lives. And so we have our top 10 holdings here. I can run through them real quick. Highwoods Properties is a Sunbelt office REIT. Apple Hospitality is a select service lodging REIT like Courtyards by Marriott. We use their properties every day. Kilroy is a West Coast office REIT. Millrose Properties is what we call the land bank for some of the home builders like Toll Brothers. Healthpeak Properties is medical office and healthcare and lab space. AGNC is a mortgage REIT. Americold Realty is cold storage, refrigerated industrial warehouse storage. So is Lineage. Annaly Capital is a mortgage REIT. And then Triple N is one of the largest net lease REITs that's out there. Think of your fast food restaurants, gas station, car washes, Dollar General stores, the list goes on and on. So with that, I will pause and I'm happy to answer any questions that you may have.
Thank you, David. Let's move into the questions now. Why RIET REIT instead of a market cap weighted REIT, REIT, ETF like VNQ?
You know, there's nothing wrong with that approach. As we had said, you know, when you invest in the large cap names, you're kind of giving up yield for that market cap size. You're missing out on where the real opportunity persists in small and mid cap names. So with REIT, we took an opposite approach, RIET. We started with income and valuation and then diversified across the sector. So the goal is, you know, mega cap REITs aren't bad. It's just trying to provide a differentiated portfolio that frankly isn't replicating what investors own elsewhere.
How do you manage risk within REIT given the high degree of small cap exposure?
Yeah, and this plays into that rules-driven strategy that we had discussed. You know, small cap REITs are frankly, let's say, cheaper for a reason. They might have more leverage. There might be a little bit less liquidity or less access to capital. So, you know, we don't stick our head in the sand and pretend that it doesn't exist. But with a true diversified portfolio where we cap our weightings, where no holding has basically more than 1.5% exposure, we're really able to provide a true diversified basket. We think the opportunity comes from finding those situations where the valuation discount is frankly much larger than the fundamental risk that may be out there.
It has a high dividend yield. Should investors view that as a sign of higher risk?
You know, investors should understand that potentially higher yield and higher risk are related, you know, but yield doesn't tell you whether something is attractive or dangerous. We take a different approach. And the key being, with this being the high dividend yield ETF, our first question is the dividend covered? Are earnings growing? Is cash flow growing? How levered up is the company? Is that high yield from a temporary valuation pressure, or is it because of deteriorating fundamentals? And as I mentioned before, with over 60 REITs raising their dividends so far this year, while payout ratios still remain historically conservative, we think there's still a lot more room to run here. But a high yield's a great starting point for research. It's not the conclusion to the research.
What is the biggest opportunity you see in REITs today?
You know, when you talk to any talking head about that, the question becomes public versus private. Public REITs tend to lead private real estate, since private real estate is frankly only reset once a year through an independent appraisal. So because of this underperformance and this net operating income and earnings growth that are well above where we were pre-COVID, while private real estate valuations haven't quite caught up to where the public guys are currently, we think that's why you're seeing a lot of M&A activity, why private players and private equity are buying the publicly traded REITs. Because again, when these names are trading at a discount to net asset value, a private manager can buy an established existing platform for, in some cases, 60, 70, 80 cents on the dollar and be exposed to a certain asset class with tens of thousands, if not hundreds of thousands of units or square foot of ownership going forward.
Do REITs need the Fed to cut rates for this thesis to work?
I mean, obviously, when people think REITs are interest rate sensitive, interest rate cuts would sure provide the tailwind for the sector. But as I mentioned before, REITs have been operating in this high for long environment for quite some period of time that, frankly, they're sick of waiting for the Fed to cut rates. So we're not going to go back to zero, but we do need to see some stability in the cost of capital that's out there. Obviously, if rates hikes stop, then we can obviously finally start to understand how much it costs to underwrite acquisitions, development. We could refinance with more confidence that's out there. But again, I think the catalyst here is that lack of new construction. The lack of new supply makes existing real estate that much more valuable, where some of these landlords, especially in the retail space, like a Simon Property Group or a Tanger, are able to frankly raise rents by double-digit percentage points because of the amount of demand for those high-quality properties that they own.
We got this rather long one here, David. Let me read it off of the email. Housing has been caught between two powerful forces, a long-running shortage of homes in many markets and mortgage rates that are still around the mid 6% range. When you look across the housing ecosystem today, which of those forces is having the greater influence on fundamentals? And where are you seeing the biggest disconnect between housing demand and affordability?
It's a fantastic question. And that's frankly why we have the Hoya Housing 100 ETF, HOMZ. It plays right into that. The questioner is absolutely correct. There is a major supply-demand imbalance that's out there, coupled with very high mortgage rates. As a result, home affordability is frankly out the window for so many potential consumers that are out there. As a result, it's frankly the REITs that benefit from that, such as apartments, single-family rentals, and manufactured housing. And of that group, there's about 15 to 20 REITs that make up that subsector of the industry. A couple of things have to break, though, for that to, let's say, right-size the ship. Obviously, one, a significant decrease in the 30-year mortgage rate, going to, let's say, frankly, a 5 handle, if not a 4, which might be a pipe dream. But also, your favorite home builder frankly needs to reset and deliver a more affordable product. Instead of delivering a $700,000 home, deliver a $300,000 home. But I think you're going to continue to see these home builders continue to buy down the mortgage rate, offering incentives to those consumers that can afford properties. But this is a story that's been going on for many, many years. And frankly, It's not about to change anytime soon. And we really wish that we could, again, frankly, right size this supply demand imbalance that we are seeing in the housing industry.
Why are you particularly interested in small cap REITs right now?
Yeah, so we showed some slides that kind of highlight the why of small caps. Right now, small cap REITs are trading about 13 times their FFO, or what the REIT equivalent is of earnings per share. The large cap names are at 17 times. The mega cap, the big guys in the S&P 500, are at 25 times. So the small caps are trading at larger discounts to NAV. Because the balance sheets might be a little bit more leveraged and might have a little bit less liquidity. But REITs are a momentum-based sector. So as that pendulum swings, those REITs that are in the right place at the right time are the ones that are in demand, or you're seeing those as natural M&A targets that are going out there. So we think that the small cap opportunity isn't that every small REIT is cheap. It's just that the market is charging an unusually large size discount, and we think there are places where that discount is excessive.
Here's another longer one. One of the unusual features, this person writes, of this housing cycle has been the gap between new and existing homes, as existing homeowners with low rate mortgages have been reluctant to move. How has that lock-in dynamic changed the competitive position of home builders, and what would have to change for the existing home market to become meaningfully more liquid?
It's another great question. Love the question where the person's thinking from. That's great. And I think we are starting to see it a little bit more, frankly, with every year that passes. And it's that baby boomer that's selling the house and moving into the retirement community or senior housing. Oh, by the way, that senior housing side of the equation, just like regular housing, we don't have enough supply for the amount of demand that we're going to see in the world of senior housing. The property that exists today is going to look nothing like what's going to be demanded tomorrow for Gen X, Gen Y, and futures there beyond. But as you see these baby boomers and others shift towards those communities, that's what's going to unlock some of that existing home supply that's out there. But just like before, when we're locked in with sub-3 mortgages, or some cases lower, it's very difficult to make that plunge into buy another house with a mortgage rate that starts at the high 6.897% mortgage. And so again, there's got to be some type of give and take here for us to see that number decline. But again, they kind of move in lockstep with each other. And sadly, it's shutting a lot of people out that want to buy that house that don't have that opportunity to do that.
Now, if higher interest rates have hurt REITs so much, what is the silver lining?
It goes back to this example I mentioned about the retail landlords as an example. Though new construction is harder to pencil in, let's say, it does make that existing supply that much more valuable. So when you don't see new competing product that gets built for several years out, existing landlords are eventually gaining more occupancy and pricing power. Remember, the publicly traded REITs, frankly, own the best properties in the best markets at the best intersections in the most desirable locations. It's those properties that are in demand that we're going to use every single day. So it's all about positioning. Though the higher rates have created, let's say, a REIT bear market, it could also have planted the seed for potentially that next bull market in REITs by shutting down that new supply that's not there today.
Home Depot and Lowe's are among HOMZ's largest holdings. With housing turnover still relatively subdued, how do you think about the outlook for home improvement spending? Is the more important driver ultimately home sales, the aging U.S. housing stock, household formation, or homeowners choosing to renovate rather than move?
Is there an E, all of the above type of answer that's available there? You're absolutely correct. Home Depot and Lowe's are a great source of information looking at the state of the housing market. but then you've also got all the other service providers and home goods and furnishings that are out there. And I think the earnings results speak for themselves. Again, because of that lack of affordability, more people are choosing to focus on upgrading their existing properties or renovating a room inside their house and everything. So I think that you are going to continue to see that demand from the Home Depot and Lowe's of the world, hopefully offset by, let's say, improving economic conditions that make home affordability that much more available for potential consumers.
Residential gives HOMZ exposure to the rental side of the affordability equation. How do you assess the balance between high home ownership costs, which can support rental demand, and the new apartment supply that has pressured rents in some markets? What indicators tell you when that supply-demand balance is starting to turn?
Again, another great question, and we point towards the publicly traded companies, the dozen or so public traded apartment REITs, the two or three publicly traded single family rental guys that are out there. They are the ones that are telling you what that supply situation looks like. So, number one, concessions. What do the concessions look like that's out there? And we know they are still somewhat elevated. But the key is, as you mentioned, supply. And a couple of the well, let me rephrase that. All of the residential REITs have been out there saying that supply number, the oversupply, we're finally eating into it. And they are starting to see positive signs towards the back half of this year into 27, when that supply situation might finally right-size itself. So we are seeing some pushback, as we've been talking about here, but that provides that opportunity for down the road. Because remember, an apartment lease is 1 year, if not month to month. It's usually 1 year. And so we're able to kind of take a look at it from a year-over-year situation. From a very high level, though, what a lot of the apartment guys have said is, look, our net operating income year over year, 2Q 26 versus 25, was actually down. But if you look at new lease rates and NOI on a sequential basis, as in 2Q 26 versus first quarter 26, those numbers are actually positive. So they're finally starting to see signs that the tide might be turning more into their favor, but it's definitely a wait and see type of thing, especially, again, driven by what's going on in the world of single family home ownership and that lack of affordability due to elevated mortgage rates and other factors.
Turning now again to our IET, the portfolio currently spans very different businesses, from office owners such as Highwoods Properties and Kilroy Realty to Apple Hospitality in lodging, HealthPeak in healthcare, Americold and Lineage in cold storage, and mortgage REITs such as AGNC and Annaly. Where are property level fundamentals diverging most sharply across real estate today? And which of these divergences do you think investors misunderstand?
There's a lot to unpack there. And I think the fact is there's 20 plus subsectors of real estate that are out there. Each of those subsectors are in a different stage of the real estate cycle. And frankly, inside each of those subsectors, some companies might be in different stages of that process as well. But if you look towards a company like, let's say, Welltower, which is in senior housing, it's one of the large cap REITs that are out there, or Prologis, one of the largest industrial REITs that are out there, they provide a very good, let's say, overview of the entire sector. So if Prologis says industrial fundamentals are very solid, we're rocking along, there's a pretty good chance that a lot of the other industrial REITs that are out there are in that same position as well. It's very rare do you see one guy or 10 guys that are kicking butt, and maybe one guy is going through their own issues for a certain set of reasons. So they kind of tend to move in herds with each other. But we try to cover all of these different sectors. Like, look at banks as an example. A year ago, we were talking about regional bank distress, and the mortgage REITs are under pressure. Now we're on the other side of that. Look at somebody like Blackstone or Starwood, the private REITs, where, again, they're investing in the same assets that the publicly traded REITs own, but investors couldn't access their capital. Their redemptions were gated. So for all of these stories that are out there, our goal is to figure out, at the end of the day, pick any stock that's out there. You, the investor, want that company to do four things: grow revenues, grow profits, grow dividends, grow annual guidance. If any company is able to do those four things, regardless of what's going on in the macro world as far as elevated interest rates and all that stuff, that's the driver you're looking for.
Excellent presentation. Thank you very much. For additional information about Hoya Capital and its funds, please visit the sponsor's website, where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Principal Funds. Presenting today will be Brett Busness, the Managing Director. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Brett, please go right ahead.
Hey, thank you. I guess we're going to keep my identity a secret today, so you guys won't see my photo out there. I'm Managing Director of the Americas, and I'm excited to be on today's conference. Hey, just real quick, a little bit about Principal. We're an institutional sales manager offering what I'd say a myriad of interesting and valued ETF strategies. There's three things I'll share with you before I kick it off to Kyle. One, starting with what makes Principal unique, our suite of quantitative ETFs. Hey, they're based on decades of research and experience, so investors will benefit from a proven, disciplined, rules-based investment process. We're not new to active ETFs. We started this important endeavor 10 years ago, so you get real experience in this new world. Number two, just a quick shortcut on what we're going to talk about today, Principal Small Cap ETF, or PSC. High level, this is an active ETF. It combines three factors: quality, momentum, and value, that manages out low-quality businesses while selecting profitable companies with strong cash flow and balance sheets. This is very different than an index approach that likely holds 25 to 35% unprofitable companies. Big difference. And then number three, it works. It works. It has delivered outstanding peer indexed outcomes and gathered over near 2.5 billion in AUM. Finally, our speaker. Kyle Johnson is the portfolio manager and our speaker today. Along with managing PSC, Kyle leads our quant team and has been with the firm for more than a decade. Kyle, welcome to the call.
All right, thanks, Brett. You guys can see the slides and me are coming in okay. And Brett, I'd like to, highlight, we've been doing these for more than 10 years. PSC is reaching its 10-year anniversary on September 18th. Okay, so PSC's turning 10. A little bit about Principal asset allocation. We're over a $200 billion asset manager, primarily focused on target date and target risk assets, but I manage quantitative equities within that. And what we think is these equity solutions, they fill they fill a portfolio gap. And we think that if they fill a need for us, they fill a need for other people, because after all, we are all asset allocators in some level, right? With specifics to PSC, it's a small cap equity product. Asset class studies have shown that it pays to be active within small cap. Managers like myself can add value through security selection above and beyond that of the index, right? And some of that is, as Brett mentioned, due to the just volume of unprofitable companies within the index. Right. Spend a little bit of time talking about why small caps, right? I've heard clients ask from time to time, why should I have small caps, right? Should I just be invested in private equity or private debt? We believe that those are valid asset classes, But why would you not invest in the same companies that private equity and private debt invest in, right? But with more liquidity and a similar return profile. In addition, right, if you have emerging market exposure, if you have global developed exposure, and you don't have small cap exposure, you sit and ask yourself why, right? Small caps have had higher performance over the last 10 years than either developed or emerging markets. Okay. The third thing that you want to keep in mind is that small caps can be valuable. So it's important to stay invested over a market cycle. So what does PSC do, right? We take fundamental concepts and we systematically apply them. And, over time, we believe that active management adds value, but sometimes can be cost prohibitive in the small cap space, right? PSC helps to address that by having a systematic process which scales very well. And we have a 38 basis point net expense ratio, right? And so we can select similar stocks in a similar way to that an active manager does, right? We start with a screen, and that selects for a few multi-factors that we believe, proprietary multi-factors that we believe have efficacy over time. And then we construct a portfolio around that, right? Our portfolio construction process, and we'll get into this, helps avoid fundamentally distressed small cap companies, and our active rules-based framework helps to ensure a consistent approach is implemented through market cycles. Okay? And our back testing indicates that makes a lot of sense. So how does this framework work, right? First, we start with a market cap weighted index, and we screen out a set of illiquid securities. This ends up being about 500 securities, but not a lot of weight, right? And so what this allows the product to do is it allows it to scale a little bit. It allows it to scale and allows for a lower transaction cost implementation, right? And so when we built this, we've had some success, but when we built it, we were thinking about what are the problems that happen when small cap products begin to get to scale, right? Then we have after our liquidity screen, we have a multi-factor methodology, right, which scores companies based on proprietary metrics that we bucket into three factors: quality, value, and momentum, right? I think the high level way to think about this is you're buying companies that have earnings that have positive earnings and are growing earnings, that's quality, at a reasonable valuation, that's value, right? And that are getting some form of market recognition, right? And that's momentum. We have our own specific implementations of these that add value, and we'll talk through that. But high level, that's the concept. And then we take the securities that pass, that have favorable quality, value, and momentum characteristics, and we rank these companies within sectors to create a final multi-factor score, okay? And then we calibrate stock weights to favor more liquid securities within a sector, okay, and remaining sector neutral. So again, we end up with security stocks that have the most favorable quality, value, and momentum characteristics within a sector, right? And we're emphasizing higher liquidity at 2 points in the process, okay? At our rebalance process, we limit stock weights to 70 basis points, so we're not overemphasizing one security or another. This leads us to have a very diversified portfolio, which holds about 500 securities over time. This diversification allows us to effectively express the factor and return characteristics, and let those characteristics shine through in the ultimate returns. Talked about our liquidity selection process, right? The securities that are in PSC, the median security is twice as liquid as that in the Russell 2000, right? And what that allows us to do, right, that lowers transaction costs, that allows us to, and that allows you and us to trade more efficiently in the product, right? And transaction costs are real, and we want to be cognizant of those. Okay. So talk a little bit about, I talked about these three factors. I'm going to do a little bit deeper dive on why we think that they're a little bit unique. That they're unique and they're a different representation than might be elsewhere. Okay, these factors themselves. They're backed by decades of economic research or decades of academic research, and we've combined different elements of academic research to define these factors themselves. Right. So first, we'll start with quality. Right. We have 11 different factors that within our quality framework. Right. We call it pricing power, and what we think of quality as is sustainable growth, above average profitability, and durable pricing power, right? And we emphasize earning stability. What we think that does, and what that does over time, is it emphasizes ability to grow top line and bottom line, which indicates a resilience to inflation. Okay. If you're a profitable company, you're doing something fundamentally different than other companies, right? And then we want to look at companies that are growing their top line. You could have a very profitable lemonade stand, but if it's only going to be a lemonade stand, if it's all it's going to be is a lemonade stand, that's not terribly attractive. Okay. Value. We think about value a little bit differently than your traditional academic or the traditional value that people will talk about, right? When value in some ways is talked about, it's like a book yield, right? And that is it's based on a large pile of assets. And we don't think that that's an appropriate way to quantify value, right? We think about value from a shareholder yield standpoint, right? Which is a total return to shareholder, either stock buybacks or dividends, okay? But we balance those, right, with a focus on improvement and sustainability of those shareholder returns, right? So you have to have free cash flow, and you can't be too levered, and you can't be paying too much of your cash flow in the form of shareholder returns, right? So we take a balanced approach that's somewhat different than maybe your traditional large pile of assets valuation approach, or a deeper value approach, if you will. And then third is momentum. We take a multi-period approach, right? 13 distinct periods that emphasizes active design and evolves around shifting market leadership, right? So we emphasize intermediate term momentum while avoiding long-term reversal, right? We know that trees don't grow to the sky, okay? So, those really long-term winners, we can generally stay away from. All right. So I'm going to talk about what this looks like from a portfolio construction point of view and what the end portfolio looks like. So on the left, I'm going to start with the Russell 2000 index. In the middle, I'm going to go and talk about what the refined universe looks like. So after we take out those liquid securities, and on the right, we're going to talk about PSC. Okay. If you compare the Russell 2000 with the refined index, what you'll see is that the refined index looks very similar to the Russell 2000, right? And what that means is that we're not materially altering the index after we take out these liquid securities. When you look at PSC, you can see the value add in PSC is from the fundamental rules, right? And so what you'll see is that these fundamental rules, what they do is you get more efficient companies, higher ROA, higher ROE, right? Which are more profitable, higher operating margin, are growing their profitability faster than the index, operating margin change at 9% versus flat or to down for the index, right? That is growing top line both faster historically and forward, sales growth, and growing earnings faster both historically and forward, right? And what we believe is over the long term, prices follow earnings. And what we're doing is we are systematically identifying companies that are higher earners, that are growing their earnings faster than the overall universe, that are growing their top line faster than the overall universe, and are more profitable. All right. With that, my computer had some wonderful technical issues. Give me 1 second. And the application just closed. That was sweet.
Kyle, would you like to simply answer questions? We've got a lot for you.
Yeah, why don't we go to questions? That's a great opportunity.
Good idea.
Absolutely. After years when market leadership was dominated by a relatively narrow group of very large companies, we've recently seen much broader participation. What has fundamentally changed for U.S. small caps, and what do investors need to understand about this part of the market today?
Yeah, good question. So we're in a portion of resurgence for America, and we've decided to bring back a lot of manufacturing. We've decided to bring back a lot of jobs to America, and the U.S. small caps are more sensitive to the U.S. economy overall, maybe less sensitive to the global economy, right? And that coupled with the thought of the market desire of lower rates, we think that this is a very attractive time for small caps. And we've seen that the index is up, 40% over the last year. 25-30% above, the large cap indices. We think this is the confluence of those things makes it very attractive time for small caps.
Small cap indices contain a remarkably wide range of businesses, from profitable niche leaders to companies that are still losing money. And recent data suggests a significant portion of the Russell 2000 remains unprofitable. Does that dispersion make small caps especially fertile ground for a systematic quality screen? And what does quality actually mean in your framework?
Yeah. Again, we think that over the long run, prices follow earnings, right? And so we want to have a tilt towards companies that have positive earnings, but it's not just having earnings that's important, right? You want to have positive trends in your underlying fundamentals, right? And so within our quality factor, we think about it, we call it pricing power. We think about it from a pricing power standpoint. And so you want to be able to grow not only your bottom line, but you need to be able to grow your top line as well, right? If you're a very profitable company with, $100 million a year of sales, right? But you're not growing at all, that's not terribly attractive, right? We also want to be able to screen out companies that really pop in a profitability in a short term and are not necessarily able to pass on prices in the long term to their clients, right? We want to be able to identify things that people are doing, things that companies are doing fundamentally differently, right? So they're able to pass on prices through inflationary cycles and grow their top line.
Interest rates are another important dividing line because smaller businesses can be more dependent on external financing and floating rate debt. How does a higher rate environment affect the opportunity set, and can balance sheet pressure actually create better differentiation between financially strong and weak small cap companies?
Yeah. Small cap companies are, more financially sensitive than their large cap counterparts, right? You can see that they generally have a higher beta, right? And they generally borrow at higher rates, sometimes shorter maturities and sometimes in floating rates, right? And so, yes, they are more economically sensitive, right? And that cuts both ways. In rate rising environments, they tend to perform a little bit less well. In rate cutting environments, they tend to perform a little bit better than their large cap peers. We take into account debt levels and overall ability to continue repayments to shareholders in our value factor, right? And so, all else equal, we do want to be somewhat cognizant of companies, of the debt level of companies. Having some debt is not necessarily a bad thing. Being overly indebted can be a warning sign, and doesn't mean it's always bad, but it can be a warning sign.
Kyle, PSC combines quality, momentum, and value rather than relying on any one factor. Those signals can sometimes point in opposite directions. A cheap stock may have deteriorating fundamentals, while a strong momentum stock may have become expensive. How does the model reconcile those conflicts, and what combination of signals tends to be most compelling?
Yeah. So again, we take quality, value, and momentum, and we equally weight them. It's relatively easy to take a back test and do some factor timing. It's easy in the back test environment. It's much more challenging out of sample. Okay. So we think that is, we think that equally weighting is the right approach. Again, we combine them because, and a lot of times, like you said, a security will have strong value characteristics, but not so strong on the quality and not so strong on the momentum characteristics, right? And we know that each of these things is a relatively weak learner, right? But together they get much stronger. And so what ends up, obviously, the most favorable is you have very strong momentum, you have a very good quality score and a very good value score, right? That's probably the most favorable. But generally, if you're in the top 30% of each, you're in the top decile of the resulting score. If you're in the top decile of one and somewhere in the middle of the other two, you'll probably be in the top 30% of the resulting. And so what we're really trying to avoid is something that's really spiky in one area and really negative in one or two of the other areas.
Zeta Global is currently the fund's largest holding, and it sits at the intersection of AI, data, and digital marketing. The company has recently emphasized the evolution of its AI strategy and relationships with technology platforms, including OpenAI, Snowflake, and Palantir. What is the model seeing in Zeta today, and how do you distinguish sustainable operating momentum from enthusiasm surrounding the broader AI theme?
Yeah. So Zeta Global has very strong momentum characteristics, right? And they have reasonably strong valuation characteristics because of their free cash flow, right? And so those elements are coming through in our model. With respect to their the specific business model, we run a quantitative process, and so we're not terribly familiar with like the specifics of the underlying business. We trust our process, And in this case, right, it's our largest holding, which means that it's, it's run quite a bit. And so we've been in the right place. We've been in the right place with that holding. Again, I think that this helps to demonstrate, this helps to demonstrate the resilience and the, the positive characteristics of our diversified approach, right? And so we own a number of securities. We own around 500 securities, which means that we are able to be broadly invested and catch a large part of themes that have developed, like AI over the previous 2 years, but other themes that have in 2022 we had kind of the burn off of COVID, and that was a very favorable period for us.
The portfolio also owns Freshworks, which is incorporating AI into customer service and employee service software while restructuring parts of its own workforce around automation. Software investors are debating whether AI is primarily an opportunity for incumbent application vendors or a threat to their existing economics. How does your framework evaluate a company when technological disruption can improve productivity and threaten the business model all at the same time?
Yeah. I think what our framework would do, we look at a couple different things, right? We look at like market recognition of that, of the company's progress, right? So we look at momentum, right? And then we look at what the company is able to return through their financial statements, right? And so, if they're getting threatened by AI, right, if they're successful at it, right, they should be growing top line. And if they're implementing their cost initiatives, right, they should be getting higher margins, higher operating margins, and a little bit higher profitability, right? And so we look at a combination of, of market recognition, so momentum itself, and then how that is flowing through to company fundamentals. And we believe, over the long term, that is a helpful sign.
With roughly 490 holdings, this is clearly a diversified portfolio rather than a collection of a few high conviction bets. How do you translate the individual factor scores into actual position sizes? And where do sector, liquidity, volatility, and benchmark relative risk enter the portfolio construction process?
Yep. So again, we have our multi-factor score, right? And then we sector neutralize that score, and then we buy securities that are generally in the top 20% of that score, and then there's some lagging for turnover purposes. We take those sector neutral scores and we weight those according to liquidity, right? And so, we're favoring more liquid securities that we can get in and out of, and are not terribly expensive for us to trade or for, clients of the ETF to trade, right? That tends to align with larger benchmark weights. And then we cap individual holdings at 70 basis points, which is how you get to that, larger diversified, much more, 500 holdings. Yeah.
Now, because the strategy is rules-based, what ultimately triggers a sell? Is it usually deterioration in quality, valuation becoming less attractive, loss of momentum, changes in relative ranking, or some combination? And how do you prevent excessive turnover when factor signals move around quickly?
Yeah. So generally, you have a deterioration in one or more of those signals, right? Which, would prompt a security to be traded. We have a process that creates a model portfolio every week, right? And we compare our held portfolio to that model portfolio. as that model portfolio, when that model portfolio has materially drifted from our held portfolio, we will trade to that model portfolio. Okay. That generally, as we were building this product, we took into account how often we want to turn over and that sort and those characteristics, and we intentionally built our factors to be a bit slower moving, right? And so we tend to do a full rebalance every 3 to 6 months. So 2 to 4 trading periods a year, right? And so it's a combination of, you slip in a combination of those factors, a combination of those ranks, and our total portfolio construction process.
Thank you very much, Kyle.
Yeah, I do want to
thank you.
highlight.
Yeah.
Thank you very much. I do want to highlight the last deck that we didn't get to, the last slide that we didn't get to. PSC has outperformed its peers in 97% of periods on a 3-year rolling basis, right? Since inception. So it's going to be, 10 years since then. So this is, it's a process that works and has a high batting average over time. All right.
Thank you very much, Kyle. Thank you for that. For additional information about Principal and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Aptus Capital Advisors. Presenting today will be Head of Equity and Portfolio Manager David Wagner. But before David begins, I'd like to share an important notice with you. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. David, please go ahead.
Craig, thank you very much for that introduction there. It's funny that you started this with a disclosure because I also have to start with a disclosure, but one that's very different than one you gave. Mine has more to do with my personality and how I present. My compliance department, my lovely compliance department always says, Dave, you got to give a disclosure. So this is me disclosing that I am who I am. I have lots of opinions. I don't cuss, but when you hear me present, you're going to get the real me and my thoughts. And I think the best way to describe that is that, I think it was Ronald Reagan or one of the presidents said, I want a one-armed economist, because whenever you talk to an economist, they always say, here's what I believe, but on the other hand, this can also happen. Well, I think when you speak with me, I hopefully I am that one-armed economist, because I have lots of convictions. I have lots of things to say. I got a lot of problems with people, in the words of George Costanza's father in Seinfeld, and you guys are probably going to hear him here right now. But I think that is just a great characteristic of Aptus as a whole, is that we try to bring a lot of different conviction and a lot of different ideas to the table that are somewhat non-conforming to a lot of the different opinions out there in this market. So I'm going to share my screen here, 1 second, and we're going to go through all of the slide deck. But talking about what Aptus is and who Aptus is, we're probably very much unknown, to be honest, in the eyes of many people, but we are a firm based out of LA. And while many think that stands for Los Angeles, it certainly doesn't. It stands for Lower Alabama, in the words of Bocephus. And I think a lot of y'all will probably think when you think of Aptus Capital Advisors, I want y'all to think that Aptus Capital, they're known for derivatives and options investing, that they're very innovative in the active ETF space, which I firmly believe that. But you may question our knowledge when we start a firm like that out of Alabama, not a Chicago, New York, or the other LA. But our founder, he's from Alabama, and his wife's from Cincinnati, where I'm based out of. And she went down to Fairhope and visited one weekend and said, hey, JD, John David, this is where we're going to be living. And that was just a fight our founder, JD Gardner, just wasn't going to put up. And that's where we started Aptus back in 2013. But in a quick backstory, we run about $7 billion in active ETF revenue. active ETF assets, pardon me. We have about $14 billion in AUM, about $50 billion in AUA. But all of our ETFs, except for one, do have a derivative-based aspect to them. We're a firm believer in long vol here at Aptus, not so much short vol, and I can explain that here momentarily. But again, when you think of Aptus, I wanted you to think of that, from an options-based perspective, we're not a calendar-constrained shop. We do have buffers out there right now, but when we created our buffers, we have ladder versions. We create them at 1/3 the cost at the majority of our peers because, when we think of Aptus, I want you all to think that we're trying to do what we think not only is best from an investment standpoint, but from a fiduciary standpoint. I think the buffers are a great example of that. Because, a buffer in a nutshell, if it's not in a laddered form, it's basically one trade per year. And we just don't understand why a lot of people, pay 80, 90 basis points for that. So we charge 25 basis points. And the best way to say that is like, hey, where do you buy your Cheerios? Do you want to buy your Cheerios at, Trader Joe's, or would you like to buy it at Walmart? Well, we want to buy it at Walmart because it's the exact same product in both spaces. But kind of getting into the two topics of discussion I have for y'all today, I'm going to be pitching a stock on the first half, but on the bifurcation on the second half, I actually want to talk through one of our strategies. It's our largest strategy. It's a collared investment strategy, about just under $3 billion in AUM. But let's talk ChemMed, okay? ChemMed is a firm based out of Cincinnati, and I would say most of you probably haven't heard of it, but its ticker is CHE. And while probably many of the new hipster investors out in this world want to call it like Che, like Che Guevara, that's far from correct. Though the company does have to deal a lot with different types of death, given their hospice business. I just think the only difference between them and Che Guevara is that you're likely not going to have any type of guerrilla warfare attacks on this company from a volatile earnings perspective. I've been picking stocks for about 13 years now, and the management team I absolutely love here. There's a lot of consistency to this business. But the only guerrilla warfare attack that you're probably going to see here is probably from a few activists. They've had activists, come at them, I think, multiple times over the last 10, 12 years. And I like to call activists ankle biters, specifically in this situation, because what a lot of these ankle biters try to do with the stock ChemMed is that they want the ChemMed to spin off one of their businesses, because ChemMed, it is a conglomerate. All right, it has two completely different companies underneath the umbrella of it that have nothing to do with each other. The first one is going to be hospice through Vitas, and the second is going to be a drain cleaning company through Roto-Rooter, which is more of a brand name. But yet it has quietly compounded shareholder value really over a few decades. So Vitas, it's the healthcare side of the business. It's the largest hospice and palliative care provider in the U.S. It's the majority of ChemMed's revenue and profit, and they basically just get paid on reimbursement, mainly through Medicare. And then Roto-Rooter, yes, it's a plumbing and drain clean company. It's franchise and company owned across North America. But on paper, yeah, it is a random conglomerate. But I think if you look closer, there's real logic to this. Both are essential businesses. They're non-discretionary businesses, specifically on the services side. I mean, no one chooses hospice care. No one chooses, one of their plumbing pipes to get burst. Like, it's basically a need it now type of service that they provide. And both those businesses, they're very highly cash generative. They have low capital intensity relative to revenue. Both sit in fragmented markets. So they have scale and logistics that I think creates, real advantages. But more importantly, together, like, they diversify away from their pure healthcare risk. So while Vitas gives Roto-Rooter like the cyclicality, from a demographic counterweight, Roto-Rooter kind of brings a lot of cash flow to the table. And then the management team just allocates capital to whichever segment actually has the best opportunity for return. So we're talking to kind of three pillars of the company of what my bull thesis is. Like, obviously, the first one on the Vitas side, it's all going to be about U.S. population aging. The 85 plus group, the cohort that's most likely going to need some type of hospice, it's growing faster than the population as a whole. That trend holds at least probably for the next decade, in my opinion, as then the baby boomers generation really starts to move in. And hospice utilization, that in itself has actually been structurally rising because there's been more awareness. You have more physicians referring earlier, which is great for the company. So like Vitas, they don't have to win market share to grow right now. It already has this multi-year demographically locked in demand curve underneath it. And that's rare in any type of industry, in my opinion. Now, on the second pillar, like if you look at, sorry, I'm not good at moving slides, but if you look at, Roto-Rooter, it's recession resilient. Obviously, it doesn't get like the multiple that VITAS, the hospice side, is going to get, but it doesn't need to because of its resilience around recessions. Like pipes, they don't wait for the economy to recover. Then they have these like kind of a franchise-based core here that has high margins, low capital needs. Then, of course, some steady cash flow that really funds buybacks and actual reinvestment back into VITAS. So, like, that's not a huge growth story. You're getting GDP plus, 4 or 5%, but that's the ballast of the portfolio for the VITAS side to grow. And I think one of the cooler things I've seen with Roto-Rooter is a few years ago, some Japanese private equity tried to buy a bunch of their franchisees in San Diego and LA at like 3.5, 4 times EBITDA because they wanted to spin it because that was such a cheap EBITDA that they could get in this type of business. But they didn't have the scale from a technological aspect that Roto-Rooter has. So they actually sold those franchisees back to Chemed basically at that same valuation in its own. And then you got Chemed trading from an EBITDA standpoint at like 16 times, and they're buying these franchises back at 4, 5, 6 times. It's just directly accretive. But I think the third pillar is probably my most excited pillar or bull case I have for the stock because it all comes down to absolute great capital discipline. Like what Kevin McNamara has been able to do over there since 2001 when he became president and CEO is unbelievable. Like just look at their buybacks. They have absolutely unbelievable consistent buybacks, obviously driving lower share count over time, a direct tailwind to earnings per share. They also have a growing dividend, though modest, but they have very, very low leverage and a conservative M&A playbook. They don't do these really large dilutive deals to try to show off. They're just a very simple, steady Eddie company that buys back shares, grows their dividend at double digits. And it's kind of a company, that treats free cash flow, really like it matters because in my mind, it absolutely does. And it reminds me a lot of how, I think his name was like Henry Singletary of Teledyne. He was spoken about in this, profiled in this book called The Outsiders like 10, 20 years ago, where he built this sprawling 130 business conglomerate through aggressive 1960s acquisitions. But then he basically abruptly stopped acquiring and instead ran some of the most aggressive share buyback programs in any type of corporate history. I think he retired like 90% of his shares. Well, he never paid a dividend like Chemed, but both companies, Teledyne and Chemed, they run this radically decentralized way with capital flowing purely to the highest returns. And I think there's a Venn diagram of those two companies that kind of overlap from a notorious standpoint, like a moon, I forget, a lunar eclipse or something like that. But Chemed valuation, I think they're cheap. I do want to talk on like the devil's advocate here because the stock has performed well lately, but over the last 5 years, it probably has underperformed amongst my expectations personally. And I think, the understanding what's gone wrong with the stock over the past few years, kind of looking through the rear view mirror of your car. If you look through the windshield, I think it really gives you some opportunity where you can continue to get some type of valuation expansion in the company. Well, VITAS had its own problems. They've kind of worked through it. They had some trouble with this aggregate Medicare cap rate, specifically in Florida, but the company's been very proactive there to buy more, hospice sites to increase the footprint so they can have that cap actually raised. And I think this past 2 quarters, honestly, have really started to show it. I think that where the black eye is, because all small cap companies, they have a black eye. And I think it is actually on the Roto-Rooter side of the business right now. Because they've had trouble, garnering share on Google. Google continued to change their algorithm. Like if you type in plumber, Roto-Rooter is the brand name. Like everyone knows it. Like there's other companies out there that copy the Roto-Rooter name, like Mr. Rotor or Mr. Rooter, because they are the brand name of the business. But Chemed has had difficulty trying to figure out the algorithm to always have their name float to the top of the list. Previously, it was all about, who pays the most. But that algorithm continues to change over the last, like every 2 weeks, that algorithm changes. So they put a lot more money into kind of this AI focus of figuring out how to best utilize the algorithm to get towards the top. And while they know it's going to cost some money, I think I talked to McNamara, the CEO, Kevin McNamara, like 2 years ago. And he's like, for every click we get on Google, it's like, it costs us like $70. And I'm like, oh my gosh, Kevin, that Mr. CEO McNamara, that's such a crazy high amount to pay for every single click. But honestly, if they get clicked on, that means there's a plumbing problem going on with that, whatever user is utilizing Google to look for a plumber, where, you know, the return on invested capital of that $50 to $70 is pretty high, because just for that plumber to walk into your house, like, you're getting charged $150 to $200. So they're fine paying that amount. They just need to make sure that their names still drift to the top. So you've seen margins get hit a little bit. You've seen revenue start to inflect back a bit here, but I really think that's where you can get some type of valuation expansion back to levels that I would think are proper for this company, which is about 20 times EBITDA, and I would say about 20 times forward earnings. But to sum it up, like, Chemed, they pair this demographically driven healthcare business with a recession resilient services business run by a management team, Kevin McNamara, with a real track record of disciplined capital allocation. It's just a story that doesn't get the headlines. It's a story that just gets compoundings over longer periods of time. So if you don't know Chemed stock, take a look at it. It's one of my favorite stocks right now, and it has some pretty good momentum. So I'll stop there to see if we have any questions before we go on to my second topic.
Absolutely have questions for you, David. Smaller companies have had to navigate higher financing costs, shifting economic expectations, and a market that has often concentrated investor attention in large cap technology. What has changed fundamentally in the small cap opportunity set, and where are you finding the greatest disconnect today between market perception and underlying business fundamentals?
That's a great question. So let's go back to the first line of that book, Animal Farm. I always say Animal House, but it's Animal Farm. Like, all animals are created equal, but some are created more equal. And I think that that's very synonymous to what's going on in the small cap land, because it's like all animals, specifically the lower quality stocks in small cap land, are actually being treated not just equal with the high quality, it's actually higher from an equality standpoint in my mind. And that may surprise a lot of people given the interest rate backdrop in small caps. Small caps, they tend to very much have a balance sheet that's more encumbered than their large cap peers. About 30% of the debt on the aggregate balance sheets of all small caps is floating rate, which tends to be very much shorter in duration. So that's me saying that small caps are going to be a lot more sensitive to interest rate movements. And just yesterday, you know, we had the 30-year US Treasury hit a level not seen since 2007. So many probably are pretty surprised that small caps are performing so well right now, outperforming their larger cap brethren. But more importantly, not only that, I think the lower quality stocks that tend to have more debt, more floating rate debt, they're absolutely crushing it this year. They've actually been crushing it probably for the last 2 years. And I think that's caught a lot of people by surprise. So I think if you're looking forward as a small cap investor, and Chemed fits this narrative perfectly, like, I want to invest in high quality stocks. Like, I know that's no different than any active manager out there right now. But I think that bifurcation right now of high quality and low quality is at a level where I think a lot of investors could make some pretty good money by going back into compounders and outside of these more risk on, you know, not profitable, not dividend yielding types of stocks out there in this market. The last thing I'd say, Craig, before I pass it back to you, is like, the small caps do get a valuation discount right now. Historically, they've traded a 4% premium to large caps. Now they traded a 30% discount. And I think kind of the cloud over small caps right now relative to large caps is, well, in large caps, they have operating leverage as their core tenet of one of their characteristics, given the tech weighting there. Like, small caps are more focused on healthcare and they're more services based, so they don't have operating leverage. But private equity is definitely, I think, kind of played around with you know, the new opportunities in small caps. And I think that's why you've kind of seen this discount really occur. So while not a lot of people want to play small caps from a mean reversion trade because they're trading at such a substantial discount, I think when you see the forest through the trees, that small caps have actually just been re-rated lower, and this is kind of the new norm relative to large caps. So I think the areas of opportunity are going to be in higher quality small caps, not the lower quality small caps. So I'd be very more active in this space right now.
Why keep Vitas, which is hospice, and Roto-Rooter, which is plumbing, under one roof when they share no operational synergies? What's the strategic rationale beyond it's always been this way?
Yeah, I mean, I spoke about the ankle biters the activists that I call ankle biters. This is really why they come after the stock. Like, if they really spin off this company, like, congrats, like you got a few turns difference maybe in valuation, like, but the Chemed is not, investing their hard and free cash flow just for a few turns difference. I mean, if you talk to Kevin McNamara, their CEO, like he always, talks about how people want this. Okay. But like Roto-Rooter's steady and recession resilient cash flow, like it just acts as, a stabilization counterweight to VITAS's exposure to Medicare reimbursement risk or the regulatory scrutiny, or even that hospital ag cap that I spoke about earlier. VITAS on the other side of the equation, they offer this higher growth, demographically driven upside that a pure plumbing company couldn't provide on its own. So I think a spinoff would leave each entity more exposed to its own specific sector risks. I mean, like Roto-Rooter's cyclicality without a hedge is what they'd be, or VITAS's reimbursement volatility without a cash generative ballast from Roto-Rooter. I think that would just not look great from a valuation or volatility standpoint. Then you obviously have the standalone costs. But I think that, management just has shown, a consistency preference for capital discipline over structural reshuffling, suggesting that they view diversification and cash flow smoothing benefits as outweighing any type of multiple expansion argument analysts might make for unlocking some type of, segment specific valuation through that stock split.
How does the stock's current multiple compare to A, pure play hospice peers, and B, local services roll-up peers? And does that gap suggest the market is already assigning a conglomerate discount?
Yeah, absolutely has. I would say that they've always kind of received some type of valuation discount, but that goes back to what I just spoke about there, Craig, on like the stock, the company trying to split or spin off, pardon me, is the proper term that I was missaying there, the stock in its own. Like, so if you compare each two businesses to the respective peer categories, they are getting a little bit of a discount underneath the hood. Like if you look at like your Addus back in the day, AMED before is acquired, they're trading closer to their peers at 23, 24 times earnings. Chemed is at 20 times right now. So maybe a 3-4 turn discount, so 15% discount. On the Roto-Rooter side is actually probably where you see the larger aspect of a valuation discrepancy or discount. Like they always compare themselves to Rollins. Like Rollins trades at 30 times forward earnings. It's actually seen a lot of multiple compression over the past year, usually traded at like 45 times, while Chemed has actually seen none. I think over time, like once you get both sides of the businesses working for you, because right now like VITAS is working well, Roto-Rooter is trying to drag itself out of the mud of that Google problem I just spoke about. Once you get both firing on all types of cylinders, obviously they're still going to protect capital and some type of volatile downside. I think if you get both segments working together, you actually do have some firepower and leverage on both sides of the business to participate in up markets, because this is a defensive name, don't get me wrong, where you can at least get some more participation on the upside through that valuation expansion.
Your process puts emphasis on dividend yield plus dividend and earnings growth, rather than simply buying the highest yielding small cap stocks. What does a dividend tell you about management, discipline, and business quality? And what warning signs tell you that an attractive yield is actually a value trap?
I think a lot of people would say like, hey, we want to invest in small caps for the firepower. So we don't want some type of dividend component to the strategy that we're owning or the stock that we're on, because we want that, equity risk premium there for some type of growth. But, Craig, if you actually look at historical figures over longer periods of time, small cap stocks that pay a dividend, they actually tend to outperform those that do not pay a dividend. And if you actually pair that with a lower valuation, those two factors combined outpace each of those factors on a standalone basis. But the best way for me to describe like why I want dividend payers in small cap land, it's actually very simple. Because once you start to see these companies get of size, like they tend to be kind of founder-based style companies, but the founders, want to retire because they've now IPO'd, which probably hasn't happened lately, but they've at least graduated higher up in market cap where they pass the baton off to some type of new CEO that wants to prove themselves. So I think having some type of capital allocation policy, specifically through dividend years or overall shareholder year, I guess I should say, is really going to kind of handcuff a lot of management teams because they don't want to cut the dividend. So instead of having to cut the dividend, like they don't have the amount of capital at their resources and arrow in their quiver to go out and waste it on some type of low IRR project through some type of bad acquisition or through some type of bad project. So I think it really keeps a lot of these CEOs very stabilized in what the core bailiwick of their business is. Because one of the worst things I tend to see out there in this industry is that when a new CEO comes into place, specifically after a long-running CEO was in place, like they want to make themselves known by making some type of large acquisition, specifically when it steps outside of the realm of their specialty or bailiwick. That tends to be, bad news bears for that stock. So I love the capital discipline that comes with the yield that keeps the management's decisions in check.
Financial companies remain an important part of the portfolio, including regional banks such as Stockyards Bancorp, Seacoast Banking, Enterprise Financial Services, German American Bancorp, and Wintrust, as well as insurers and financial services companies. What are you seeing in credit quality, deposit economics, and loan demand that separates the financial institutions you want to own from those that you avoid?
I have a saying here at Aptus is that bears sound smart, but bulls make money. I think that a lot of the bears out there in this market want to talk about the degradation of the consumer or the degradation of credit quality. Like I'm simply not seeing it out there. And I think, we're pretty, at least here at Aptus, we're very optimistic about the economy. We're actually more optimistic about risk assets such as stocks, given the backdrop of debt and the monetary and fiscal policy. That's a conversation for another time. But a lot of the banks that we own specifically here in the small cap strategy that I run, Opus Small Cap Value Active ETF, ticker OSCV, you're going to find the banks that we own in, areas of the country that are having more demographic or population growth. Like you mentioned, Seacoast Banking. Okay, that's down in Stuart, Florida. Seen unbelievable population growth, and yet they're a small bank that's kind of on the forefront of different technology. So you've recognized their efficiency ratios have definitely come down over longer periods of time, something that I love to see. But no, if you look at underneath the hood of all these different small cap banks that we own or community banks that we own in OSCV, like credit quality, strong, loan growth, strong, deposit growth, strong. I'm not seeing really any credit-worthy events on the near-term side. Obviously, a lot of the credit conversations we have here in this market now pertains to, private credit and their exposure to SaaS companies or even AI companies that are seeing their CDSs expand right now. I'm not seeing it on the small cap or community banks right now.
Roadhouse is another major holding, which is interesting because restaurants are exposed to wages, food inflation, and discretionary consumer spending. What does Texas Roadhouse demonstrate about the type of consumer company that can pass your quality, growth, and valuation tests, even when the consumer environment is uncertain?
I'll be blunt. We just want to own the stock because we love restaurants where we can throw our peanut shells on the ground. More tongue in cheek there. But no, Texas Roadhouse is man, it's kind of like the outlier in regards to different restaurants you've seen out there. You've seen some restaurants on the large cap side actually outperform here lately, but Texas Roadhouse just is one of the few restaurants out there that has been a long-term compounder. And I think it's just because they have a very much differentiated model. I think one of the surprising facts we talk about Texas Roadhouse is that I think the average revenue driven from alcohol sales at a restaurant is close to 30%. Texas Roadhouse is actually very much lower at 10%. And if you do some type of on-site due diligence, which I love Texas Roadhouse, I do a lot of it. A lot of the Texas Roadhouses across the country, they don't even have bars in there. Yet when you go to Texas Roadhouse, there's always a 20, 30-minute wait, and every single table is absolutely, it's taken. But I think the thing that sets them apart is this is a very efficiently run company, even if it's based out of Louisville, Kentucky, kind of the rival town to my college town, Lexington, Kentucky, where the University of Kentucky Wildcats are headquartered. Even if it's based out of Louisville, Kentucky, it's actually run really well. If you look at each single restaurant, how the managers are actually reimbursed or paid for from an execution standpoint is really what sets them apart. It really kind of puts them as the equity owner of their own restaurant, where one, they have a lot of control, but they just have so many different metrics that they need to hit from a revenue growth perspective, a cost perspective, and they're heavily rewarded on their execution. So you actually see a lot of the managers of these restaurants staying around at that location for 5, 10, 20 years. And I think that's the model that separates them from really any other restaurant out there. So they have great growth. They have a great growing dividend. Capital allocation policy is awesome, even with their investment on their side restaurant, Jaggers, that started maybe like 2014. It's a great company to own. The knock is going to be valuation, but you know, Craig, as we always say, price is what you pay, value is what you get. I'm willing to pay a fair price for a company like Texas Roadhouse.
Thank you, David. For additional information about Aptus Capital and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Infrastructure Capital. Presenting today will be founder, CEO, and portfolio manager J.D. Hatfield. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Jay, good to see you again.
Thanks for having me on. Great
You're
to be back.
welcome. Please go right ahead.
Okay, I might need a little remedial help. Is my screen being shared or not? Can you
Yes,
see my?
we can see
Okay.
it. Yes.
Okay, so you can see my slides. Great.
Yes.
Thank you. Appreciate the remedial help. So, Infrastructure Capital, I'm the CEO and most importantly, CIO. This is my responsibility for all of our funds outperforming the relevant indices. We provide ETFs that have substantial income. We have 3 fixed income funds. PFFA is our largest fund, preferred stock, yields over 9. BNDS is our fixed income bond fund. Both of those funds are top performing funds. We also have AMZA, which is our pipeline fund, also yields well over 8%, top performing fund. And then we have 3 option income funds, QVOL, ICAP, which is an S&P option income, QVOL's NASDAQ option income, NESCAP is a small cap option income fund. So that's an overview of our firm. Great way to get good total returns and great income. And it's critical to get total return and not just income. As I mentioned, I spend almost all of my time do some presentations like this. Being CIO, we have a team of 5 analysts, and we do hedge fund style research. So we screen for undervalued equities. If they screen reasonably priced based on a PEG ratio, we will follow the company, do a very detailed model, discuss it with the company, look for third-party information to verify the model. Then it goes to our investment committee. If we decide to buy it, we add it to our portfolio. We have price targets based on PEG ratios, which we'll get into. So we're doing a ton of work on the equities and the preferreds. Also, we have our own proprietary ratings. So we're doing a ton of work for you. We do talk a bit about macro. I'll make this quite short today, but you can see this on our website. It is critical to do macro research because really most individual trades have a macro component to it. You may not realize it. And so if you look at our website, and listen to our webinars, infocapfunds.com. You can get all this data. I'll go through it really quickly. But we are bullish on the market. What really is the key dynamic? There's a lot of bad things. Most obviously the war, straits closed, oil's 80 to 100 in our estimation. I did found an energy company, and we have a pipeline fund, so we keep global data on oil supply and demand. We've been very accurate, so we don't think we'll go over 100. We're kind of range bound right now, 80 to 90 on WTI. So that's not great for the economy. The Fed's going to stay on a hold. Rates will stay relatively high, about 460, which is 100 over Fed funds. But it's not a disaster. It means the market will trade 20 to 21 times. And the key dynamic, which I'm sure you're aware of, but it's worthy of repeating, is we're in an earnings melt up. So we started the year at an 8,000 target, a 23 multiple. That would now mark to market be 9,000, but we're still sticking. We're actually upgraded it to 8,100 because even at a 20 multiple, earnings estimates have risen 16% on the S&P for next year. Our target's at the end of this year, so it's based on next year's earnings. So we are bullish on the market. So all of our equity funds should do well. Our fixed income funds are higher risk, so they should do well. They have already been doing well. So good returns this year, despite the fact that rates are higher. We do not think that high oil prices will significantly impact growth. It is a negative that the Fed is on hold. They should be cutting rates. 30-year mortgage is very high. Rents are down year over year. Their indices don't show that. So that is a negative, but this is such a powerful earnings rally. So don't use the negative headlines to get out of the market. Still a great time to put money to work. And it's important to note, like oil was terrible for inflation in the 70s, but in the 20th century and this decade, oil's not as important. We have much more fuel efficient cars, fuel efficient. We use a lot of natural gas, which is not going up in price in the US at least. So not the end of consumption, a little bit of headwinds for certain companies. We don't do a lot of retail in our funds, so not critical to our funds. Our funds have been doing well, partly for that reason. I would focus on the fact that inflation's actually contained. PC core, highly distorted, will almost certainly be replaced by CPI. PCs made up 30% imputed prices. That's a fancy word for made up or fantasy world. So we're bullish about inflation. We even think the core PC will drop. And the real critical leading indicators of inflation are the money supply, which is negative year over year. By the way, the Fed doesn't follow the money supply. That's why they're fatally flawed. They should have followed it in early 21. They would have realized they needed to raise rates. And we do not think the Fed's going to increase rates. Core CPI is only 2.5, dropped 0.4 in the last 3 months. Run rate inflation is 1.6. The Fed will talk tough rather. They don't like the fact the president's prosecuting 2 of their members. They want to maintain independence. So they're going to be ultra hawkish. So the administration has misplayed the Fed. Warsh is pretty hawkish, but probably being more hawkish to keep the other members at bay and stave off a rate increase. So we have some great data here. The 2% target is one of the Fed's fatal flaws. It's completely made up. The economy is more robust when inflation's 3 to 4%. Don't want to be much over 5, to be fair, but 3 to 4 is great. 2 to 3 would be okay. We're already at 2 to 3. So don't be caught up in this inflation bearishness. Inflation's been bad over the last 5 years, but that's because the Fed increased the money supply 60%. Most of that's behind us. It's not great if you don't own a home and have to pay rent, but current inflation is not a problem. Money supply is down 6% year over year. That's the key indicator. That's why one of the reasons why we're bullish about inflation. I'm going to move through this pretty quickly so we can talk about our funds, which probably people care more about. If you correct inflation for shelter, which is rents, there's this thing called the internet. So if you don't do 70 style um, surveying and actually update the numbers on a real-time basis instead of waiting 6 months, you would see the year-over-year CPI is only 1.1%. So again, the Fed would be crazy with a capital C to raise rates. So that's not going to happen. And the 10-year is not pricing that in. Fed funds is a little bit, but it's not happening. Our rates are very high globally. So a lot of people wring their hands, say, oh my God, the federal budget deficit's high and we're spending money on data centers. Well, we're not spending money on housing, so that's an offset. But that's not the key driver of rates. The fact that we have a pretty big budget deficit is already priced in to the fact that US rates are highest in one of the highest in the world. So key drivers, Fed funds. If oil comes down, the Fed will cut rates and 10-year will come down. Not required, but that could get us to 9,000 this year or early next year. If we had lower rates, we could have justified higher multiples. And I'll wrap this up pretty consistently. You can see, if you don't believe the money supply drives inflation, when money supply growth is below 5, inflation is 2.5. And when it's above 6%, the average is 3.8. So definitely look at the money supply critical. Just another way of looking at the fact that we're, oops, I'm going the wrong direction, sorry. So the other thing is that, like I said, everybody's trying to explain why rates are higher by looking at corporate issuance in the federal government. The 10-year trades 100 over Fed funds. End of story. Fed funds 360, treasuries 460. If you learn this, you'll be a great bond trader. The Fed doesn't seem to be focused on this, but we have a recession. If you look over to the left here in the construction and housing sectors, that's what the Fed impacts. It's another reason why it'd be crazy for them to raise rates, because they're already causing recession in the part of the economy they affect. We sent out sort of a tongue-in-cheek note that said if the Fed wanted to fix inflation, they should invade Carg Island. So in other words, the only way to really lower inflation right now, because keep in mind, high oil prices affect core as well for things like airline fares, but everything has some energy in it. So already recession in structures and housing, but the boom in tech is keeping us growing. Don't stress about the consumer. All recessions come from investment. That's why we're not going to have a recession. We would if we didn't have the tech boom, because housing's in recession and construction. So most people don't seem to know this, even though the data is right there. And then getting into a little bit more of our funds. These are equity funds. So Qball, that's probably our most exciting fund, probably most relevant to people follow RedChip. What's fantastic about this fund is that we get to double curate a normal call writing fund. So there's a lot of well-known NASDAQ call writing fund like JEPQ, QQQI. Even though one of those are allegedly active funds, they have all the companies in the NASDAQ, which you probably may not have focused on, includes Walmart, which was overvalued, now it's getting closer to fair value. It also includes Kraft Heinz, Comcast, Charter, companies that are actually getting hurt by technology, not helped. So we can have either zero or low weights in those companies, mostly zero, the ones I mentioned. Then we can have more Marvell. Marvell is one of our big overweights, more of Amazon and other great companies. So we curate the actual weightings of the NASDAQ, exclude the dogs of what we call the dogs of the DAC. And we write calls, but we don't write index calls. We write individual calls based on both our fundamental analysis and technical analysis. And so check the performance, but our objective with all of our funds is to beat the NASDAQ, not just produce income, but also beat the index If you look at the other call writing funds, they massively underperformed the Qs. So far we've achieved our objective, but do your own work on the returns. And because we've done well, we're likely to be able to increase dividend, no guarantees. We look at that quarterly. And then ICAP's our S&P option income fund, same objective, beat the S&P. We're doing well this year on that objective. In addition, AMZA is our pipeline fund. Great timing this year. Those companies are really undervalued, doing well with the straight closed. Great story on natural gas, growth of natural gas to AI, but also for export. That has a great distribution yield of over 8, distribution yield of ICAP's over 9, distribution yield QVol is over 12, and SCAP is about 8. So great yields. The SEC yield is just the cash coming in, ignores the options we write. So we do get more income from option writing. And our funds are unique, except for QVol, where we do have pretty good income just coming from regulars, common stocks, and some preferreds. So we don't have to write as many calls. That's another reason we have a shot at outperforming the NASDAQ. You write too many calls in a normal market, the NASDAQ's going to be rally, going to get run over by the index calls. If you write fewer, shorter term, and get the better volatilities from individual stocks, you can outperform. Doing pretty well on timing. These are different ways you can generate income from equities. So you can use large cap stocks. That's like our ICAP fund. MLPs is AMZA. You get really good yields. You don't get a lot of interest rate risk, which is nice. If you buy REITs and utilities, you get a bunch of interest rate risk. You also get lower growth. Then you get pretty good yields, although they've gone down. So REITs only 3.6, utilities 2.8. Telecoms, pure telecoms like AT&T and get 5. Large cap dividend stocks only 4.4. But when you add call writing, you can get more like 10. And so what we do is take the more volatile stocks. We do have some income coming in from some of the AT&Ts of the world, but then add option income. So we think that's a superior way, because that way you get better growth and you get the income. And if we do it correctly, we can actually beat the underlying indices. As I mentioned before, if you look at our stocks we hold, they're somewhat driven by the weightings in the S&P and NASDAQ and in the small cap index, but it's driven by our fundamental research where we're covering the companies, have our own models, have our own earnings estimates. So Marvell's our biggest overweight in ICAP and QVol. We have a model. They announced great news on the Google partnership size. We're increasing our estimates so we can stay ahead of the street because we have our own model, and we raised our target substantially to $350 there. But what we do to keep ourselves out of trouble is we look at the PEG ratio, PE to growth plus yield. And that way you don't buy things like Tesla trading at 200 times. You don't buy Walmart. Walmart traded as high as 140 where it had like a 4.5 PEG. So you want to have reasonable PE to growth. That means you're not overpaying for the growth. So that's what we apply to come up with our targets. We recommended Marvell at $90 when it was a half PEG. Now it's closer to a 1 PEG, but the valuation is going to go, or the target's going to go higher because the growth rate's going higher. So you want to have fundamentally cheap companies, not play momentum. And in all of our funds, all of our equity funds, we rate single stock options. That's what you want to do. A lot of work, got to manage the taxes, hard to do on your own if you have a day job. But this is all our core strategy. And we stack the deck in our favor because we use these methodologies, which are hard to implement, but we enjoy doing it. We do it essentially 24/7. And that's what's accounted for our attractive track record. QVol already discussed, focus on the technology part of the QQQs, not the old economy part. Covered calls of individual companies, actively managed with these target ratios based on PEG ratios. If you do your own stock buying, now you can look at PEG ratios just by using Gemini or and whatever AI you use. So stay out of trouble with PEG ratios. And, we do have an advantage over most individual investors because we have enough time to have a model on every company. We talk to the companies because we're big and we have national presence. So if we recommend Marvell on CNBC, they're going to call us back. So we do have an advantage over individual investors, but you want people who do this hedge fund style work on the companies. It's attractive to be in the NASDAQ. I've been adding QVault to my IRA. I have a lot of PFFA too, which is not going to keep up with the NASDAQ. But if we can achieve our objective and beat the NASDAQ, you can see you can get great returns. So it's not, if you want income, you shouldn't have it all in QVault, but you can have some in bond funds like BNDES, PFFA. And then I want QVault because I want this great total return. And this is actual data that shows our fund has a 1.1 PEG ratio, PE to growth. NASDAQ's 1.3, S&P's 1.5, Dow is higher. So great way to find undervalued companies. Just this is data that demonstrates it's more effective to write individual calls based on fundamental and technical analysis. So Marvell, you can get a 90 vol. We actually wouldn't be writing a lot of Marvell calls after this Google announcement, but we did have a few written, but they were at 300, so they're not costing us any money. And we could write them so high because the balls are 90. So you can get much better income by writing fewer calls, so you don't cap your upside. If you look carefully at all those other competing call writing funds, they massively underperform the NASDAQ. So you don't want that. So you want somebody doing this extra work that has a good chance at not capping upside by writing calls. And you can see here in the NASDAQ, you can get a lot of super high PEG companies. They're arguably overvalued, like Costco, Tesla, Apple. And those have been dogs, so we've excluded those. Get more reasonable companies, AMD, Marvell, definitely Google. So don't just buy a company because like I trashed Tesla when it was at 420 on Fox Business, ran into somebody who was also on the show. He said, well, I love Tesla because I love my car. I don't care. It trades at a 5 PEG ratio. So don't buy stocks just because you happen to like the product. Make sure if you like the product and it's reasonably priced on PE to growth, God bless you. But stay out of trouble, use PEG ratios. You don't need all these companies when you buy the Qs. So you probably didn't know that you got, Fastenal, Copart. Perfectly, Cintas makes uniforms. They're okay companies, but not really what you want in your technology fund. Won't get into all this, but you can write these individual calls. If you think about them and curate them, you can get much better total returns. You don't cap your upside. And also we pick companies like maybe the hedge funds are picking on Microsoft. Well, we'll write Microsoft calls at 460 to 500. So we held it at 380. It runs up, but then a lot of the calls have already expired. So we can look where there's resistance technically, where they become fuller valued. So Microsoft's probably fully valued in the 400s. So use that research to write individual calls. Don't write just dumb index calls. The market takes off, you just lose a ton of money. And you can look up the performance. ICAP, same story, using the S&P. So different weightings, different companies, more non-tech. So we have KKR, which is doing well today, and some other companies. So more diversified. Won't spend same thing, great to be in the S&P. Use the same methodology. So I'm going to run through these slides in just a couple of minutes. Pipelines are great hedges, only 0.6 beta, working well with the straight close. Will work okay anyway, probably come off a little, but still you get good income, total return. Could play the AI growth that's undervalued right now. Same thing, we do write calls. long-term good returns. The other thing is that you may have been burned by MLPs 5 years ago. They now have free cash flow. They were sort of like Oracle is now then. So they were issuing too much equity. Hedge funds are picking on them. So they're no longer disadvantaged like that. Lower Ps, better PEG ratios, lower betas. And the tax advantage, you get usually deferred tax on your distributions. And with that, I just mentioned SCAP, same thing, different index. Take individual companies, write individual calls, have good income from even the companies and some preferreds. And this fund yields almost 9, good attractive total returns over inception to date. So if you like small caps, you want income, great opportunity. And with that, we have 6 minutes left. So I would open it up for questions if there's any questions that the moderator has.
Thank you, Jay. Let's jump into questions. Small cap stocks have received renewed attention as market leadership has widened, but smaller businesses are also more sensitive to borrowing costs and economic conditions. What fundamentally has changed in the small cap opportunity set, and where do you see the greatest disconnect today between valuations and underlying business prospects?
Well, you know, we actually, that everybody says that, so I'm not being critical, but we thought correctly that that was a misnomer, that because that was kind of the explanation before this year of why small caps are doing so badly. But it was really just that we were coming out of a Fed rate increase cycle. There's still a lot of risks out there, and large cap stocks are lower risk than small caps. And so then when it became more risk on and became more AI driven, there are a lot of AI derivative type stocks in the small cap indices, and they're not, notwithstanding the notion that everybody repeats, that they're more levered. They're not substantially more levered. They're not more sensitive to interest rates. And so the fundamentals kicked in. There's an opportunity for mergers and acquisitions because they're smaller. You've seen a lot of that this year. Our suppliers do a lot of AI industries. There are semiconductor companies. So it was really just the risk-off environment post-pandemic. Finally got out of that. They've been working really well, plus 20% this year. And still a lot of great undervalued companies. And you should follow RedChip to find them if you don't want to buy SCAP, our fund.
Thanks, Jay. Now, SCAP isn't simply a basket of the smallest companies. It combines dividend discipline with a growth at a reasonable price approach. When you evaluate a small company, what tells you that a low valuation represents genuine mispricing rather than a business whose fundamentals deserve that discount?
Well, that's a great question because, you know, we start with consensus for the screen, and some small cap companies don't have any estimates, to be fair. So it might look on the screen like the P to growth ratio is really reasonable, but then we go do the real work. We come up with our own model, and oftentimes, particularly with small caps, we'll find that the ramp that was implied in maybe just a couple estimates isn't really there. So it is something, given that most of you have day jobs, that it's good to outsource, because you can rely on consensus for like Marvell and Broadcom, but not really for the small cap companies. So it needs to be proven out. And also, you know, we are big enough so we can call a company, verify understanding of the public financial statements. We can afford to pay for alternative information sources. So we can come up with a very accurate model to ensure that the companies are actually undervalued.
Jay, we got time for one more question. The portfolio cuts across very different parts of the economy. Among the current larger positions are Contour Brands, SM Energy, Hudbay Minerals, Huntington Ingalls, Halozyme, KB Home, and former RedChip client Celsius. Is there a common fundamental characteristic tying those businesses together, or is the opportunity today primarily about bottom-up stock selection rather than a single macroeconomic call?
Yes, precisely the latter. So we do look for undervalued companies. Celsius, a good example, has become, it's underperformed, but it's become a takeover candidate. That can be true of small cap stocks, less true. Like Broadcom's off a lot recently. It's, $2 trillion company, not a good takeover candidacy. So we do try to be diversified in all of our funds. Obviously, QVol, you're going to be mostly tech. S&P, not as much. But in SCAP, if you look at the indices, it's very diversified. There are a lot of tech companies, a lot of financials, a lot of REITs. So you're getting a more diversified portfolio than you will get with large caps. And that's one reason small caps have outperformed. They are more diversified. They're more like an equal weighted S&P. So that's another reason they've worked. And that's another reason they underperformed before, because they're not super tech heavy. And so the whole notion about interest rates was incorrect. It was more the industry weightings and not the interest rate sensitivity.
Thanks, Jay. For
Thanks for
additional
having me on.
information, yeah, thank you so much. For additional information about infrastructure capital and its funds, please visit the sponsor's website, where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Vista Shares. Presenting today will be the CEO, Adam Patty. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Adam, are you there? Okay, folks, Adam is on his way in. I can assure you of that. We're just going to bring him up onto stage, and that shouldn't take more than another second or two. Adam?
I am here. Thank you for having me.
Thank you. Thank you for waiting. Let me jump into, well, actually, we've gotten all of that out of the way. And if you're ready, Adam, you can go ahead at any time.
All right. You can see my screen with ammo up.
We sure can.
Excellent. Well, again, thank you very much for having me. My name is Adam Patty. I'm the CEO of a company called Vista Shares. Vista Shares was, we founded around 2.5 years ago. I've been in the ETF business for, since 2002, a long time. Started my first company in 2006, a company called Index IQ, which focused on liquid alternatives, and built that up and sold that to New York Life Investments back in 2015. Spent 3 years there building out their global ETF platform, and then was kind of out of the industry for a few years, trying to figure out a way to get back in, and had the good fortune to meet a guy named John McNeil. John was the former president of Tesla, working in partnership with Elon Musk. Then he ran Lyft. He's on the board of General Motors and is vice chairman of their autonomous vehicle subsidiary, among many other things that he does. What was interesting is that John recognized a big problem with thematic ETFs. And it's something I've wholeheartedly agreed with for many years, is that they're very marketing oriented in general, right? So you see an ETF, it's called, XYZ theme. Then you look under the hood and you look in the portfolio, and you soon recognize that the portfolio doesn't actually give you the exposure you're expecting. And that's because many ETFs are built on SIC codes and kind of other industry type codes. They're not really built for an outcome. And really, they're not built necessarily by people who really understand the industries. So John's brainchild was to come up with something called the bill of materials process. And right now we have a suite of 5 ETFs, all in what we call super cycles, which I'll talk about in a moment. And they all follow the same process, the bill of materials. And what that is very simple. The first thing you do is when you look at a theme like defense, you want to analyze the supply chain. So you want to map out each segment of the supply chain to understand exactly what are the components that go into building the products that are sold within that industry. Once you've determined what the supply chain looks like, then it's all about identifying what the bill of materials looks like. And what the bill of materials is very simple, is, how much does it cost for a specific unit that goes into an end product. So taking, for instance, like our AIS ETF, our AI infrastructure ETF, when you map out what a data center costs, you quickly realize that cooling systems is around 20 to 25% of the overall build cost. So that makes it very important for investors. So if you're not having enough cooling exposure, you're not really getting direct access to that theme. So our bill of materials is all about finding and identifying the CapEx levels, and then following where the CapEx is deployed. And the CapEx is deployed by, again, taking AI as an example, it's deployed, let's say, by the hyperscalers. So every dollar that Meta invests in AI is broken out into the supply chain, into the cooling system, the networking, and so forth. So if you follow where the money's flowing, you can follow where the profit pools are. And if you identify where the profit pools are, that's where investors make money. You want to invest in companies that are growing their profits. So it's a very different way of looking at how to build an investment strategy. The other thing that we do that is very different in the thematic space is that our ETFs are active. So the bill of materials process, which is something that we've actually filed a patent on, forms the core of our portfolio, and we rebalance that portfolio, twice a year based on where the bill of materials has drifted over the year. But where the secret sauce really comes in is having a group of people on the investment committee that are experts in the industry, who actually are in the industry building the products and identifying where the bottlenecks are in the supply chain, where the technology is moving, and where the industry is going overall. That's where we find the critical piece, because if you have a investment committee made up of just a bunch of Wall Street analysts, they're looking at the financials, they're looking really backwards. What the people who are in the industry are doing are looking forwards, right? They're in the industry actually building stuff. So they identify where the industry is going and what's important. We take those insights, we distill them down, and we incorporate those into our portfolios. So that is kind of the common thread across all of our super cycle ETFs, which of course AMMO is one of our newest ones. And what a super cycle is generally, we define it as a disruptive technology that really changes the way people live and work over a long period of time. So 10, 20, 30 years in terms of disruptiveness. So that is very important, because here, at VistaShares, we're not looking to, capitalize on a short-term theme. We're building products that we believe are foundational technology exposures. And that's why we're very careful on how we choose those exposures. So why don't we just talk a little bit about AMMO. What's interesting about the defense industry, if I can get my thing here to work. Oh, there it goes. So, look, unfortunately, we live in a time where there is a lot of geopolitical risk. There's a lot of distress. There's a lot of entanglements all over the world. And, it doesn't look like it's going to be abating anytime soon, which is unfortunate, of course. But as an investor, the question is, well, how do I capitalize on that? So the U.S. recently came out with their new defense budget of $1.5 trillion, which is the largest in the history, even on an inflation-adjusted basis, I think since World War II. So it's grown about $500 billion over just this year. And the global military budget is approximately $2.7 trillion for just this year. And over the next 10 years, it's going to at least double. Because of, for a variety of reasons, as we know. Not only is the U.S. budget expanding, but European budgets now are expanding because of the change in the percent that NATO members have to spend of their GDP. So it's a very rapidly growing industry, but the trick for an investor is it's how do you make money, right? At the end of the day, where do you get your exposure? And if you follow our bill of materials concept, it's not necessarily buying Lockheed Martin. Now, of course, those companies, the Boeings, the Lockheed Martins, the Raytheons, those companies are important. They're the primes, right? They're the ones that are actually creating the end products. They're getting the big contracts from the government. But what they're doing in large part is designing and assembling. So then you dig in and you have to determine, where are all the parts coming from? And what's really important now is that, over the last 20, 30, 50 years, defense budgets were deployed pretty much the same way. I mean, technology certainly did change, but, there was aircraft, there was naval assets, and there was ammunition and all those things. But the entire nature of warfare, as we've seen in Iran and in Ukraine in particular, is changed, right? It's really technology driven. It's about drones. It's about sensors. It's about space. It's about all of these new kind of technologies that just simply didn't exist 10 years ago. And now, as a warfighting unit, you need to survive. The U.S. just came out with some news a couple days ago where they're creating an entirely new drone force, land, sea, and air. So, and we've seen some of that in Iran. We've seen some of the naval assets that are drones, save those sailors about a month or so ago. So there are incredible technologies that are being deployed, and many of them are, quite new, right? They're very new in their development. So I think over the next 10 or 20 years, the way that countries fight wars, the way countries defend themselves is going to be completely different. I mean, you look at the Golden Dome that we're building here in the United States, it's been proven out in the Middle East and Ukraine most recently. So you got to really understand the dynamics there and really understand where the growth is coming from. So the key then again is to dig into the supply chain, right? So while AMMO does own some of the primes, we have some exposure to them. Those are the ones that are deploying the capital, right? So the ones that are deploying the capital may be good investments, but I would rather invest in the companies that are soaking up the capital, the ones that are making the money by creating the widget that goes into the end product. And those are, many things. There's sensors, there's munitions, there's unmanned systems and all the components that go into those. And then, of course, the platforms and subsystems. And that even expands into some of the space capabilities as well. Being able to get satellites into space, into orbit for reconnaissance and, frankly, for warfare as well. So that is a massive change occurring. And AMMO is the only ETF out there that really captures that supply chain. So what I would encourage anyone, anytime you buy any ETF, not just a VistaShares ETF, is compare the portfolios. Look at the portfolios side by side. Understand the exposures you're actually getting, because that will inform you on what you should expect as an investor. It goes into the size of the companies. It goes into the locations of the companies. AMMO is a global portfolio. It's actually skewed overseas, which is another interesting takeaway, because a lot of the components that go into our warfighting capabilities are designed and built in Japan and South Korea and Taiwan and other places. And that's, it gives us should give us pause in the United States that we need to control our own supply chains. But the reality is that's where those components come from. And we can't build our end units without them. So that's really important. Another major structural issue that I think is really, probably I should have mentioned first, is the fact that it's great that NATO has committed to raising their budgets to 5% of the GDP. But the problem is that the global economy does not have the infrastructure to support that spend. So if you think about that for a minute, they could spend all the money they want or try to spend it, but they actually cannot, because the factories, the manufacturing capabilities are simply not there. And that is a major risk factor for, Western civilization. Excuse me. But it's also something very important to understand as an investor because it's all about infrastructure. So, if you look at any of our super cycle ETFs, we have artificial intelligence, we have electrification, we have space, we have robotics, and we have defense. All of those super cycles are in their infrastructure phase, meaning that it's all these technologies are wonderful, but unless the factory capabilities, the industrial layer is built out, we simply can't create those products. So that is really phase one. So if you look into our portfolio, you're going to see across our suite of super cycle ETFs, there is a lot of infrastructure there. So we call ourselves, in this case, we're the defense infrastructure ETF because we're the only ETF out there that is actually identify that as a problem and are capitalizing that in our portfolio. So it could be 5, 6, 8 years before the industrial base can actually support the level of spending that is being required of NATO members and the increased defense spending of the United States. So major risk factor for civilizations in terms of warfighting, but a major opportunity for investors. And that is something that we think is quite important. So we talked a little bit about our super cycle bill of materials process. And what we really want to draw attention to there is just how important it is to understand that, or to have a transparent process. All right. So while we're an active ETF, our bill of materials process is 100% transparent. You can go right on our website, you can pull up the rules-based methodology and see exactly how we develop that portfolio and exactly why a specific company is in that portfolio. It's all defensible, which we think is important. At the end of the day, investors are very sophisticated, much more sophisticated than they were 10, 20 years ago, because there's just so much more information out there, right? I mean, a novice investor can get access to the type of information that an expert could only get 10, 20 years ago. So there's a lot more information, a lot more analytical horsepower out there. And we think it's important that everything we do is transparent. Right up into how we run our investment committee. Our investment committee is on the right-hand side. And you could see the types of people that we have on board. I talked to you about John McNeil, former president of Tesla. We have Professor Robert Whitelaw, who's the former chairman of the finance department at NYU Stern School of Business and the former dean over there at the School of Business. We have David, who is a former of Teal Capital, and he is just an incredible intellect. We have Sunny Madra, who is the former president of Groq, G-R-O-Q, which is one of the leading developers of inference technology, inference chip technology for AI data centers. They were acquired by NVIDIA, and now he runs hardware over at NVIDIA. Justin Lopas, he's partnered with Zach Dell over at Base Power. Justin Lopas, he was one of the lead engineers at SpaceX. He was head of manufacturing at Anduril, which of course, as you know, has quite a bit of exposure into the defense space. And now he is one of the world leading experts on energy technology. And of course, Ian Cinnamon, who is the co-founder and CEO of Apex Space. He was also a lead executive at Palantir prior to that. And Palantir, as you know, has become a critical component of our warfighting capabilities here in the United States. Ian runs Apex Space. They are the leader in developing what's called a space bus, or a satellite bus, I should say, where they actually specialize in transporting satellites into orbit, which is something, of course, that didn't exist just a few years ago. So taking into account all the expertise we have, our investment committee meetings are quite lively, as you can imagine. Quite a few insights are kind of provided in every one of our meetings. And those are written up and available to investors in terms of our insights and how we take those insights and we translate that into our portfolio construction. One thing to note also is we are not traders. So we don't wake up in the morning with ammo and say, you know what? Palantir's low is down 10%. Let's buy more. That is not what we do. Our investment committee is 100% focused on risks and opportunities. And what that means is if one of the experts on our investment committee identifies a new technology that is usurping market share of an existing technology, or a specific company that is gaining pipeline or losing pipeline through their own knowledge of being in that industry, we identify that early in real time and we put them on a watch list. So if you look at, and ammo's too early to tell you the annual turnover, but you look at a product like AIS, which is about $1 billion in assets, our AI infrastructure ETF, and it's about a year and a half old, our turnover is around 8%. So very low turnover. And we do that because, again, we're not traders. We are looking for risks and opportunities that will structurally change the investment thesis behind a company. And when we find that and need to make a change, that is when we make a change. So we're not making value determinations on a daily basis. We, of course, look at that, but that's not our game. We're not, which we think is important. And it also keeps the products a lot more tax efficient for investors as well. And we think that's important as well. I think that is really the synopsis. So I would encourage you to take a look at ammo. We believe it's the best constructed defense ETF in the world. We think that it's going to bear out from a performance perspective over the next several years. And again, the main reason is because we're following the cash. Where's the cash deployed? And who's earning the profits based on that CapEx that's being spent? And that is, at the end of the day, the synopsis of all of our super cycle products. Follow the money, follow the profit pools, invest in where the profit pools are being generated.
Thank you, Adam. Question number 1. You've described defense as being in a long-term super cycle. Global military spending is already at record levels. So what convinces you that this is more than a temporary response to today's conflicts? And where in the defense industrial base do you think the biggest capacity gaps still exist?
Great question. So yeah, I mean, putting aside the geopolitical turmoil that we're experiencing today and over the last couple of years, the reality is, even putting that aside, the entire nature of warfighting has changed. So many of our existing weaponry is no longer really sufficient to deal with today's threats. So, you look at our THAAD system and our Patriot missile batteries and things like that. Those were designed to take out a finite number of ICBM missiles and protect a specific area. As we can see now, people are moving to drone swarms, and taking out a $20,000 drone with a $5 million missile is just not economically viable. So, and that's just one example, right? But you can apply that really across the Navy. You can across every single method of warfighting that we have. You can apply that across. Space is something that has become just interoperable with every other component of our war machine. So we need to build those capabilities. If we are going to keep up and stay number one in terms of a military, we need to completely revamp how we fight wars and the mechanism in which we do so and the type of equipment we use. So putting aside the geopolitical turmoil, the fact of the matter is that even without that, we need to completely revamp everything. So that should take more than the 1.5 trillion that we're spending this year just by itself. And then if you kind of look down the road at what's happening, drones is something that people are just starting to use, right? It's only been over the last few years that you've heard a little bit about it here and there. The United States has surveillance drones, but now they're war-fighting drones. That's going to change into robotics and robotic dogs and all of the, to replace infantry. So everything is changing. And you could say it's kind of like the Terminator, right? Which is a scary thought, but at the end of the day, that's where it's moving, right? It's going into robotics. It's going into space. So the spend is going to have to continue to ramp up. China and Russia, well, Russia has its own problems, but China in particular is spending a lot of money on technology. They don't have a lot of the red tape that we have. They are able to build massive amounts of energy to support the new AI economy. So the defense spending is going to continue to grow. And in terms of where it's deployed, number one is infrastructure, right? Without the infrastructure, we can't build anything, and we simply don't have it. We don't have the ability to keep up with missile demand for our Patriot batteries and things like that. So that is number one. We need more infrastructure just on existing weaponry. But to build the new types of weapons, the new capabilities and the sensors and the robotics and the space capabilities, we need all new infrastructure. So I think number one is infrastructure. That is where the money is going for the next 5 to 10 years, is building out that industrial base where we can create the products that we need. So that's where I would focus. And that's where we do focus.
Related question, Adam. NATO members have committed to a major step up in defense and security investment over the coming decade. When you translate those political commitments into actual corporate fundamentals, which categories, be it air and missile defense, munitions, naval systems, electronics, autonomous systems, perhaps something else, are most likely to see sustained procurement demand?
Great question. Well, the increase in NATO spending to the 5% level is going to be phased in over a few years. Part of it is political. Part of it, again, it comes down to infrastructure. They can't spend the money even if they wanted to. I think in Europe is in a different situation than the United States is. The United States needs to really get into autonomous systems and sensors and space and robotics. That's where we are going, because we do have the most advanced traditional weaponry. Europe is way behind. I mean, you saw what happened with the UK trying to deploy some naval assets to Iran earlier in the conflict a couple of months ago, and they could only muster up one ship. France has one aircraft carrier, right? So they are so woefully behind where they need to be that or at least our position is that they need to catch up there before they can even think about going to next generation warfare. They need to catch up on, their munition stockpiles, their missiles, their anti-missile technology, their ability to project force through naval assets. They have a long way to go. They have just simply not spent money for the last 20 years. And, a lot of them are in the kind of 1% to 2% range of GDP, choosing to spend their money elsewhere. And whether you agree with it or not, from a political perspective, it doesn't matter. As an investor in the defense space, they need to stack up those wins and spend the money to build their capabilities back to where they need to be.
Adam, one notable feature of the portfolio is that it doesn't simply own the largest U.S. defense primes. You're looking further down the supply chain at components, subsystems, and enabling technologies. Where do you see the greatest disconnect today between how investors think about a major weapons platform and where the economic value or bottlenecks actually reside inside that platform?
It's a great question as well. And I'll kind of tie it to where AI infrastructure is, right? 2 years ago, when people wanted to invest in AI, they said, "Oh, let's buy Meta, let's buy Amazon, let's buy, the hyperscalers." The hyperscalers are the ones deploying the capital. They're not the ones earning the profits from their investments yet. They're making these investments so that 10, 15 years down the road, they will have enough compute power to enable themselves to create the type of value for their consumers where they can earn the money. Okay, so it's literally, it's an investment now for tomorrow. The same thing is happening in defense. So Raytheon, Lockheed Martin, they are the hyperscalers, right? They are the ones that are deploying the capital, in addition to the government ourselves, right? The U.S. government deploys directly through the primes, right? So if you really want to understand how to invest in defense, you got to look at the systems that they are looking to build. And then you have to build the supply chain for those systems and understand, where are the widgets? How much is widget 1 as part of the supply chain? How much of that does that soak up of the CapEx versus widget 2, widget 3, and go down the road? And that's how we build our portfolios. That's why the bill of materials process, we believe, is a superior way to invest. And it's proven itself, with AIS, our AI product, and POW, our electrification product. It's already proven itself from a performance perspective. But it's no surprise, because we are investing where the profits are coming are being developed. And that's the same thing with ammo. It's where the profits are being generated. That's where you want. Now that will change over time, right? But that's why we're an active ETF, because as the supply chains migrate and as the maturity of the industry changes, you need to redeploy where you invest. So today it's in the infrastructure. It's in the supply chain of the components for certain weapon systems. Tomorrow it could be something else, and you need to stay nimble and, more importantly, have the expertise on the investment committee to say, guys, let's start taking a look at this sector, because that is now where things are moving. You got to go to where the puck is going, because that's how you make outsized returns, by getting there first. And that's how we've developed such a good track record with AIS in particular, because 9 months before anyone was talking about a memory bottleneck, we loaded up on the memory stocks. Why? Because our investment committee said, we're building data centers all over the world. We can't get memory. And we were early to know that.
Final question, and we only have about 30 seconds for you to answer. Looking over the next 6 to 18 months, what developments would you tell investors to watch most closely? 30 seconds, please.
I would see what's going on in Europe, because if they accelerate their spending, if things stay as hot as they've been, we might see an acceleration in their spending, and that will go directly into kind of the more traditional investment classes like munitions, naval assets, and things like that, and aircraft. So again, you want to be in the supply chains for those components, but I would keep an eye on that.
Thank you very much for your excellent presentation. For additional information about Vista Shares and its funds, please visit the sponsor's website, where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Tidal Financial Group. Presenting today will be VP of Portfolio Management, Dan Weiskopf. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Dan, are you there?
I am here.
All right, jump right in, please.
Thank you for having me. I'm looking forward to a great discussion with you, as well as maybe with the audience themselves, because I think everybody has questions around blockchain. But before I get going, I just figured I'd give a little bit of my background. I'm maybe one of the old timers here. I started in the business in 1987, working for a family office affiliated with Allen and Company, and learned a whole lot about the market through that experience, including venture capital and activism and commodities and themes, to tell you the truth. And then I spent some time at UBS. UBS is, well, big firms weren't my thing, let's just say that. And then I caught the ETF bug. And for me, ETFs have always been about access to ideas. And it's always been a great wrapper for me. And for years, I've been talking about how structure matters. And that's all about security selection. In 2018, I joined Tidal Financial Group. And at the time, Tidal was about $1 billion. There were about 6-8 of us. And Tidal today, as everybody knows it, and I hope everybody knows it, is a firm that helps others launch ETFs. And we're about 250 people strong. And it's all about bringing great ideas to the marketplace. I could list many of the funds here on that have been presenting as Tidal clients, and we appreciate their commitment to being an ETF entrepreneur. So with that, I would just say, though, that ETF entrepreneurship is a wonderful experience, but it's tough. We have about 90 or 95 clients who have launched through us and about 420 ETFs. And we do everything from the trading aspect of the funds to the legal to helping folks market and hopefully sell their products. And at the end of the day, if you want to launch an ETF, please feel free to reach out to me. You can find me at D. Weiskopf at Tidal Financial Group. And then also on Twitter at ETF Professor. I'm also available, of course, on LinkedIn. My key role, though, and with this, my key role is on the Portfolio Management Committee. And I manage a number of funds directly. We've got about 20 products that we're responsible for on the investment committee, but 4 very close, dear to my heart products are Block, which is the largest blockchain ETF, and then Digital Asset Debt Strategies, DADS, which is the debt side of blockchain and crypto. And then we also manage, or I manage, the subversive products that are all about your honorable members of Congress and how they invest their hard-earned dollars in Nance, which is following the Democrats, and then the Republicans is GOP. So thank you. That's my bio.
Thank you, Dan. And if you're ready, we'll jump right into the many questions that we've been collecting.
Awesome. Totally.
Okay. Start with the one that's dear to your heart, Block. You've been managing it since 2018, which means you've lived through several very different chapters of blockchain, from the early enterprise blockchain enthusiasm to crypto winters, Bitcoin ETFs, stablecoins, and now institutional adoption. What has changed most fundamentally about the investment thesis over those 8 years?
Well, it's actually completely changed on so many different levels. When we first launched Block, Michael Vanu himself as the PM team, it was all about really specifically crypto and just companies that might be disruptors in the space. And that's still the case today. But regulations were not clear. And the idea was, ironically, that at some point blockchain might disrupt ETF. So it was a bit of a hedge. People thought we were a little bit crazy. It was one of the most successful ETFs ever launched at the time. And I think out of the gate, we came with about $200 million. Today, we're at $1 billion. But to answer your question directly, I think when Gensler left, it opened the door to real regulation. And with real regulation, at the end of the day, we're going to have a framework where companies can be more confident in how they can build a business. Today is a very special day because there's a number of people at the White House trying to work with the president again, and the SEC and the CFTC to create a framework. Listen, at the end of the day, as much as I think structure matters, it's not always easy. We've had a couple of things that have come our way. The Genius Act as one. The Clarity Act is still hopefully going to pass, but maybe not. But if it doesn't, it's very clear to me that the SEC and the CFTC are now at a point where they're going to move forward with programs to offer up the rules, and they've already started doing that. And that's in the public filings through the SEC right now. So the answer to your question is clear rules are the big difference. And we'll talk further about what that is as we move along.
Now, Dan, when people hear blockchain, many still immediately think Bitcoin. From an investor's perspective, how do you distinguish the investment case for the blockchain ecosystem from the investment case for Bitcoin itself?
Yeah, great question. And going back to your earlier question about what's changed, back in 2020, a couple of years after we launched Block, um, MicroStrategy made a big announcement. Michael Saylor led that announcement about pivoting into Bitcoin, and he did a Dutch tender and said, whoever wants out, whoever doesn't want Bitcoin, just know, here's your exit. I'm willing to pay, I think 143 at the time. And then he went out and he went out and he bought a bunch of Bitcoin. And for us, frankly, at that point in time, that was an confirmation of our original thesis that Bitcoin might get adopted by companies as a store of value, as a transfer of value, as maybe a hedge against inflation. And my goal was, wait, Michael Saylor, how do I talk to him? Everything that we do around Block is oriented to capturing the theme, but we definitely like to talk to managements. And so I went on a rant to try and have that early conversation with Michael, well, of course, called 1-800 MicroStrategy IR, no answer. Emailed, no answer. Reached out on Twitter, not really responsive. Then all of a sudden, I get a 202 number calling me on a Friday afternoon, and it's literally Michael Saylor, and he says, in his tone of voice, "Hello, this is Michael Saylor. I understand that you're looking to talk to me." And with that kind of experience, I almost fell out of my chair, quite honestly. And we talked for like an hour and a half or so. And I bring that up because it's, again, like one of those things that have changed so much since we started, in the way of Block. Also, I would say, I forgot to mention, like, these little companies called DTC and Swift now are leaning in on blockchain. But to answer your question on the difference between Bitcoin and blockchain, simply put, Bitcoin is one blockchain, okay? And now it might dominate with about 60% market share in the terms of market value, which is wonderful for blockchain. Its use is different than Ethereum, Solana, or many of the others. You're not going to, or Swift is not going to use Bitcoin to program rules on the Bitcoin blockchain. It just wouldn't work, right? They'll use other types of coins where there is more programming value on there. So I think that's a key difference. And like stablecoin as another example is wrapped. You can think about a stablecoin is wrapped within the context of a blockchain, and that store of value is held stable because stable coins own treasuries. So if you think the treasury is going to be stable, you can think about how that blockchain, meaning stable coins, will be stable as well. And we'll talk a little bit further about that in the future. But the other point that I would make is that Bitcoin miners use a different system than Ethereum and Solana. And that's an important distinction, because that's part of the reason why they don't work for programming in the same way that Ethereum or Solana work. So I hope that I've answered your question.
Yes, thanks, Dan. One of the interesting things about the portfolio today is the prominence of companies like Cipher Digital, TeraWulf, and former Redchip client Hut 8. These
Yeah.
businesses grew out of Bitcoin mining, but increasingly we're hearing about miners repositioning power and data center assets for AI and high performance computing. Is that creating a fundamentally different investment thesis for these companies?
Yeah, it's almost apples and oranges, with the exception that energy is the key component. You're using different chips. You're not speculating on whether or not Bitcoin is going to be higher or lower. You're getting billions of dollars um, of of potential revenues from firms like Microsoft or from Amazon or I could go along a whole list. Um, and what we do, which is fun for me personally, is we go out and visit the data centers and see the equipment and the physical structures. I visited Galaxy Digital recently. I visited Cypher's facilities. I was on the board, the restructuring board of Core Scientific, where I helped make the decision to hire that board of directors as well as Adam Sullivan. So what's the difference? The difference is at the end of the day, with Bitcoin Miner, you don't have control over your costs beyond that you can shut down if you're going to lose money instantly. But you don't have control over your revenues because they're all priced in Bitcoin. Versus, I'm going to say an AI data center, whichever one you want to point to. You've got a guaranteed billion-dollar contract that spans maybe 10 years, 15 years. And ultimately, in my mind, these are fabulous businesses that in time may convert to REITs. They just may end up being dividend plays. They are going to be strong companies with free cash flow. And while currently they've sold off a lot because of some of the changes in the approval process, whether that's in Texas or Pennsylvania. I think these are political in nature. These are political decisions by Governor Abbott or in Texas or Governor Shapiro in Pennsylvania to candidly please their constituency, and they need to do that to win the election. And while these companies have pulled back very hard, that's the opportunity in Block, and that's the opportunity, frankly, in DADS as well. The difference, though, is in Block, you've got the equity side. In the case of DADS, you have the debt side. And I'll just stop with that. And if there ends up being any questions related to those two funds, we can address them.
Dan, for years we've been hearing that tokenization could move stocks, bonds, real estate, and other assets onto blockchain-based infrastructure. What has to happen for tokenization to move from an interesting technological concept to something that materially changes the economics of financial markets?
Yeah, great question. And I think there are certain, maybe I'm more patient than others, but I would say Figure Technology, which is a top holding in our funds, we're talking about 50 to 100% growth in the way of HELOCs on chain. If you can get a HELOC in 5 minutes or maybe even 5 days using Figure's technology, and it's faster, cheaper, and easier to get, that's a great example of how blockchain's working for the end consumer, right? If you can get life insurance in a similar way, I think people will be pleased with that. I'm looking forward to title insurance being on chain as another example. You know, as a very well-known banker said, if things are faster, cheaper, and more efficient, ultimately adoption will accelerate. And I think that's what we're going to see in the near future, because while the Clarity Act has stalled out a bit on giving that framework for companies to adopt and accelerate the blockchain benefits, you still have firms today that are leaning in on it, whether it's Visa or MasterCard or Broadridge. Broadridge, you know, can move something like $360 billion of repos daily just on their ledger, which is a blockchain. So as much as people, I think, are disappointed or frustrated with the price action of, we'll say Bitcoin as an example, but you can lump them all together. I think the adoption is moving forward very, very much in a strong way, just not fast enough. And it isn't necessarily evident to people, but it is moving forward. I mean, heck, you know, if you've got DTC and Swift embracing it, what else could you want, right? You know, by big companies, they're moving quadrillions of dollars, not on chain just yet, but they will be adopting those, the technology.
Stablecoins may be one of the clearest examples of blockchain finding a real-world financial use case. Do you view stablecoins primarily as a crypto product, or are they becoming a new payments and settlement infrastructure that could eventually compete with parts of the traditional banking system?
It's definitely going to compete. And Circle also recently just bought, and Circle's the largest U.S. stablecoin provider. And they just recently bought IBM's patent portfolio. And I think they're doing that in part to create a moat around their business, because stablecoin could end up being offered by Walmart or eBay or Amazon for that matter. It's just a brand on top of maybe the Circle infrastructure or on top of their own infrastructure, which may be lined up with Visa or MasterCards. We just don't know yet, right? There's going to be a lot of adaptation as well as the adoption by many of these companies. So in my mind, the way stablecoin is going to be used in the future is going to be by companies that kind of recapture some of the payments rails that cost them money. I think it's something like Walmart pays like $10 billion of credit card fees to Visa and MasterCard and the credit card companies. Well, if they can capture just a little bit of that or negotiate deals differently, right? Or as I envision it, create their own stable coin, and there's interoperability between Amazon and Walmart, there's risk, frankly, between Visa and MasterCard maybe having some pricing pressure. But that's why the future may be just different than the past, and that's okay. I think in the way of this particular opportunity, what we're going to see is AI, and that's part of the reason why we're so long the data centers, working with the blockchain in so many different ways. And the technology is here today. So it's not a great leap. And my last comment on that would be, well, we've been talking a lot about the major companies leaning in on it. The underlying premise behind crypto is that small operators can have an advantage, right? So that's the premise behind decentralized finance.
Dan, you're in an unusual position because you're not only investing in a rapidly changing technology through Block, but also at Tidal, you are also helping other investment managers bring new strategies into the ETF market. I want to pull the lens back and take some questions now about what's happening in the ETF business itself, if that's all right with you.
That's great. But actually, look, I can see Folio Beyond as a client, Unlimited is a client, Vista Shares is a client. That's great.
Now, we got this question here. The ETF industry has been growing at an extraordinary pace, as you well know, with more than 1,100 new US ETFs launched in 2025 alone. From where you sit, Dan, what is driving this wave of product creation, and are we still in the early stages of that expansion?
We are so in the early stages. We've just scratched the surface. And some of that, again, has to do with regulations and ease to launch an ETF. It's also because, frankly, I think retail wants really decisive themes. I'm a thematic investor. And at the end of the day, the way I see the world is that this is an opportunity for entrepreneurs to launch ETFs, and they can do it 90 days, 120 days, and they can do it where they know their risk. It's asymmetric risk, perhaps an asymmetric reward. And once you get that reward, it's an annuity. So I think it's like 2,300 ETFs or something are in registration at this point. I see a world where ETF growth is only going to be accelerating in the future. And also, I would say the big asset managers want to get in now. They finally want to convert. And then the advisors also realize that there's the 351 exchange that can offer a tax deferral benefit so that they can convert a book of SMAs into an ETF and get diversification. And that's just a wonderful thing. And when you think about what we've created, well, through the YieldMax product fund family, in the way of option income, that's again a wonderful thing. Kudos to Vista Shares too. I got lots of friends on this panel. So I guess bottom line on it is ETFs are going to be accelerating in the future with more launches unequivocally.
Dan, we're also seeing investment strategies inside ETFs become considerably more sophisticated. Options overlays, defined outcome approaches, futures, and other derivatives-based strategies. What new operational or trading challenges emerge when the ETF itself becomes more complex?
Well, fortunately, we have a team of professionals who can address those issues. And some of it is also emerging markets, and you need to be able to set up accounts with emerging markets, and that's why what we've built at Tidal is so special. You as an individual or as frankly a big company would probably be very challenged to compete against us in the way of sophisticated solutions, because we've got so much experience in the space. So sorry, that may have sounded like an advertisement, but well, it is.
From your vantage point across hundreds of ETFs, what are investors asking for today that they weren't asking for 3 or 5 years ago? Are there particular strategies, exposures, or portfolio problems that are driving product development right now?
Well, before I forget, one of the great uses of an ETF is that it's transparent. And I manage 2 products that follow how members of Congress invest. And I told the tickers were NANCE and GOP. And what's wonderful about them is you can see how members of Congress are taking risks with their capital. I think that's like one of those things, a beautiful thing about ETF wrapper, the transparency. And I would just mention something that is probably maybe overlooked. So recently, since I'm following how those members of Congress are investing, we saw Nancy Pelosi buy a slug of leaps in Intel. And GOP happened to be long Intel as one of its top holdings. So I dug a little bit deeper. And just last week, I think it was, Intel did a major secondary to raise like $15 billion. Well, coincidentally, I just highlight this. I think it's August 27th that Intel, America, which owns 8 or 9% of Intel, will be able to trim or sell some of their shares. So that's like one of those things that through an ETF, you can see or monitor how a position gets sold. And where I'm going on this, sorry, just to be really clear on this, how interesting is it that Nancy Pelosi bought Intel stock like 6 weeks ago, and GOP is also long it, and Intel just raised money, and then America, well, is America going to trim Intel?
Great
Thank
way
you.
to end, Dan. Thank you for a very informative presentation today. You truly are an expert on ETFs.
I appreciate it. Enjoy,
For
Bob.
For additional information about Tidal Financial Group, please visit their website. For more information on Block, please also visit the sponsor's website and read the fund's prospectus. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Unlimited Funds. Presenting today will be co-founder, CEO, and CIO Bob Elliott. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Bob, please go ahead.
Hey, thanks so much for having me. It's fun to come on the heels of Dan Weisskopf, who's an old friend, and so it's you guys are getting some good content if you're hearing from Dan, that's for sure. Well, I wanted to jump into what we're doing here at Unlimited. As we and I wanted to talk about our equity long short product. For those of you who aren't familiar with Unlimited, about 4 years ago, my co-founder Bruce and I, after several decades in the hedge fund business, started to think hard about whether there was a way to bring hedge fund strategies to the everyday investor. And obviously that's a lot easier said than done. But leveraging our experience, having run proprietary hedge fund strategies for many years, we built technology that allows us to look over the shoulder of how hedge fund managers are positioned in real time and use that understanding to translate it into long and short positions in liquid securities that we can use to back ETFs, which seek to replicate how those managers are positioned. And because we're using technology instead of hiring expensive portfolio managers, we can do it in a way that is much lower cost than traditional products. And part of what our real goal here is to kind of bring the concept of diversified low-cost indexing to the world of 2 and 20 and open these strategies up to every investor. And I think when people think about hedge funds, they often are trying to think, let me find the all-star manager, let me find the one diamond in the rough that does better than everyone else. But the thing that you'll realize once you start to look at institutional quality managers is that actually the wisdom of the crowd creates a much more reliable return over time than trying to pick any one manager who at any point in time might be above or below their peers. And so what we're really doing here at Unlimited is what I call alpha indexing, which is looking over the shoulder of, the 1,000 equity long short hedge fund managers that are institutional quality or global macro managers, et cetera, and making their positions, the wisdom of that crowd available to every investor. So let's get into it. Really what we're trying to do, as I said, is we're bringing hedge fund strategies into hedge fund style strategies into the ETF wrapper. For way of background, we started with a multi-strategy product, which combines 6 underlying sub-strategies together into a single product. And then over time, upon the request of many investors, we started to break out some of those underlying sub-strategies. So global macro, equity long, short, managed futures, et cetera. And we've launched in just a little over a year ago, we launched those individual sub-strategies, which our equity long short product is one of those. And our goal is to bring these strategies, to bring sort of the power of alternative ETFs to every investor, with the benefit, as I mentioned, being lower fees, higher manager diversification, and of course, without the paperwork that exists with most LP style investments. As I mentioned from the outset, the two of us who started this, Bruce McNevin, my co-founder, and I, we have extensive experience in the hedge fund business. I was at Bridgewater Associates for almost 15 years. Bruce McNevin, my co-founder, was at top 10 hedge funds as far back as 2000. We've seen a lot of these strategies through our career, and so we're leveraging that experience. And unlike others who have tried to bring sort of hedge fund strategies in ETF or replication strategies out there, we have actually managed these proprietary strategies and understand very well how they work. I mean, my co-founder Bruce was creating equity long short strategies as early as in the 90s. So we've seen a lot and can apply that sort of understanding to how we build these strategies. Now, often we get asked, how do we go through this process of replicating how hedge fund managers are positioned in real time? And that process leverages what we call our alpha mining technology. That's a technology that allows us to look over the shoulder of how hedge fund managers are positioned in real time and take that understanding and translate it into long and short positions in liquid securities. The way we do that is through what I call returns-based inference. And what I mean by that is that what we're doing is we're looking at the path of returns from these managers, and we're backing out which portfolio is the highest probability portfolio that's generating the returns that we're seeing. Now, you might say, hey, look, there's lots of different portfolios that could be generating the returns that you're seeing. And that is true. But one of the most important things when you're thinking about institutional quality managers is that they're typically managing money at a sufficient size where they can't instantaneously flip positions. Institutional quality hedge funds and institutional size hedge funds, they're not going long stocks one day and short stocks the next. Instead, they're evolving their positions over time, and most have designed their alpha generation to rely on medium-term alpha strategies. And what that means is that in any one day or week or even month, they're not necessarily significantly shifting their positions. And so what that means is that their positioning is continuous, which means it's what I describe as path dependent. And to be very simple, if you think about a particular day's returns or week or month's returns, there's lots of different combinations of different positions that a manager might use or managers in aggregate might use to generate those returns. But because institutional managers can't shift their positions all that quickly, the positions that they hold today have to be adjacent to the positions that they held, for instance, yesterday. And you can observe yesterday's positions through yesterday's returns. And so if you think about it, say you solve for today's positions and yesterday's positions, there's not that many combination of assets that have related positions or adjacent positions that describe today's outcome as well as yesterday's outcome. If you think about what we're actually doing is we're doing that process back 25 years and then bringing it up to today to give our best guess of what positions managers are holding today. It's very important because it contrasts with most replication strategies that have existed in the past. Typically, for those of you who might be familiar with replication strategies, typical replication strategies use rolling regression type approaches. So for instance, they might look at the return, they might look at 20 different positions that managers could be long and short. And the challenge with that is, in order to not get an over-optimized regression, you have to basically look at 20 periods of returns, 20 months of returns. Well, hedge funds move much quicker than the average position that they've been holding over the course of the last couple of years. They're tactically shifting their positions, not daily, but over the course of 3 or 6 months. And so one of the things that our approach does is it allows us to solve for today's portfolio. What is the highest probability portfolio generating the returns that we're seeing in real time? But doing so in the context of those previous portfolios, but not averaging them in, simply using the understanding of those previous portfolios to understand the path of positions that get to today. And we expect, as a result, to be able to pick up the tactical alpha shifts much more quickly as a result of that. How we do it functionally, which is shown here on the slide, is for each hedge fund style, like equity long short or global macro, et cetera, what we do is we look at the sort of 10, 20-ish, 25 typical exposures that those managers are holding at any point in time. So whether it be across asset classes or factors or geographies or market segments like, high free cash flow, low free cash flow, things like that. We look at each one of those, for every single hedge fund style, we sort of define a universe of plausible positions they might have on at any point in time. We get timely information about their returns, some daily, some weekly, and a comprehensive view monthly, a few days into the subsequent month. And then, as I mentioned, what we do is we have this, we have our technology creates probabilistic positions that are driving the returns that we're seeing in real time. And then we take the highest likelihood of those probabilistic positions and hold each one of those assets, asset one, asset two. So it might hold, long US stocks or short European stocks or, long Japanese stocks or value or growth, et cetera. And those define the positions that we hold in the portfolio. When it comes to the equity long short portfolio in particular, our goal is to track the returns of equity long short managers, hedge fund managers that are of institutional quality. Now, typically, when people look at the performance of equity long short managers, institutional quality equity long short managers, what they'll often do is they'll see that the returns, the absolute returns, are not that high. And the reason why that is because institutional allocators typically want their strategies run at bond-like risk. And the challenge with that is that typically makes those strategies quite cash inefficient. It also causes those strategies to often trail equity returns, particularly in bull markets. Our approach here is to take the insight in terms of the tilts that those managers have on, which generate alpha over time, and instead of running them at bond-like risk, we target equity index-like risk. So essentially running it at 2x the target return of a typical hedge fund portfolio. And that's really important because it allows us to basically create a product that leverages the insight of hedge fund managers at a lower cost in a way that is competitive with equity index investing. And so our equity long short product, it can be in many ways thought about as an active equity strategy. And as the table on the left-hand side shows, these managers have done a very good job navigating this recent market environment. If you take a look at the returns, over a range of different time frames, particularly since inception in the summer of last year, long short managers in aggregate have been able to deliver on the order of 1,000 basis points of alpha relative to the S&P 500. And in fact, this approach has made HFEQ a top, amongst the top 5% of all equity long short managers in the Morningstar equity long short category as of the end of last month. And so, we're really proving out that when you leverage the insight and the experience from the wisdom of equity managers, you can see that they're able to deliver meaningful returns. I think the thing that's very interesting about this is that they're able to do it in a way that is not overly reliant on the sort of semis AI boom. Now, obviously, folks who are investing in equity strategies, probably the biggest determinant lately has been whether or not you're overweight AI and AI-related names or not. And I think one of the things that's really interesting about what equity long-short managers in the hedge fund space have done is they've looked for opportunities that are outside of that sort of narrow scope of interest. And instead, what they've done is they've found opportunities, some growth exposure, as you can see in the portfolio positions there on the left-hand side, but also finding opportunities in things like value, European stocks, mid caps, biotechs, areas of the market that have largely been unloved by the sort of traditional speculative interest in the market. And as a result, have been able to generate strong returns without overly relying on being, extremely overweight the semi and AI story going on. And on the right-hand side, you can get a sense as to how the strategy has played out since inception. And I think it's important to recognize that you're getting equity index-like volatility on the strategy. What you see there as the monthly standard deviation annualized 16%, the through time equity S&P 500 standard deviation is about 15%. So you're getting something on par with traditional equity index risk, but doing so in a way that has generated significantly better returns, 29.49% annualized since the start. And at the same time is, it's correlated to stocks in any short-term perspective, correlated to the S&P 500, but an 0.7 correlation, which is pretty consistent with what we see historically. This sort of mix of attributes is pretty consistent with what we've seen historically with these managers. And so I think for many folks who are looking at equity products in the market, they're really, the question is basically, how do you find actual alpha in the market rather than leveraged beta, right? That's always the question. There's certainly, for people who are following the markets carefully, there's lots of stories about leveraged beta and folks who are doing that in order to juice their returns. And we find that that hedge fund managers are generating their excess returns relative to traditional index investing, but doing so in a way that is that's not relying on leveraging beta, but instead finding opportunities across the market that are differentiated relative to sort of traditional concentrated positions. And so that is that's pretty much it to give you a sense as to how our equity long short product works. Appreciate everyone taking a few minutes out of their day to hear more about it, and I guess we'll take a few questions.
Investors are dealing with an unusual mix right now. Inflation is still above the Fed's objective, energy prices have been pressured higher by geopolitical disruption, and growth is uneven across regions. When you step back from the daily market moves, how would you characterize the macro regime we're in? And which forces do you think investors most need to understand?
Well, I think you've got a combination of in the market, you've got a combination of a mania that exists in the AI and semi names that has driven expectations, particularly earnings expectations, towards extremes. And at the same time, it's and in part that's driven by what's going on with expectations of the technology, but it's also in part driven by the relatively loose monetary and fiscal policy that has existed, and for some time, and as a result, we basically have a circumstance where the biggest opportunities on a forward-looking basis are not by concentrating in the areas where there has been a mania, because that is a fragile future that exists there, but actually looking at other areas in the real economy that either might benefit from the new technology adoption. It's interesting if you look at margins, you actually see that margins have not actually expanded much for real economy names yet. And so if you think about where is the next leg of technology adoption and benefit in the economy, it really is much more likely to be in the real economy companies, essentially real companies selling real stuff to households and consumers and et cetera. And so that's probably the place to look. And it's an economy that continues to be reasonably strong. So looking for areas that are not necessarily that are undervalued relative to other areas that are probably the most interesting places. And the last thing I'd say is there's also some idiosyncratic places where you probably want to be thinking about. I really like the biotech area. Talk about an area that really could benefit from AI adoption that has been beaten up for a long time. That's exactly what you sort of want to see is those sorts of areas that could really benefit from the technology innovation, but are not priced to perfection.
Unlimited's central premise is that you can replicate the return characteristics of hedge fund strategies without knowing or copying the fund's actual holdings. Explain how that really works, and what information in hedge fund returns allows your models to infer that managers collectively are exposed to things like rates, equities, currencies, or commodities.
Yeah, it's a good question. I think one of the challenges of often people look at things like filings and things like that in the hedge fund space to try and understand how managers are positioned. And I think one of the challenges with that as you get to more sophisticated managers is they aren't necessarily disclosing all of their exposures through those sort of traditional filing mechanisms, in part because those filings are relatively limited to long-only positions and cash securities, and they may have exposures that are outside of that narrow set. Those reports are also quite lagged, meaning it can take as much as 4.5 months to get an understanding of how managers are positioned. So we like to look at the returns, and the reason why we like to look at returns is because returns are truth. You can't lie about your returns or you go to jail. So returns are the reality, and we're able to see those returns. I think a lot of folks think, oh, maybe you can only see those returns quarterly or something like that. At an aggregated level, at an industry-wide level, we actually get quite a bit of information in reasonably close to real time in terms of how those managers are performing, and so that gives us a very timely understanding of how they're performing. And then the question always becomes then, how do you know how they're positioned? And part of the way I like to talk about this with folks is to just kind of go with, think about how you would typically approach thinking about how an active manager might be positioned, in the sense of, if you know a manager's returns and you basically know what their strategy is and you know what happened in markets, you could probably guess where their overweights are. So like, I don't know, if you were looking at a macro manager earlier this year and they were performing very well, you'd probably think, oh, they must have been long gold and benefiting from the debasement trade. Or if you're looking at a equity manager a few months ago and they were outperforming, you might say, oh, they probably were long the semis names, right? And you can kind of take a guess of how those managers might be positioned. just kind of by eyeballing it. And really what we're doing with our technology is taking that sort of core intuition, which is you can look at the returns and know what happened in markets and take a pretty good guess as to how they must be tilted in one direction or another. And you can just run that in a more computationally rigorous way than eyeballing it and taking a guess. And so functionally what we do is we go through that process. We could think about it like a sophisticated Monte Carlo simulation where we're looking at the returns information every single day. We're taking our best guess as to how they must be positioned, given what we've seen so far. And then each day we get incremental new information. We see incremental returns. We see incremental market information. We have our guess of how they're positioned, how they were positioned. And we can basically look at the divergence between what our guess was of how they were positioned and what that would have implied from the return profile based on the market action versus how they actually performed, and then incrementally adjust positions towards the actual observed outcomes that we're seeing. And I think that the basic idea here is, our replication approach is going to be imperfect, but it's going to get a pretty good sense of how these managers are positioned. And I would emphasize the alternative here. The alternative is going and investing in single managers who have wild dispersion relative to the aggregate index. And we've done a lot of work. If you can have, a reasonably good replication of the index, if you look back over the last 3 years, will have beaten single manager selection, something like 9 out of 10 times, because the replication can be run at a lower cost and a higher target return than what you'd get out of the box with single manager allocations.
Bob, could you take us inside the portfolio construction process? Once your models infer the exposures associated with a hedge fund category, how do you decide whether to express a view through an ETF, an equity index future, a treasury future, a currency future, or some other instrument? And how do liquidity, transaction costs, and tracking accuracy affect that choice?
Yeah, so there's one thing to create portfolios of supposed positions. Part of the job of running the money is also to make sure that we're expressing the views as efficiently as possible. And so what that means is when we show these sort of asset 1, asset 2, asset 3, you kind of think about those like a concept, meaning like Japanese equities or treasury futures or gold, something like that, that's driving the returns or the positions. And then the question becomes, how do you hold those positions? Which literal securities do you hold? And so for each one of the different positions that we're holding at any point in time, we think carefully, given the size of the fund, the liquidity of the available instruments, what is the best way to express the position. And so in many cases, holding futures contracts can be the most efficient way to express the positions because they're often very liquid, they're very low cost to transact, and they allow flexibility to run sort of gross notional exposure that's beyond just traditional, basically beyond your sort of your fully invested cash. And so most of the time we're looking at futures as a way that we express the positions, but not entirely. There's certainly many markets or specific areas where there aren't active futures or liquid futures that capture the economic exposure we're looking for. And so in other cases where those don't exist, what we'll do is we'll invest in low-cost index ETFs that are similarly liquid. So whether it be something like a sector spider or the large index Vanguard ETFs, those are products that we're using as well, and those are typically quite liquid and easily traded, and then can be held either long or short.
Bob, HFGM and HFMF both currently have exposure to crude oil, copper, and gold. Those assets can represent very different narratives: geopolitical risk, inflation protection, industrial demand, and monetary uncertainty. What signals are you seeing across those markets, and how do you distinguish a durable macro trend from a temporary shock?
Well, I think if you look at how what we're seeing in, as I said, in the equity space, what we're seeing is equity managers are looking for sort of real economy opportunities that are underpriced relative to the underlying economic growth that exists, the durability of the underlying economic growth. On the macro side, we're seeing fund managers really position for lack of a better term, a debasement type environment. And so we've seen them move into gold, copper, and short bonds meaningfully over the last couple of weeks. And I think there's good reason to, there's good understanding of why that might be, particularly given the delayed monetary policy efforts by the new, by Warsh, as well as, efforts. There's a variety of different efforts to basically try and limit duration supply, which is actually net stimulative. And if you think about sort of the world of different assets, stocks are basically pricing in very, very good stocks in aggregate are pricing in very, very good conditions ahead, with earnings growth that is expected to be around 25% a year for the next 5 years. So stocks have fully priced in a great set of economic conditions. Areas that have not priced in that, for instance, gold, or have not priced in easy money ahead, for instance, gold, are areas that macro managers see attractive. I'd also say sort of another somewhat related but orthogonal theme that's going on is that macro managers continue to raise questions about the Hormuz situation. They've traded oil quite well through the course of the year, and are back to basically highs in their longs in response to the continued strain that exists. And so that is why you're seeing the long oil positions as well.
Bob, thank you very much.
Thanks so much for having me.
Yep, thank you so much. Great presentation. For additional information about unlimited funds, please refer to the information provided in today's presentation. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Folio Beyond. Presenting today will be Chief Strategist and Portfolio Management, Dean Smith. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Dean, please go ahead.
Thank you. Good afternoon, everybody. I'm sure it's been a long day for a lot of you there. Thanks for hanging in. We're going to talk about some things today that are maybe a little different than some of the other presentations that have gone on before. Folio Beyond is exclusively a fixed income shop. We invest in some very differentiated fixed income strategies. We're going to talk about two of our ETFs today. The first one is the, let's see if I can get my screen share up here. There we go. Yeah, the first one is our RISR, RISR ETF, and the second one is our FixP ETF. These are very different strategies, but they fit together very nicely for a comprehensive fixed income position. And we'll talk about the differences between them and why one or both might make sense for you. A little bit about Folio Beyond first. We are a company that was started back in 2017, but our experience, Manat and my partner Young Lim, goes back quite a bit further than that. We've been investing and managing risk in fixed income and structured products for more than 25 years, each of us. And our approach is highly quantitative and not the sort of thing that is easily replicated by most investors. It requires some very sophisticated modeling, some proprietary tools. And what we're doing is we're bringing institutional style strategies to retail and institutional investors, family offices, mostly through registered investment advisors. But obviously anybody can invest in these funds. They're available on the New York Stock Exchange and on most of the major investment platforms, TAMPs and so forth. We in fact just got approved for LPL, and we're very excited about that. Let's talk about the current market environment and why a sophisticated fixed income strategy can make sense right now. There's a lot of risk out there in the market. There always is risk in the market, but right now we're seeing a combination of factors that is pretty unusual. You've got a lot of uncertainty and confusion about interest rate policy. We've got a very stubborn inflation problem. It's been above the Fed's 2% target for 5 years now. And while we've had some softer prints, it doesn't seem to be going away anytime soon. We've got softening GDP. We've got softening labor markets. We've got a budget problem that is completely out of control in DC. You've got a couple of wars going on. There's a whole lot of changes and risk factors that people have to deal with and maybe don't have the tools that they would like to manage these risks. And our products, we think, can help that with that problem, and we've designed them to do just that. So as I said before, there are two ETFs I want to talk about. The first, Riser. This is a fund that invests in mortgage-backed security, interest-only bonds. Now, these are really interesting, and we'll get into some of the details, but the great thing about these is they have negative duration. That is to say, when interest rates go up, most bond prices go down. We all know that. But MBS IOs, when interest rates go up, they increase in value. And we'll talk about why that is. We also, one of the great things about Riser is that it has a pretty healthy dividend. We're paying about a 5.8% dividend right now, and that dividend is very stable across interest rate regimes. It is coming from the underlying mortgage cash flows. And the thing that makes Riser different is that it's an interest rate hedge and diversification instrument that also provides current income. We'll talk about why that is. The great thing about the MBS IO strategy is that it has a very strong negative correlation to the bond market generally. If you look at the AG, for example, the fund has been running since 2021. We're at about 325 million in AUM, and it has a 5-star Morningstar rating, which it's had for quite some time now. The other strategy, FixP, is a multi-sector tactical allocation fund that looks at different sector ETFs across the fixed income universe, treasuries, munis, corporates, high yields, you name it. It's potentially in there. And there's a option overlay that we put on that fund to generate some additional income. And so the idea of FixP is that it's to provide a core plus multi-sector investment product all in one ETF wrapper. So let's talk specifically first about Riser, because there's nothing else in the market that's really quite like this strategy. As I mentioned, it's a 5-star Morningstar rating. It's currently ranked number 6 among almost 200 funds in Morningstar's non-traditional bond fund category. And the idea here is to provide an uncorrelated investment with current income that can provide protection against rising interest rates. So it's achieving several different objectives all at the same time And we think that's pretty unique in the fixed income ETF universe. MBS IOs may sound exotic if you're not familiar with the mortgage-backed market, but it's a really, really large and deep liquid market. The mortgage-backed securities market, if you're not familiar, is the second largest market sector after treasuries. It's larger than the equity market. And so it's a lot of liquidity there. It's difficult to access as an individual investor because it's an institutional over-the-counter traded market. But we've got the tools and the experience to access that market very ably. Now, there are other strategies that people have used from time to time to generate diversification and negative duration, but almost all of those are negative carry. If you short treasuries, for example, you have to pay the coupon out. If you're buying put options, you've got the premium that you've got to pay, and then those are wasting assets in terms of time decay. Riser is different from all of those in that the positive carry from the interest income is an offset to what would otherwise be a cost to hedge. You're actually getting paid to have diversification and interest rate protection in your strategy here. As I said, this is something that requires quite a lot of quantitative modeling. We can be as transparent with investors as they want into the investment process, but this is not something that, as I said before, can be replicated very easily. We've been doing this for decades. We've been in the mortgage origination business, servicing, hedging, securitization, and that deep skill set is something that you just don't come across very often in fixed income ETF managers. So let's talk for a second about how MBS IOs work. When the government agencies, Fannie Mae, Freddie Mac, Ginnie Mae, guarantee a pool of mortgages, they will typically issue just a straightforward pass-through instrument that just passes through all the principal and interest. What Wall Street firms then do is they create new securities where they separate out the principal cash flows and the interest cash flows. So the IO, interest only, is receiving only the interest component from the tens or even hundreds of thousands of underlying mortgage loans. Okay, so those borrowers are just like, you know, the rest of us. We're just making our mortgage payments every month. And in the US, of course, we have the right to refinance our mortgages whenever it's financially advantageous. But as interest rates rise, as they have been for quite some time now, the borrowers have less incentive to prepay or refinance those loans. As prepayments and refinance activity slows down, that means those MBS IOs receive that interest cash flow for a longer period of time. And that's what causes the increase in value. So we're getting the interest component. When prepayments slow down, we receive that cash flow for a longer period of time. And that is what creates the inverse negative duration to interest rates and the broader bond market. Now, I want to make sure that people understand this. We're only buying mortgage-backed securities that are backed by Fannie Mae, Freddie Mac, or Ginnie Mae. So this is essentially U.S. government credit risk, and there has never been the payment default on any Fannie, Freddie, or Ginnie mortgage-backed security in the history of these institutions. So that's not something that you need to worry about. This strategy we launched in 2021, and it's done very well. Since inception, the average annual return has been almost 15%. We're up almost 5.5% over the last 6 months, and it's done 92% since cumulative since the inception of the fund 5 years ago. So it's been a pretty good ride here. And as interest rates have taken another leg up, we're continuing to see really nice performance in this strategy this year. As I mentioned, the correlation of riser, the inverse correlation to the broad bond market, is something that's very difficult to find out there. So we're minus 0.4 correlation to the Bloomberg Ag, the broad bond market. The other benefit, though, is that it has extremely low correlation to equities, right? So we're at minus 0.17 to the S&P and minus 0.118 to the NASDAQ. So you're not only getting an inverse relationship to the rest of the broad bond market, you're getting almost no correlation to the equities. So this is a kind of diversification that's very, very difficult to achieve any other way. And so adding riser to either a fixed income portfolio or even a blended portfolio can reduce the overall risk in that portfolio meaningfully. As you see here, the fund has been tracking the rise in the 10-year Treasury very closely since inception. It's actually down a little better even than the 10-year. And we just use the 10-year as a benchmark to show how the fund has performed. We're not actually benchmarking to the 10-year. We're looking at the diversification and the inverse correlation to the broad bond market. But if we just look at how it's performed as interest rates have risen, you can see just that strong connection to the 10-year Treasury. As I mentioned, there are other things that people have used to try to provide interest rate protection, and some of those have some similar benefits to riser. Depends on the scenario that you're looking at. If you're looking at an increase in long-term rates, riser again has performed really, really well. You could short treasuries, and that would get you that same kind of benefit. But if interest rates, an increase in short-term interest rates, you have negative carry on that short position with those treasuries. If rates stay stable, you've got negative carry there. Floating rates will perform reasonably well, as kind of as expected. But in the case of inflation, the only thing that provides a better direct connection to inflation is TIPS. The problem with TIPS is that they've got a very long duration. So when interest rates rise, TIPS fall in value. Now, if you're having a TIP and you're holding it to maturity, maybe you don't care about that. But if you're in an actively managed portfolio, having that negative duration in TIPS is not something that's very desirable. So just another alternative look at how it's performed against how the fund has performed against other products in the marketplace. Since inception, riser, as mentioned, this is June, the other chart was July. Riser has actually outperformed the S&P since inception, so up 90-some%. The S&P is up 86%, and it's done it with 1/3 of the volatility of equities. So the strategy is designed to perform exactly as it has been. And we've been really gratified at how well it's performed and how well it's been accepted by investors. Talk now about the second strategy. This is FixP. And as I mentioned, this is a tactical allocation model that invests in different ETFs depending on how they're performing in real time. As I mentioned, there's 24 different ETFs that are eligible for inclusion in FixP. And we run a very complex risk model that is used to make the allocations that runs on a daily basis. And we don't always change the allocations on a daily basis. Obviously, the turnovers is not as high as all that, but it is dynamically allocated. And one of the things that we think is really important here is that the sort of traditional fund it and forget it fixed income strategy that a lot of folks have followed for a long time is not really purpose built to the market environment that we're in right now. We think it is very beneficial to have some sort of dynamic allocation strategy like we employ in fixed P. And there aren't a lot of products out there that have that sort of strategy. So as I mentioned, there is a multi-factor model that is underlying the allocations. This is one of the things that differentiates Folio Beyond from maybe some other ETF shops is that because we have such a long track record of institutional investment in fixed income, we have a really, really sharp focus on risk management. As anybody who's been watching the markets for the last few years, risk management has kind of been shoved to the side in some cases in terms by people who've been sort of chasing the next hot thing. We think that having a strong risk management discipline is really important in the current market environment. As I mentioned at the beginning, there's a lot of different risk factors in the marketplace that people have to contend with now. And the fund it and forget it approach to fixed income just isn't going to cut it anymore. As I mentioned, the quantamental, as we call it, it's a fundamental but very quantitative approach that we use here is, again, not something that is easily replicated by individual investors or investment advisors. And so we think that having fixed P, taking a look at fixed P as your core plus multi-sector fixed income sleeve can make a lot of sense. And we'll talk about the performance of this strategy, how it's done. Our benchmark here is the Bloomberg Ag. We're cleaning the Ag's clock. There's just no other way to put it. The 1 month, 3 month, year to date, the Ag is actually down in all of those categories. Fixed P has a positive return 1 month, 3 month, and year to date. On a 1 year basis, we're more than 2 times the return of the Ag, and we're doing it with less volatility. Again, there's that focus on risk management. We want to make sure that we're not just swinging for the fences here and just adding volatility as a way to beat the Ag. In fact, we try to outperform the Ag with no more than, and ideally less than, the volatility of the Ag. And that's been how it's actually played out since the launch of the fund. A couple of the factors, or the main factors that we look at in making these allocations, is for each of the ETFs, we're looking at duration, prepayment risk, call risk on the corporate side. What's the credit risk? We're looking at, we've been running option adjusted spread models that take into account call risk as well as default risk. We have tax adjustments for munis versus corporates, and we're looking at, we do include tips in the constellation of strategy of ETFs that we can buy in this strategy. So inflation measures also work into this analysis. As I mentioned, there's 24 funds that are eligible for inclusion, but typically we're invested in something like 4 to 8. The current allocation is, as it shows right here, so high yield, SJNK. We do have an allocation to Riser, which has helped the returns here. Currently, we have about 16% in tips. We've got 13% in BKLN, which is a floating rate bank loan strategy. and then 10% of the fund is in REM, which is a REIT ETF. So just to sum up, and I threw a lot of information there at you in a really short amount of time, but we'll leave time for questions if folks have any. Why we think that anybody who's investing in fixed income should at least take a look at these two, because there's really nothing else quite like this out there. Riser, one of the few liquid positive carry ways to hold negative duration. It's the negative correlation to the ag, makes it a great diversifier. As is mentioned, near zero correlation to equities. 5-star rating from Morningstar, 5-year track record. We think that this is something that is demonstrated its value really, really well. And on the fixed P side, again, you've got systematic sector rotation across the entire bond complex. Plus, we're generating option premium. Again, nothing else out there quite like this. We think that it's worth a look for people who want to have a broad exposure that's dynamically allocated to what's working in fixed income in real time. I'm responsible, together with my partner, Young Lim, for the strategy and the portfolio management of both of these. As I mentioned, either one or both can fit into any fixed income investor or blended portfolio that people might have out there. So I'll stop there. That was a whole lot of information, and we can have questions if folks have any.
Thanks, Dean. The Fed has held its policy rate at 3.5% to 3.75%. Inflation is still above its 2% objective, and 30-year mortgage rates remain around the mid 6% range. What do you think investors misunderstand about the relationship between Fed policy, longer-term rates, and the mortgage market right now?
Well, that's a complicated question there, isn't it? I mean, I think that there's a very well-known cognitive bias that investors and investment managers have just the same as everybody else. It's called recency bias. And people who have been in the market for a while have looked at the very severely repressed interest rates that have been there since the financial crisis of 2007, 2008. And somehow this idea has come up that that's the norm. That's where interest rates are supposed to be. They're supposed to be really, really low. And in fact, today is not the anomaly. That was the anomaly. And interest rates right now are not particularly high by historical standards. And so I think that there needs to be a reorientation in some people's minds about what is the sort of baseline expectation for interest rates going forward. I think Kevin Warsh knows this, and I think that as we saw at the last Fed meeting, there were 3 votes to raise rates, and the minutes just came out today, and there were 2 additional non-voting members who wanted to raise at the last meeting. I think that we're in a new regime that's very different from the one that a lot of people on this call maybe have experienced for a large portion of their investment careers. And the reality is you're going to just have to get used to a higher interest rate environment for a lot of reasons. We're not going back to zero.
RISR is built around mortgage interest-only securities, which many investors rarely encounter directly. Can you explain the economics of an IO, particularly why slower refinancing and mortgage prepayments can increase its value, and why that can create negative duration rather than the positive duration investors associate with ordinary bonds?
Right. I touched on this earlier, but we went through it really quickly. So let me just reiterate. The mortgage payment that you make, that I make, anybody makes, is a component of interest early in the life of the mortgage. It's mostly interest, and a component of principal. Now, if interest rates decline, the borrower has an incentive to prepay that mortgage. And if you own that mortgage or you own an interest in that mortgage, the cash flow goes away, right? You get your principal back, but the interest cash flow stops. Conversely, when interest rates rise, that borrower doesn't have any incentive to prepay that mortgage. He's just going to sit in that mortgage and just keep paying that low interest rate. In fact, about 60% of the mortgages that exist in the United States right now have interest rates below 3.5%. So the zero interest rate policy that was pursued by the Federal Reserve for the last almost 20 years now has created a lock-in that makes it so that with interest rates where they are now, mortgage rates are above 7% in a lot of the country. If you're sitting on a 2.5%, 3.5%, 4% mortgage, you have very little incentive to prepay that loan. In fact, interest rates would have to fall a lot, from 7 down to 5, 4.5%, 3.5% before that mortgage loan becomes prepayable economically. So as interest rates have risen, prepayment rates, refinance rates have slowed down. That increases the amount of time that the IO holder is going to receive the interest component from all of those underlying mortgages. So if I was receiving the interest payments for, call it 7 years on average before a loan prepays, now that is stretched out to 10 or 11 or 12 years. That has increased the amount of future cash flow that I'm going to receive. And that means that when interest rates rise, prepayments slow down, I get that cash flow for longer, the value of my IO goes up. This is an instrument that is very commonly used by sophisticated investors, hedge funds, large institutional investors. They're used by mortgage companies. They're used by banks to hedge their mortgage pipeline. So this is not as exotic to the institutional market as it may seem to retail and investment advisors, but it's very commonly used, and it's a very, very deep and liquid market. As I mentioned, the mortgage-backed securities market is second only to the treasury market in terms of volume and trading activity. I see hundreds and hundreds of opportunities to invest in interest-only securities every day from the street. I'm very, very selective. Maybe out of the 350 or 400 bonds that are available to me in any given day, maybe I think 3, 5, 7 are interesting. And because of that selectivity, and because
Dean, excuse me, I hated to interrupt you. Yeah, we've run out of time, but we really do appreciate your very informative presentation. Thank you, Dean.
My pleasure.
Thank you. Now, for more information about Folio Beyond and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Up next in today's Beyond the Index conference is Sarmaya Partners. Presenting today will be President, Co-founder, and CIO Wasif Latif. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Wasif, please go ahead.
Thank you, Craig. It's great to be here, and a lot of great presentations. I think this one is going to be a really good presentation on something that we believe is very, very different from what's out there in the rest of the marketplace, simply because of the way we approach the investment. So I'm going to share my screen to highlight some key elements of our strategy and our ETF. The ticker is LENS, LENS. This is our company is a few years old. The name Sarmaya means capital, it means wealth. And what we try to do is compound that wealth for our shareholders through our secular investment approach. So we are secular investors that believe in the big picture of a secular theme and invest alongside of that secular theme and compound the returns over multiple years as opposed to a short-term tactical type of an operation. Our strategy is very much an equity-focused strategy, and it is a concentrated strategy on what we believe to be the next big secular theme, which is a commodity super cycle. The track record for the strategy goes back to 2020, and so it's been around for a long time. The strategy is now in an ETF form, which launched at the beginning of last year in January of 2025. So the numbers that I will show you will be representative of the ETF when it launched in January of 2025. A few slides here are important to touch on as the background and the backdrop for our framework and why we think we are entering and actually have entered a commodity super cycle. And so this is our framework slide, which looks at prior secular themes across the last several decades of market history. And this can go back even further in time. And you can go back to the 1800s, the early 1900s, and similar type of secular themes would emerge. So in this case, we're showing that in the 1970s, the big major secular theme of that time was investing in gold and oil. In the 1980s, it was investing in Japanese equities. In the 1990s, it was investing in the internet boom, particularly in the second half of the 90s. And in the 2000s, the big secular theme was emerging market and everything related to commodities. And since the great financial crisis, we have been in the secular theme of mega cap tech, and it has taken up many different shapes and sizes, but it has been a secular theme for the record books. One thing we've also added is a light gray line in this, which hopefully is viewable, which represents the S&P 500 as an indication of how each secular theme had performed versus the S&P 500 over that time period. So a couple of important key takeaways out of this is, number one, no secular theme lasts forever. Eventually, they all decline. Number two, as one is peaking or maturing and running, the new one generally tends to emerge and start in its shadow, and the broader investment public doesn't even realize it, and the market doesn't even realize it when that happens. So we believe, if you look all the way to the right of this chart, we believe that in the 2021 period, the new secular theme, which is emerging and really becoming the market focus now, has been a commodity super cycle, and we're calling that commodity super cycle the return to tangibles. And we think that that's what the world is really doing through a series of catalysts since 2021, whether it was the pandemic lockdowns that ignited inflation out of its slumber after many decades, to the Russian invasion of Ukraine, to the currency wars, as well as the tariffs, and then most recently the invasion or the war, I should say, in Iran. And all of these have been different catalysts that have contributed and continue to pull the market and investors along commodities, particularly in gold and oil, that have led the way, but others as well, including copper. So a couple of slides on really the backdrop of why we think that is happening. As I mentioned, those catalysts were really the igniters, if you will, of that along the way. The other thing that has been occurring is the macro backdrop. And when we look at the world through the lens, pun intended, through the lens of the inflation and economic growth grid that's on the screen, we can see that, generally the world has 4 different quadrants through which we can see the world operating in terms of the markets and the economies. And we believe post the deflationary bust that we experienced of the GFC in the great financial crisis, more or less since the pandemic and even a few years prior to that, we began to enter what we're calling the inflationary boom part of the quadrant. And we think that we're in that for now. And the policy that's been in place for a few years has been to run the economy hot, like the 1950s, so that we can grow our way out of the high levels of debt that we have, but also continue to grow economically and create an economic prosperous environment for the US. The risk is that because some of the shocks are the supply side shocks, we actually end up in a stagflationary environment where the prices continue to rise and inflation continues to be an issue, but economic growth is lackluster or anemic. And you can see that in some of the similarities that we're seeing in the inflationary numbers in this cycle compared to the 1970s. So this slide is showing just the CPI of the 1970s in the dark blue versus the CPI that we've experienced since 2014 in the light green color. And we can see that it's tracking closely. And when we say that it doesn't precisely match, history does often rhyme. It doesn't necessarily repeat. And we think that this is likely to continue with an inflationary impulse. And we believe that as the quadrant that I showed earlier, we're in the top half of that quadrant, whether we remain in the 1950s style run it hot economy, or we risk moving into the stagflationary era, we're going to be in a higher inflationary environment. So this is a view of the US dollar looking at the DXY, which is the trade-weighted US dollar going back to the 1960s. And as we can see, the dollar since then has had 3 primary bear markets. And our view is that we have entered a new bear market for the dollar. We're not de-dollarization folks. We don't believe in that. We think the dollar is still going to maintain its status, but that doesn't mean that it cannot have a depreciation similar to the prior bear markets. And that coincides whenever the dollar is generally under pressure or weak. That generally coincides with commodities doing well, non-US assets doing well, and assets like large cap growth generally tending to struggle because of their impact from capital flows as money might flow out of the US and into non-US assets. This last slide is showing the relationship, the ratio of commodities to financial assets, in this case, the S&P 500. So as this line is rising, commodities are outperforming the S&P 500 or the market. And as this line is dropping, then the S&P 500 or the market is outperforming commodities in general. And as you can see, this line is at the bottom. In fact, it's more than a standard deviation away, and it's been bumping along the bottom at multi-generational lows. And we think that this is about to turn. In fact, it has already begun to turn. And we think that this is likely going to continue similar to what we saw in the 2000s, which was the last major commodity super cycle. So shifting gears a little bit, talking about the sub-themes within our secular theme. So as I mentioned earlier, our secular theme is the return to tangibles. And inside of it, we have 3 sub-themes that we think are really good way of not only organizing the communities, the commodity space, but more importantly, identifying the kind of areas that we think are going to be leading this commodity super cycle. So really quickly, the 3 sub-themes in the portfolio that we manage are energy is life, the geopolitical and fiscal risk era, and build the future. And in our view, these are the primary drivers of the commodity super cycle. And it kind of makes sense because when you look at any prior commodity cycle, the areas that really lead the way and tend to continue to run and compound over time are the big ones, are the big commodities like oil, like gold, and like copper. And each one of these is dominated by those. So on the energy is life, our approach is to invest in oil and gas companies. And this is, just to be clear, an equity portfolio, as I mentioned at the top of the presentation. This is an equity portfolio that invests in the equities of these commodity-centered companies. And we'll touch on a little bit of why we think that's better than investing in the direct commodities themselves. But in the energy is life section, we invest in oil and natural gas companies. We also invest in energy service companies, which tend to have a higher beta to oil itself and energy itself, and have much stronger returns as the cycle moves forward and matures. We also have exposure to uranium mining companies because of the nuclear renaissance that we think we're still witnessing and is underway. And we think that that's going to be continuing on. And this is occurring after years of underperformance, underinvestment in this space, both in the supply side, in the infrastructure side, as well as the investment side. The second sub-theme is one of geopolitical and fiscal risks. That was probably most intuitively understood. It is the idea that ever since the great financial crisis, the world has gradually but continually moved towards higher and higher elevated geopolitical and fiscal risk situation. And over the past several years, that continues to escalate. And one big catalyst, if you will, was the Russian invasion of Ukraine on the geopolitical front, where in response to that invasion, as we now all know, the US and Europe confiscated Russia's foreign reserves, which are predominantly denominated in US dollars and euros. And as a result, that sent a message to pretty much all central banks and countries around the world, friend and foe alike, that your dollars are not necessarily protected. And so that began the movement of diversifying away from the dollar and diversifying their portfolio into gold as a primary recipient of that. So treasury holdings have been coming down since then in those countries' balance sheets or central bank balance sheets, and gold has been increasing. We believe, and alongside of that, we also like silver. And in this sub-theme, we actually own gold and silver directly, in addition to owning the gold mining companies, because again, the gold mining companies have that additional beta attached to them. They generally do 1.5, sometimes 2 times the return of the metal itself, simply given the operating and financial leverage that they can enjoy over the cycle. The fiscal side of that risk, we believe, hasn't even kicked in. It's just begun. And today, incidentally, is a great example of the fiscal side really beginning to make its impact. So on a day like today, where the Treasury announced that they're going to buy back the longer end of the bond market, their issuance, and use the shorter term bills, that's indicative of higher inflation, pretty emerging market type of behavior. And that generally means a debasement of the currency. And as a result, we saw a big jump in gold and silver and their mining companies as a result of that. So the strategy did exceptionally well today, especially in a day where the market was flat to negative. The last sub-theme is build the future, which is basically saying that despite all the challenges and everything that the world is dealing with on a macro level, the world will continue to build the future in terms of the infrastructure, not only for the data centers and the AI infrastructure, but also for all of the other emerging countries around the world, particularly in Asia, but also in Latin America. As friendshoring and as supply chains get reconfigured, there will be duplicative factories and other elements built out, in addition to all of the infrastructure that might be built in those countries. So copper for that purpose becomes really, really important. So I spent a lot of time up front to break down sort of our approach. The next few slides, I'll be a little bit quick. This one is showing the breakdown of each of those sub-themes that I just went through, and wanted to highlight the underlying exposures that are in these sub-themes. So there's a little bit of a, tangible view, pun intended again, of what that looks like. So in the geopolitical and fiscal risk, and those are the weights that we had of each sub-theme at the end of last quarter on June 30th. And as you can see in the geopolitical and fiscal risk sub-theme, we have a healthy allocation to gold, but also to gold mining stocks, which is in the darker gold color. And then we have silver and silver mining stocks. Similarly, in the energy is life sub-theme, we have exposure to energy service companies, major integrated energy companies, as well as other type of energy exploration and production companies, natural gas companies, as well as the uranium companies that I mentioned as well. And then in the Build the Future, the preponderance of the exposure is to copper mining companies, but it's also exposure to things like iron ore and platinum, because they're all going to contribute to building that infrastructure, as well as some industrial companies that are going to be able to allow that exposure. So really quickly, two things to remember is, number one, our strategy is actively managed. It's actively managed across both the sub-themes and then within each sub-theme. And this shows the weights of each sub-theme in the portfolio at the end of each quarter. I just wanted to highlight the active management approach that we have. And one quick example is that at the beginning of this year, as the gold and silver price was getting really, really frothy and it was running up, we are longer term bulls and we're big believers in the secular move in gold, and we think that there's a lot more to come. But that gave us pause, that move. And as a result, we were seeing on a relative value basis some attractiveness coming in on the energy side. And by the way, this is even before the war had started. And so what we did was we proactively reduced our equity allocation to the gold and silver space and added to the energy space through the companies that are in those sub-theme exposures. And we continue to actively make those adjustments. As of today, each sub-theme is roughly about the same weight, the main two ones. And then Build the Future is a little bit of a lower weight, given our view that on a near-term basis, there seems to be a little bit of frothiness on the AI data center story. And the copper names have become part of what I refer to as the AI data center vortex. And so they're a little bit they are a little bit a part of that trade. And so on a relative value basis, we have taken that down. So it's shifting to the portfolio really quickly. Again, the strategy looks at the world from a top-down perspective and builds it from bottom-up perspective, looking at those sub-themes. We do have equities in the portfolio, and we try to have a barbell approach where in any given exposure or sub-theme, we'll have a higher weight to the higher quality, larger cap, more stable companies, and lower weight to companies that have a high degree of alpha potential and return potential, but they might have a little bit more volatility. So we'll have more of those in number and fewer weights attached to them. And that provides a little bit of volatility stability to the portfolio. We're going to run a pretty concentrated portfolio because we believe in the secular theme and the sub-themes and are only focused on that. We don't have a benchmark. We don't manage to a benchmark. We're only focused on the sub-themes. And as a result, we want to focus on that and concentrate on that. So the portfolio is generally anywhere between 35 to 45 names. Currently, we're running north of 40 names in the portfolio. So really quickly on the delta between owning commodities versus equities, this slide speaks for itself. A couple of things that I would highlight is that the equities of commodity companies, number one, they compound returns over time. Why? Because they can continue to sell the commodity at that higher price and compound it through operating and financial leverage. Number two, they pay a dividend, which is good. And then another important piece is we can have access to a much more broader swath of that commodity exposure. So for example, in energy, instead of owning just oil and natural gas in terms of futures, we don't have any futures, no derivatives in the portfolio. It's all equities. We instead own not only oil companies, but we own oil service companies as well, which, as I mentioned earlier, have that higher beta component. So we think that the return characteristics are not only stronger, less volatile, it's less subject to the very short-term mean reversion and volatility that may occur in commodities themselves. So we prefer to play this entire space through the equities. This is a return of the fund. This is already dated, so I'll just touch on that. As of today, the fund lens, the ETF, is up about 20% year to date, and since inception, it's up about 87%. And you can have a look at the information through your various data service providers. Some really important statistics to highlight on the ETF itself is we have a really high information ratio, and we're just comparing it against the S&P equivalent index. We're not saying we manage to it. It's just a highlight because most advisors and most folks' portfolios are measured against the S&P, so we use that as a measuring stick. So we have a high information ratio, very strong Sharpe ratio, really low correlation to the S&P because of what we're investing in, even though it's equities. The upside downside capture ratio is just very, very compelling, completely active share, and then low beta to the strategy itself. I just wanted to point out the importance of not having the benchmark because it doesn't tie us down to any kind of tracking error constraints or how a benchmark is moving and needing to own names that we might not want to own otherwise. And as a result of that, you can see on the left side of this slide, when you look at it from a Morningstar style box perspective, Lens, the ETF, continues to have a diversification across style and market capitalization. So it's a healthy allocation of value, blend, and growth, as well as large, mid, and small. And then on the right side of this chart, we show the geographic breakdown, and it shows that the fund has a healthy allocation to non-US equities, and that's given that commodities and the mining companies usually are overseas, that gives us some geographic diversification as well, especially if the environment is one where the dollar might be weakening, then non-US equities, their currency component also adds a boost as well. This is the portfolio in its entirety as of the end of last quarter, June 30th. And as you can see, it's a concentrated portfolio. You can see the weights that we have to each of the different underlying exposures. So between gold mining, integrated energy, we do have gold, as I mentioned, directly because we believe in the metal itself, because it's a very, very core part of what we think is driving some of the geopolitical and fiscal risk side of the story. And then I'll just touch on one last slide before I open it up for questions. One question that we generally get and want to highlight is our low correlation of this strategy to pretty much everything out there. And that's why we think we're different, because you can find natural resources products, you can find commodity futures-oriented products, but this is one that it highlights how different we are. Why? Because we don't have a benchmark. We're only focused on the sub-themes. And as a result, our correlation to broad equity indices, even the commodity ETF on this screen, we have a low correlation to, and then bonds speak for itself. And so the last thing I'll end with is that because of our returns and the correlation relationships, a lot of folks see our strategy as an alpha driver, but also one that is a diversifier in their portfolio. So they really like it from that perspective. And then lastly, some folks like it as a single line item position where they don't have to worry about actively managing and trying to tactically figure out 7 different commodity exposures through ETFs and having to explain all of those to clients in a statement. They like this as a single solution for all of their needs. So with that, I'll stop and see if there's any questions.
Thank you, Wasif. You've described the dominant theme for this market cycle as a, quote, return to tangibles, end quote. What convinced you that commodities and the businesses that produce them are entering something more durable than a normal cyclical upswing? And what would tell you that the thesis is wrong?
Yeah, that's a great question. I would say it goes back to that that four quadrant slide that I had. Let me share it again. But it really boils down to that, which is that it's the macro backdrop of why we are where we are. So it's two things. It's the top-down view and the top-down world of where we are in terms of the economic cycle versus the policy cycle from the fiscal dominance that we're facing, as well as the central bank policy cycle. But ultimately, we're in a fiscal dominant world with higher and elevated levels of geopolitical and fiscal risks. And we don't think that that ends anytime soon. The world is on a path of unsustainable environment from that standpoint. And then on a fundamental basis, from a bottom-up perspective, it goes back to the relative value of the commodity space versus the broader equity space. And we think that we're approaching an inflection point, much like we did in the two prior cycles, especially the one in the early 2000s, which then subsequently led to a commodity boom. So I think it's the combination of those that we think that it's going to be there. What would change it? What would change it would really be a longer term sustained deflationary bust, which doesn't seem to be in the cards, because even if we get a recession or a recession scare or something happens on the credit side, what will occur is you're going to have the policymakers again providing liquidity and again providing stimulus through potentially another version of QE. And if that happens, our view is that given the circumstances now with the level of debt and deficits, that's actually going to spur more inflationary concerns and boost commodities even higher.
Thank you very much, Wasif. For additional information about Sarmaya Partners and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or info@redchip.com. Thank you for joining our conference today.